Hello everyone, welcome to this comprehensive session in which I will be providing you the most important RBI notifications, RBI press releases and finance current affairs. So this one video will save a lot of your time and efforts as you will not have to go through the multiple different videos, you will not have to go through the whole playlist of the Finance 360 degree to find the important and relevant articles from March 2026. In this one video, that is the compiled video, you are getting the most important RBI notifications, finance current affairs, RBI press releases that we have discussed in March 2026. Okay, so this is a very important video for your RBI Grade B 2026 preparation. Let's get started with the topics now. But before that, there is a big announcement from EduTap that we have brought for you this RBI Grade B guidebook. This guidebook is absolutely free of cost and it is providing you the PYQs for the different components, for the different sections. It is providing you the important topics that you have to focus on in the different sections, in the different components, as well as the resources have been laid down in this guidebook. These resources you can follow if you are doing the self-preparation. Okay, there is also the 6-step strategy that has been mentioned in this guidebook so that you are moving in the right direction in your preparation for the RBI Grade B examination. So this guidebook is absolutely free of cost. The link for this guidebook is provided in the description box below. So now let's get started. Hello everyone, welcome to EduTap and welcome to today's Finance 360 degree session in which we are going to discuss two very important news articles, two very important finance current affairs. Okay, the first one is regarding the new CPI series. The base year has been changed, and with the change in the base year, there is the change in the basket of the consumer price index. There is the change in the weight that all we have to discuss, as well as there is the international measures that is being followed. So that we will discuss that what is this new guideline, the new framework that we are following. Okay, so this we are going to discuss in detail in today's session so that you have the clarity about the new CPI series, the basket, the weights and all the nitty-gritties we will be discussing in today's session. The next news article is regarding the real GDP. So for the real GDP, the base year has been changed, and with the change in the base year, there is the data that has been released for the growth. Okay, so that we will discuss. So these two news articles, they are going to be very important from your examination perspective, because the real GDP as well as the CPI that determines the inflation in the country. So both of this is very important from the examination point of view, from your syllabus point of view. Okay, so let's get started with the discussion for today, and give me a thumbs up if I'm clearly audible and the screen is visible. Okay, so I hope that everything is fine. Okay, good morning everyone, good morning and welcome to the session. So let's start with today's discussion. Okay, so before starting with the discussion, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel where you will get the PDF of the session. Okay, and the link for the Telegram channel is provided in the description box below. So starting with the first topic for today, that is the Ministry of Statistics and Program Implementation has unveiled the new CPI series covering more items and services with the revised weights. So what is this new CPI series that we will discuss? We will discuss the highlights. We will discuss that what the Ministry of Statistics and Program Implementation has brought, what are the major changes that has been brought in the CPI series. But first of all, you have to understand that what is this CPI, what is the base year, what is the requirement of a basket and the revised weights. So let's have the understanding first and then we will come back to the news article. Okay, so MOSPI has unveiled the new CPI series covering more items and services with revised weights and with the revised base year. But before understanding this news article, let's understand about the consumer price index and the base year and the basic idea. Okay, so first of all, what is consumer price index? Consumer price index. See, consumer price index is the price index that shows the changes in the prices. That shows the changes, the movement of the prices. Now, the price index, it shows the movement of the prices. It shows the changes in the prices of what kind of goods? Consumer goods. Consumer goods and services. Okay, so consumer price index, it shows the movement in the prices, it shows the changes in the prices, the increase and decrease of the prices for the consumer goods and services. What are the consumer goods and services? Consumer goods and services are those goods and services that are consumed by the household. Okay, so consumer goods and services are those goods and services on which household is doing the expenditure. So basically, consumer price index is a measure that shows us the movement of the prices of the goods and services that the households purchase for the purpose of consumption over time. So this is the idea that the consumer price index, it shows us the movement of prices. It shows us the changes in the prices of the consumer goods and services over time that households purchase for the purpose of consumption. So this is the idea. So this is the consumer price index that shows us the change in prices of the consumer goods and services. Now, what are the goods and services that are consumed by the consumers? So there is a basket of goods and services that we are consuming. We are consuming the food and beverages. We are consuming the clothing, footwear. We are buying the clothing, footwear. We are also buying various services, healthcare services we are buying, personal care services we are buying the nanny services, the babysitter services, we are buying the online subscription services and such. So we are buying different goods and services. So this is a basket of the goods and services that we are consuming, okay? So this is a basket of goods and services that the households are consuming. So consumer price index, it shows us the fluctuation in the prices. It shows us the movement of the prices of the goods and services that is consumed by the consumers, that is consumed by the households, okay? So this is the idea. So in the consumer price index, the index value is calculated by taking the current year prices of the basket of goods and services and divided by the base year prices of the same basket of goods and services that is consumed by the consumers multiplied by 100. So basically the index value is showing us the change in the prices from the base year. So this base year, it provides a reference point, it provides a comparison point for the other years, okay? So base year prices or the base month prices, they are basically providing the comparison points against which the other years can be compared. So CPI index value or the index value is generally calculated taking the current year value divided by the base year value multiplied by 100. So base year is nothing else, it is a chosen year taken as a reference point to compare the prices over time, to compare the value over time, okay? So the index value for the base year is kept at 100, okay? And against this value, the other values are compared. So that is the idea. So what is the consumer price index? It measures the changes in retail prices of goods and services households buy for consumption. So basically under the consumer price index, this is a price index where we are seeing the movement of the prices, the ups and downs and the changes in the prices for the goods and services that is consumed by the household. Base year is the reference year whose value is decided at 100 and base year provides a reference point against which other years can be compared. Now the previous series had a base year of 2012. So CPI series. So the previous series that shows us the movement in the prices of the goods and services. So this CPI series had a base year of 2012. Now you can understand that we were comparing 2012 with 2026. We were comparing 2012 or we were comparing 2025 with 2012. Now from 2012 till 2024, 2025, 2026, we can understand that there are major changes that have happened in the consumer behavior, in the consumption patterns of the households. We have started using more of the online services. We have started using more of the different kind of services, like the digitalization has happened, because of which we are using the digital services and such, okay? So from the 2012 till now, there are various different services or there are various different goods and products that the households have started to utilize, okay? There is the change in consumption patterns, not only in the urban areas but also in the rural areas. So it was found that, okay, we need to change our reference period, we need to change our reference point, we need to change the base year, because since 2012 till now, there is a lot of changes that have happened in the consumption patterns of the individuals. We will discuss that how the consumption patterns have changed, but this is the basic idea. So previously the CPI series had the base year, that is the reference point, that is the comparison point of 2012. But now as we know that 2012 and 2026, a decade has passed, and in the decade there are various changes that have happened in the consumption patterns, due to which it was analyzed and it was discussed that now we need to have a different reference period, now we need to have a difference comparison point, and that's why the new base year has been identified, that is 2024. So this is the new base year for the CPI series. Now against this base year, the other years will be compared, okay? So previous series had a base year of 2012 and was based on consumption expenditure patterns of 2011-2012. So you can understand that the previous series was based on the base year of 2011, based on the base year of 2012, sorry. And the consumption expenditure patterns were seen for 2011-2012. Okay, so previous series, the previous CPI series was based on the base year 2012 and was based on consumption expenditure patterns of 2011 and 2012. So that means the basket of goods and services, for which we were seeing the price changes were according to the consumption expenditure pattern of 2011-2012. CPI series had the base year, that is the reference point, of 2012. As well as the CPI series, we were seeing the consumer price index, we were seeing the price changes, and with these price changes, we were seeing the inflation, that is the CPI inflation. We were seeing the consumer price index inflation, that how the prices are rising for the consumer goods and services. So we were seeing the consumer inflation, consumer price index inflation, with the basket of goods and services that were dependent on the consumption expenditure pattern of 2011-2012. So you can understand that according to the consumption expenditure pattern of 2011-2012, the basket was formed for the goods and services that the consumers are consuming, that the households are consuming. Now you can understand that since 2011-2012 till now, there is a lot of change that has happened in the consumption pattern, in the behaviors of the people, in the behaviors of the households. The digitalization, the urbanization is rapidly happening, and with that the consumption patterns are also changing. And with the change in the consumption patterns, this basket of the goods and services might not be the correct representation of the household expenditure. Okay, and that's why it was identified that we need to change the base year, as well as we need to change the basket of the goods and services according to the new data of the household consumption expenditure pattern. So now the new base year is 2024 and the new household consumption expenditure pattern that we are seeing is for 2023-24. Any confusion here? Previously, we were using 2012 as the base year and we were seeing the consumption expenditure pattern of 2011-2012. According to the consumption expenditure pattern, there was the basket of goods and services that was representing the households, the expenditure of the households. But now it has been said that the base year is changed to 2024 and the household consumption expenditure pattern will be seen according to the 2023-24 and the basket of the goods and services will be according to the new household consumption expenditure patterns. Okay, so this is the idea. So the previous series had a base year of 2012 and was based on, so previous consumer price index series had the basket of goods and services according to the consumption expenditure pattern of 2011-2012. Now, and this was the previous basket of goods and services. So food and beverages, pan, tobacco, intoxicants, clothing, footwear, housing, fuel and light, and miscellaneous. These were the 6 groups that were identified according to the consumption expenditure pattern of 2011-2012. Now it was said that the households are doing the expenditure on these 6 groups, and that's why the consumer price index or the price changes and the inflation has to be seen for these groups, for these goods and services. Okay. Now it has been said that the base year of the new CPI series, is 2024. That is a newer period has been taken as the reference point to compare the coming years, period. Okay. So the item basket, now if the base year has changed to 2024, that means we are focusing on the recent or more near base year. So we are taking a reference period of 2024. So with the base year, the item basket and the corresponding weights are also changing, and they are based on household consumption expenditure survey. So now with the change in the base year for the consumer price index series, there is also a change in household consumption expenditure survey that we are using. Okay, so consumption expenditure pattern has changed. The consumption expenditure pattern of the people have changed since 2012 till 2026. So with the change in the consumption expenditure patterns, we need to take the new data, that is the household consumption expenditure survey we will be utilizing of 2023-24 to have the new basket of the goods and services on which the households are spending. I hope this is very much clear that with the base year of 2024, there is the household consumption expenditure survey of 2023 24 that we are using. So this base year 2024 is the new reference point against which we will be comparing the other years for the consumer price index, for the changes in the prices of the goods and services for the consumers. And this household consumption expenditure survey, it shows us the new consumption expenditure pattern of the households, and this new consumption expenditure pattern of the households provide us the new basket of goods and services on which the households are spending. So households are spending on food and beverages, pan, tobacco, intoxicants, clothing and footwear, housing, water, electricity, gas and other fuels. Before we were only taking housing separately, but now we are taking the housing, water, electricity, gas, because if you are living in the house, like think about it, if you are living in an apartment or if you are living in your own house, you are paying for the house rent as well as you are paying for water, electricity, gas, and you are paying for other fuels and such. Furnishing, you also spend on furnishings, household equipment, routine household maintenance, also health, also you are paying for your health, transportation, information and communication. You are also paying for recreation, sport and culture. Nowadays there is more expenditure that is happening on your gym equipments and such, on your recreational activities, sport activity, culture and such. Education services, you are also paying for restaurants and accommodation services, personal care, again gym equipments and such, social protection and miscellaneous goods and services like the babysitter fees you are paying, or nanny, for the nanny you are paying, for the OTT subscriptions you are paying, for the online subscriptions you are paying, for the online services you are paying. So this is the idea that now the consumption patterns have changed. Before the consumption patterns, before the old CPI series was dependent upon the consumption expenditure patterns of 2011-2012, where the consumption goods and services, the goods and services on which the consumption was happening was considered to be these 6 groups: clothing, footwear, housing, food and beverages, pan, tobacco, intoxicant and miscellaneous, that is other services. Okay, but now there is the bifurcation that has been done as per the new household consumption expenditure survey, that is of 2023-24. As per this expenditure survey of the households, there is the new division and the new goods and services basket that has been identified. Now if we have a new basket, that means the new basket will have new weights also. So I have brought the weights in the descending order from the largest number to the smallest number, so that you can see that food and beverages have been given the highest weight, because the households, they do spend a lot on food and beverages. We all spend a major chunk of our income on the food and beverages. Okay, housing, water, electricity, gas and other fuels, this has the second highest weightage, then transportation, then clothing and footwear, then health, then personal care, social protection and such, then furnishings, household equipment, then information and communication, then restaurants, accommodation, education, then education, and then pan, tobacco, intoxicants, then recreation, sport and culture. So this is how the weights have been bifurcated. Okay, the highest weight that you have to remember, that the highest weight is given to the food and beverages, the second highest is given to the housing, water, electricity, gas and fuels. So this is the idea. So before, in 2011 CPI series, the basket of the goods and services was divided in between 6 groups on the basis of the consumption expenditure pattern of 2011-2012. But now, as per the 2024 CPI series, that is the CPI series that has a base year of 2024, the goods and services basket that the households are consuming, they are divided in between 12 divisions. 12 divisions. So rather than having 6 groups, now we have 12 divisions. Okay, and these 12 divisions are as per the household consumption expenditure survey of 2023-24. Any confusion, anyone? So the base year of the new CPI series is 2024, where we are taking the value of the CPI as 100. So consumer price index for 2024 has the value 100. So this is the base year, this is the reference period against which we will be comparing 2025-2026. Okay, the latest household consumption expenditure survey of 2023-24 is used for updating the item basket, that is the goods and services basket that the households are consuming, with weights. The weights have also been changed. So before, the food and beverages had the weight of 45.86%. So before, the food and beverages had the weight of 45.86%, but now the food and beverages have the weight of 36.75%, because you can understand that your expenditure is divided amongst your gym payments, and for gym equipments you are paying for the nanny services, for the babysitter you are paying, you are also paying for the OTT subscriptions and such. So there are various expenditures that you are doing. So your expenditure has been further bifurcated. Okay, so food and beverages now has a lesser weight of 36.75% in comparison to the previous weight that was given to food and beverages. Okay, so this is the idea. So the weights and the item basket have been changed for the new series. Coming to the next point, that is your group wise weights as per CPI 2012. So these are the group wise weights. Okay, this is for the CPI combined. This is for the CPI combined. Now here you can see that for the consumer price index, it is released for the rural, it is released for the urban, and the CPI is also released for the combined, that is rural and urban combined. So we focus on CPI combined. We focus on CPI combined. Okay. So here, because CPI combined is for the whole of the country, rural areas plus the urban areas. Now, the group wise weights as per CPI 2012 structure. Now this structure is not being followed. In 2024 also, we are not following this structure. We are following this structure for the urban areas, for the rural areas and such. Okay, so basically this structure is not longer being followed. If this structure would have been followed, then the rates would have been different. If this structure would have been followed for 2024, then the rates and the percentages would have been different, because the weights have been different. If this group wise weights were being followed, or if this group was being followed, this 6 group structure, if this was being followed, then there would have been different weights. Then there would have been different weights for 2024. But it is said clearly that this group wise weights was only followed in 2012. Now we are not going to follow this group wise weights. Now we are following the 12 division structure. Okay, so this was previous group wise weights of CPI 2012. This was the idea. Now the change in structure between both the series is due to adoption. Now change in structure from the 6 group structure to the 12 division structure. So the change in structure that has happened, it is because of the adoption of COI/COP 2018 framework. Okay, that is, we have adopted the classification of individual consumption according to purpose 2018. So CPI 2024 series adopts the classification of individual consumption according to purpose 2018, replacing the earlier structure comprising 6 broad groups. So now we are not going to follow these 6 broad groups. Now we are not going to follow the 6 broad groups. Now we are following the 12 division structure. Okay, the latest classification system has been developed by United Nations Statistics Division. Under the revised framework, expenditure is classified into 12 divisions. Expenditure is classified into 12 division. Under the 12 division, like in the second level, there are 43 groups, 92 classes, 162 subclasses, enabling and 358 items at the last level. So basically now we have shifted away from the 6 group structure to the 12 division structure, and this structure is as per the classification of individual consumption according to purpose that was developed by United Nations Statistics Division, so that we are following the international guidelines, or we are following the international norms. Okay, so the new structure is as per the United Nations Statistics Division. Under the revised framework, there are 12 divisions that we know about. Under the 12 divisions, at the second level, there are 43 groups. Then at the next level, there are 92 classes. Then at the next level, there are 162 subclasses. And at the next level, there are 358 items that are under these 12 divisions. Okay, so this is the broad idea. So before, there was the 6 group structure that we were following with the base year of 2012, but now it has been said that we will not follow the 6 group structure. Okay, if we had followed the same 6 group structure, then there would have been different weights for the 2024, but we are not following this 6 group structure. Now we are going to follow the 12 division structure. Okay, and 12 division structure with the base year of 2024. And for the 12 division structure, the weights have been determined on the basis of household consumption expenditure survey. That is the basic idea. Okay, so this is what we have discussed. Now coming to the major update, the index reference period. See the term index reference period. If a question comes on the index reference period, what is the index reference period? So index reference period means the reference period against which the consumer price index is compared, or reference point against which the CPI value is calculated. So index reference period is nothing else. It is the reference period that is 2024. The base year, that is the reference period of 2024, where the CPI value is 100. Now price reference period. What is the price reference period? Now the base year is 2024. Base year is 2024. That means the reference period is 2024. That means for the price reference period, the 2024 is the period. So from January 2024 till December 2024. Okay, so price reference period, it is the period during which the base year prices are collected. So the price reference period is the period for which the base year prices are collected. So base year prices are collected from Jan 2024 till December 2024. Okay, calendar year of 2024. So price reference period is the period during which the base prices are collected. The base year prices are collected. So base year is 2024. So the base year prices will be collected from Jan 2024 till December 2024. As simple as that. Okay. Next is weight reference period. So weights are divided according to what? The weights and the basket of the consumer goods and services. This is decided as per the household consumption expenditure survey. So weight reference period, it is the period for on the basis of which the weights are calculated. So weights are calculated on the basis of household consumption expenditures survey of 2023-24. So weight reference period is 2023-24. Base year is 2024. Price reference period is Jan to December 2024, and the weight reference period and the basket reference period is 2023-24. According to which the weight and the basket is decided, according to which the 12 divisions are decided for the base year and for the new CPI series. Chalo. Now revision of item basket and coverage. So at all India level, that is why we focus on CPI combined. See, CPI combined is the most important CPI measure. Okay, so CPI combined, this is for the whole of the country, that we are seeing the fluctuation in the prices for the basket of goods and services that is consumed by the household. CPI combined, through this we calculate the inflation, that okay, if the prices are increasing for the consumer price index combined, that means there is inflation in the country. Okay, so through the CPI combined we calculate the inflation in the country. At the all India level, the number of weighted items has increased from 299 to 358. So before 299, these were the items that were taken in the consumer goods and services, or these were the items that were taken in the basket of the goods and services for the consumer price index. Okay, but now there is, under the new CPI series, that is CPI 2024 with the base year of 2024, the number of items that will be taken under the CPI goods and services basket are 358. So the goods items have increased from 259 to 308, and the services items have increased from 40 to 50. So you can understand that the total items that have increased from 299 to 358. Okay, so the number of items in the basket of goods and services for the consumers have increased from 299 to 358. This expansion strengthens the representation of the services sector, which has assumed greater importance in the household expenditure in now time. Now, key enhancements that have happened, the key changes that has happened: first time inclusion of rural house rent for improving coverage of rural housing consumption. See what happened, that earlier in the 2011-2012 consumption expenditure patterns, it was assumed that the rural areas, in this there was the self-occupied houses. The people live in self-occupied houses. That means the people do not have to give rent because they are living in self-occupied houses. So as per the consumer expenditure pattern of 2011-2012, it was seen that okay, the rural areas, they have the self-occupied houses. The people do not have to give rent in the rural areas. But now, as we are not seeing the consumption expenditure pattern of 2011-2012, now we have the household consumption expenditure survey of 2023-24 that collects the consumption expenditure patterns of the new time, of the recent time. So as per the consumption expenditure pattern of 2023-24, it has been identified that the rental base is increasing in the rural areas. Okay, so rental market in the rural areas has expanded significantly. So there are rental markets in the rural areas also, and this household consumption expenditure survey has collected the data through the survey in the rural areas and urban areas. This household consumption expenditure survey has collected the data for the rents that the people are giving in the rural areas. Okay, so now we have the data for the rent that the people are giving in the rural areas. So first time inclusion has happened of the rural house rent for improving coverage of rural housing consumption, because in the rural areas now the people have to spend for the rent also. So previously, according to the previous consumption expenditure patterns that we were following, so it was assumed that the rural households or the rural people, they are not spending on the rent because they have the self-occupied houses. But now, as per the new consumption expenditure patterns, as per the 2023-24 data, it has been found that there is the rental market in the rural areas that have become significant, and the people are paying. There are various people that are paying the rent in the rural areas. So rural markets are expanded and the people have to spend on the rent also in the rural areas. So there is the first time inclusion of rural house rent for improving coverage of rural housing consumption. Okay, so this is for the first time that the rural house rent has been included. Rural house rent has been included in the consumption goods and services basket. Now strengthen the representation of modern consumption items such as online media services and fuels such as the compressed natural gas, the piped natural gas and such. Improved coverage of data available. Now what is happening that not only the items have been increased, but there is also the improved data that we are able to use. Okay, with the improved coverage of data available. So there is improved coverage of data available on digital and administrative sources. There is the improved data that we are using with the telephone charge data, rail fare, airfare, fuel, postal charges, online media and streaming services. So with all the new data, new and improved data that we have, so we are able to use all the available data or improved coverage of data availability that is happening. So improved coverage of data available on digital and administrative sources. Now there is improved coverage, improved usage of the available data that is going to happen. Okay, so this is the idea. So revision of the item basket that we have discussed from 299 to 358 items. Key enhancements: rural house rent is included in the basket of the goods and services that is consumed by the households. Okay, now strengthened representation is provided to the modern consumption items, online media services, the fuels and such. Improved usage and the improved coverage of the available data on the digital and administrative sources. Now the Ministry of Statistics and Program Implementation, it plans to institutionalize the base revisions at regular intervals. As per global practices, it should be done every 3 to 5 years. The base revisions has to be done so that we have the more recent reference point against which we can compare the other years. Okay, now coming to the summary, the base here has been revised from 2012 to 2024. The weight source or the basket source according to which the basket of goods and services is decided was Consumer Expenditure Survey of 2011-2012. Now it is Household Consumption Expenditure Survey of 2023-24, according to which the new basket has been decided with 12 divisions, and here the weights have also been decided as per the Consumption Expenditure Survey. Okay, total items tracked previously were 299. Now the total items tracked in the basket are 358. The food and beverage was previously weighed at 45.86%. Now it is weighed at 36.75%, and this is the highest weight that is given in the divisions. Okay, housing and fuel weight. So previously the housing only, because we were taking only housing, so it had the weight of 10.07%. Now the housing, because it is combined with water, electricity, fuel, and we are also seeing the rural housing rent and such, so the housing weight has been increased to 17.67%. that is second highest weight. The previous CPI series had the base year of 2012. Okay, now the new CPI series has the base year of 2024. So base has been revised from 2012 to 2024, 12 divisions in place of 6 groups in accordance to the classification of individual consumption according to purpose. Release of all India and state level item indices for rural, urban and combined sectors. So the basket has been released for rural, urban and combined sectors. New edition, rural housing is the new edition in the new series, as well as online media service providers, streaming services, value-added dairy products, Barley and its product, pen drive, external hard disk, attendant, babysitter, and exercise equipments, they are added in the new items. They are added in the new series in the new items. Items that have been removed from the new series are the VCR, VCD, DVD player, and hiring charges of these equipments, radio, tape recorder, clothing, second hand, CD, DVD, audio, video, cassettes, and coir or rope. So these kind of items have been removed because they do not have such huge chunk of expenditure of the people. Okay. Now, coming to the next part of the session, that is about the GDP new base year. So any confusion till now? Mayur, because we have to finish the session. Okay. Okay. Now, coming to the GDP new base year 2022, 23. So GDP new base year. So for the GDP also, there is the new base year. See, we calculate the real GDP and there is the current, or there is the nominal GDP. There is the real GDP and there is the nominal GDP. Okay, in the real GDP, we take the current production and we take the base year prices. Okay, in the nominal GDP, we take the current production and we multiply it with the current prices. Now you can understand that if the production is increasing, with the increase in production, if the prices are also increasing, so nominal GDP will increase by a greater proportion. Let's say the current production is decreasing, while the current prices are increasing by a greater proportion. So if current production is decreasing, the production is decreasing, the output is decreasing, but the prices are increasing by a greater proportion. So nominal GDP will still increase. So that means even with the decreasing production, the nominal GDP will increase. That's why it was said that it is not a good measure of economic growth in the country. Even when the production is decreasing, just because of inflation, just because of increase in prices, the nominal GDP is increasing. Now, there is the real GDP that is considered to be a better measure of economic growth, because here we are taking the base year prices, that is the prices of a previous year. So base year prices were previously 2011-2012 prices. So 2011-2012 prices, these prices were taken, the prices of 2011-2012, they were taken to calculate the real GDP. Now we multiply the current production of the current year with the base year prices, with the prices of 2011-2012. Okay, that's how we calculated the real GDP. Now it is said that the base year 2011-2012 is a very old year. Okay, that was the reference point previously. But now it has been said that we can have the new reference point, we can have the new base year, and for the GDP, the new base year is 2022-23. Any confusion? So this is the new base year. That is for the real GDP. Now we have the current production and we will take the base year prices, that is the prices of 2022-23. So this is the idea. Now why the base year has been changed? Economic change. So it can show the economic change, new sectors, the consumption patterns are changing, the structural changes are coming in the sectors, there are the different changes that are coming in the economy. So to represent that changes and to represent the newer era of the period, there are the new base years that have been brought forward. Global standards to align with the UN best practices, to align with the global standards. That's why the base year has also been changed. Better data. So we have the better data and we have the new form of data, like through the goods and services tax, through the e-Vahan, through the household consumption expenditure survey, PFMS, or labor force survey and such. So we have the new data which we can use with the new base years. Okay, with the new reference point. So this is the basic idea. We will also discuss about this IIP, but first let's discuss about the new base year for GDP. So why GDP base year has been revised to financial year 2022-23? So the year 2022-23 has been selected as the new base year as it represents the most recent normal period following the disruptions in 2019 to 2021. During this time period, there was the disruption that was caused by the COVID-19 and such. The years of 2019, 2020, 2020, 2021 were heavily impacted by COVID-19 pandemic, which temporarily distorted the consumption trends and industrial activity. Okay, so why GDP base year has been revised to financial year 2022-23? Basically because the previous years were more disruptive. They were having the turmoil, but now the 2022-23 it is considered the most recent normal period in the recent time. That's why this has been selected as the base year, because the base year or the reference point should be some normal standard period. Okay, now coming to the next point, GDP at current prices. So that means nominal GDP. It is calculated by taking the current production and multiplying the current production with the current prices. Okay, GDP at constant prices, that means real GDP, where we calculate the real GDP by taking the current production in the current year, multiplying it with the base year prices. Base year prices. Okay, base year prices are the prices of 2022-23 now, because this is the constant period, this is the base year period. So you can understand that GDP at constant prices. So from 2023-24 to 2024-25, here the GDP growth in 2023-24, the GDP growth was 7.2%. Okay, so the real GDP growth was 7.2% in 2023-24, while the real GDP growth in 2024-25 was 7.1%. The nominal GDP growth in 2023-24 was 11%, while the nominal GDP growth in 2024-25 was 9.7%. So this is the idea. The new data has been released as per the new base year. This is the base year. Now you can understand that this is the base year. That means this is the year. If we are considering the base year, the real GDP and the nominal GDP will be equal. Why? Because the current production is equal. Now the real GDP, the base year is 2022-23. Okay, so this is the base year prices. Here the nominal GDP, the current prices are what? The current prices are the prices of the current year, that is 2022-23 only. So in the base year, always remember that in the base year, the nominal GDP is equal to real GDP, because in the real GDP we have the current production multiplied by the base year prices, that are the prices of the 2022-23. Now for the same year, if we are calculating the nominal GDP, we are taking the current production multiplied by the current prices. Current prices are the prices of 2022-23. So current prices, base year prices are same, current production is same. So nominal GDP is equal to real GDP. So for base year, the nominal GDP and real GDP will be same. For the other years, you can understand that in the real GDP, we are comparing and we are calculating the current production. We are calculating the current production at base year prices. Any confusion here? Any confusion? Chalo. So this is the idea, that GDP at constant prices is basically the current production multiplied by the base year prices. Base year has been changed from 2011-2012 to 2022-23. Now, base year revision of national accounts. So MOSPI associates technical experts and representatives of central ministries and state or union territory directorates of economic and statistics with the compilation of national account statistics. So MOSPI, it associates with the technical experts, it associates with the representatives of the central ministries and state or union territory directorates of economic and statistics with the compilation. So MOSPI, in association with these, releases the compilation of the national account statistics. It releases the data for the GDP, GDP at current prices, GDP at constant prices and such. This is in the form of Advisory Committee on National Account Statistics, which is a permanent. So basically MOSPI associates with the technical experts and the representatives, and this is in the form of Advisory Committee on National Account Statistics, which is a permanent standing committee. So this advisory committee that advises the MOSPI, this is Advisory Committee on National Account Statistics. This is a permanent standing committee, and this is reconstituted from time to time. At present, the Advisory Committee on National Account Statistics, this is headed by Professor Bishwanath Goldar, and the role of the committee is to advise MOSPI And on the recommendation of the committee, base year has been changed from 2011-2012 to 2022-23. So remember that this advisory committee on national account statistics that advises the MOSPI, that consist of the technical experts, that consist of the representatives. Okay, so advisory committee on national account statistics, it consists of the technical experts, representatives from the state or union territory TReDS. So this advisory committee is currently headed by Professor Bishnath Goldar, and it recommended the base year change from 2011-2012 to 2022-23. So now coming to the last point, so we have discussed about the GDP new base year, we have discussed about the CPI new base year. Now coming to the IIP. So IIP is basically the index of industrial production. So when we calculate the index value, we are basically trying to see the, we are basically trying to compare, we are trying to compare the current year industrial production divided by the base year industrial production. Okay, so the index of the industrial production, here we are trying to see the changes or the improvement or the increase or decrease that has happened in the industrial production. Okay, so index of industrial production is defined as a summary measure that measures the changes in the volume of industrial production of the representative basket of industrial products. So here we are taking a basket of the industrial products and we are trying to see the change in the industrial production, the change in the production of these products, how much increase or how much decrease has happened of the production, okay, during a particular period with respect to a chosen base year. So basically base period, in this there was the industrial production, the volume of industrial production, and we are comparing the current period. Industrial production volume multiplied by 100. So index value of the industrial production, the index value for the industrial production, it is the current period industrial production volume divided by the base period industrial production volume. Okay, let's say in the base period the value was 100 and the current is 150. So you can understand that this is how we can see that what is the increase that has happened in the industrial production, or what is the valuation increase that is happening, or if there is an increase or decrease. The IIP for the base period is taken as 100 only, and that for the study period shows the percentage increase. So this is the basic idea that IIP, it is the index of industrial production that shows us the changes in the volume of industrial production in comparison to the chosen base year. That in comparison to the base year, how much is the change that has happened in the industrial production in the current period. So that is the IIP for which the new base year is 2022-23. Any confusion? Chalo. Now coming to the first question. The first question is in front of you. I hope you will be easily able to answer this question. So read the question and try to answer this question. With reference to the newly introduced CPI series, consider the following statements and you have to tell that which of the above statements are correct. Okay. The second question is in front of you. As per the CPI 2024 combined weights, which of the following divisions has the second highest weight after food and beverages? So after food and beverages, the second highest weight is provided to what category in 12 divisions? So in the 12 divisions, the second highest weight is provided to which category? So try to answer this question. Okay. So this is it. Thank you everyone. Thank you for joining the session. I hope you enjoyed the session. Okay, if there is any confusion, that you can write in the comment section below, but do try to give. Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session, in which we are going to discuss two very important articles of the Reserve Bank of India. The first one is regarding the Japan and India, which have signed the bilateral swap arrangement. Now, what is the limit of this bilateral swap arrangement? What is the meaning regarding this bilateral swap arrangement? How it happens? So all of this we are going to discuss in today's session. Okay. The second news article is regarding the RBI that has finalized the acquisition finance norms. So we'll discuss that what are the acquisition finance norms, as well as there are various data points that have been provided under this guidelines, so that we are going to discuss. Okay, so the data points are very important from the examination point of view, because the commercial banks, they are allowed to do the acquisition finance. So how the commercial banks and till what limit the commercial banks can do the acquisition finance, all of this we are going to discuss in today's session. As well as there is the discussion regarding the overseas syndicated deal, that also we are going to discuss. So today's session is going to be important, and I hope I'm clearly audible and the screen is visible. So give me a thumbs up if everything is fine. And good morning everyone. Good morning Ashutosh. Good morning Akshu. So welcome to the session everyone, and let's get started. Okay, so before starting with the session, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. Okay, so now we are going to start with the first news article, that is regarding the renewal of the bilateral swap arrangement between Japan and India. This is effective from February 28, 2026. So I hope, yes, so I'm clearly audible. Now let's start with the first news article, that is regarding your bilateral swap arrangement between India and Japan. Okay, so this is effective from February 28, 2026. So Bank of Japan acting as the agent for the Minister of Finance, Japan, and the Reserve Bank of India. So Bank of Japan and the Reserve Bank of India, they have signed the third amendment and restatement agreement of the bilateral swap arrangement. That means this bilateral swap arrangement between Japan and India, this is not something new. This has been going on since 2019. Okay, so this bilateral swap arrangement has been going on, but this has been renewed now. This has been renewed in 2026, and this renewed bilateral swap arrangement between Japan and India, this is effective from February 28, 2026. So what is this bilateral swap arrangement? First, let's understand this bilateral swap arrangement between India and Japan, then we will move forward with the other details. Okay, so through this example you can easily see bilateral swap arrangement between India and Japan. First of all, this is a financial agreement that helps both countries, support each other during financial stress. So the the bilateral swap arrangement, this is nothing else. This is an agreement that is signed between the India and Japan to support each other during financial stress. Now take an example, think about it, that if India is in a troublesome situation, if India is in a problematic situation where India requires dollars, immediate need of dollars is there. Okay, so if India requires dollars immediately, then this bilateral swap arrangement will come handy. Okay, so in this what will happen, that India and Japan having the bilateral swap arrangement, and India requires the dollars, let's say. So India will provide the rupees to Japan and Japan will provide the dollars to India. Okay, so this is the first leg of the arrangement, or this is the first leg of the transaction where the activation of swap is happening. India is saying that okay, we are in the financial stress and we require the dollars. So India will provide its rupees to Japan and Japan will provide the dollars to India. Now when the stable situation comes, now India is in the stable situation, so India, as the agreement ends, let's say after 3 months or after let's say 2 months, when the agreement ends, the India will take back its rupees and will give back the dollars with some interest to Japan. So I hope this is clear. So this is the idea, that if India is in the requirement, if India requires the dollars, then India, the Reserve Bank of India, can provide the rupees and can take the dollars. As we require the dollars, so we will take the dollars from Japan. Japan will provide us the dollars and in return we are giving them the rupees. Okay, now when the market stabilizes, the Reserve Bank of India is in, or the country is in the stable situation, the RBI will give back the dollars. RBI will give back the dollars with the interest, and we will take back our rupees. That is the idea. So this is like a emergency credit line. Line between India and Japan. Now if Japan is in the problematic situation, if Japan requires the dollars, then Japan will provide us the yen. So if, let's take the other example, if let's say Japan is in the problematic situation or Japan requires immediate dollars, Japan requires $10 billion. So Japan will provide its yen to India and India will provide the $10 billion to Japan. Okay, now when the stable situation comes, or after 3 months, when the agreement ends, when the bilateral swap arrangement ends, so after 3 months, let's say, Japan will return the dollars with some interest and we will give back the yen. Okay, Japan will return the dollars to India with interest, and we will give back the yen to Japan. So this is the bilateral swap arrangement, and this is a two-way arrangement. That means India or Japan, both of these countries can take the benefit of this arrangement. So I hope the basic idea of the swap is clear. So the Bank of Japan, acting as the agent of the Minister of Finance of Japan, and the Reserve Bank of India have signed the third amendment and restatement agreement of the bilateral swap arrangement. The bilateral swap arrangement is a two-way arrangement. That means both the countries can take the benefit of this bilateral swap arrangement, where both countries can swap their local currencies for the dollars. So if India requires the dollars, we can give our rupees to take dollars from Japan. We can give our rupees to take dollars from Japan. Okay, but after the agreement ends, or let's say after 3 months or after 2 months, whatever is the timeline, we will have to return the dollars to Japan with some interest, and the Japan will return our rupees to us. Okay, so this is the swap arrangement. First step is the activation of the swap, where we are taking the dollars. Okay, and the second step is settlement, where we are returning the dollars with the interest. So the bilateral swap arrangement is a two-way arrangement where both the countries can take the benefit of the bilateral swap arrangement. It's not only that India will take the benefit, Japan, if it requires, it can also take the benefit of this bilateral swap arrangement. Okay, where we can swap our local currencies in exchange of the dollars from the other country. The size of the BSA. Now this is important, that the size of the bilateral swap arrangement remains unchanged, that is up to $75 billion. So we can take up to $75 billion from Japan in the case of emergency, and Japan in the case of emergency can take $75 billion from India. Okay, so this is the bilateral swap arrangement, can be up to $75 billion. So now why this arrangement has been signed? By, like, now you have understood this already, that the arrangement must have been signed for the cooperation between the countries in case of financial stress. So Japan and India believe that the bilateral swap arrangement, which aims to strengthen and complement other financial safety nets. So India can go to International Monetary Fund, India can go to the multilateral institutions in case of requirement if it requires the dollars, but there is this Japan-India bilateral swap arrangement. This is the additional safety net that India now has, or this is the additional safety net that Japan now has. Okay, so in case of any financial stress of turmoil, India can take the help of Japan. India can use the bilateral swap arrangement. So this is the idea. So this is the additional financial safety net that India and Japan both now have. This will further deepen financial cooperation between the two countries and contribute to regional and global financial stability. So rather than only relying on the International Monetary Fund, rather than only relying on certain facilities, now we have this additional bilateral swap arrangement. So any confusion, anyone? Okay, very good question. Exchange rate. So exchange rate can be decided during the agreement. So let's say the agreement has been signed. This is the agreement. There is the agreement that has been signed, that India is taking the $10 billion from Japan and India is giving its rupees to Japan. Okay, now this agreement is, let's say, for 3 months. So it can be decided that the exchange rate will be followed for the dollars the same as right now. Okay, so the same exchange rate that is right now will continue till the end of the agreement that ends after 3 months. So I hope this is clear, that so the countries do not lose. So that's why the exchange rate can be decided, can be pre-decided when the agreement is being signed, that okay, for 3 months India is taking the $10 billion, and after 3 months India will return the $10 billion with the interest, with certain minimum interest rate, and Japan will return the rupees. So in this agreement, the exchange rate can be pre-decided, that okay, what is the exchange rate right now, that same exchange rate will continue. Okay, so this is the idea. Any other confusion? Interest rate will be in dollars. Chalo. So the agreement for bilateral swap arrangement between India and Japan, I told you that this agreement has been, this arrangement, bilateral swap arrangement, this has been renewed. This has been renewed. That means this is not a new arrangement that just started in 2026. No, not like that. So it may be recalled that the bilateral swap arrangement was negotiated between India and Japan during the visit of Prime Minister Shri Narendra Modi to Tokyo on 29th October 2018. Okay, so this discussion regarding the bilateral swap arrangement, it happened between the Prime Ministers of India and Japan, we can say, in 2018. This bilateral swap arrangement provides for India to access $75 billion, whereas the earlier bilateral swap arrangement had provided only $50 billion. Okay, the bilateral swap arrangement was approved by the Union Cabinet on 10th January 2019. So since 2019, you can understand, since 2019, the bilateral swap arrangement with the $75 billion is available to India and Japan, Okay, I hope this is clear. So this is not a new facility. This is not a new arrangement between India and Japan. This has been in effect since 2019, but it has been renewed in 2026, so that you have to remember, and the limit is $75 billion for the bilateral swap arrangement. I hope there is no confusion. Now moving forward to the next news article, that is regarding the RBI that has finalized the acquisition finance norms. So what is this acquisition finance? What are the data points? All of this we are going to discuss, and these norms are going to be in effect from April 1, 2026. Okay, so let's get started with the acquisition finance norms. But before that, we have to understand that what is acquisition finance. Then we will understand the acquisition finance framework. Okay, in the first news article, any confusion anyone has? In the first news article, any confusion? Anyone? Okay, now acquisition finance refers to a loan or financial assistance. So acquisition finance is basically a loan or the financial assistance the borrower is taking from the bank. Okay, so acquisition finance refers to a loan or financial assistance that is given to an eligible borrower. So here you can understand that a commercial bank, so it has been allowed that a commercial bank can provide the financial facility, can provide the loan to an eligible borrower entity. Now, who is the eligible borrower entity? That we will discuss in the coming slides. But basically, the commercial bank can provide the financial facility to a borrower entity that wants to acquire the target company. So this borrower company, it wants to acquire the target company. So basically, the commercial banks have been allowed to provide loan, to provide the finance to the borrower entity, to the acquiring company to acquire the target company, by purchasing the equity shares, by purchasing the shares of the company, or by purchasing the compulsory convertible debentures that convert into the shares. Okay, resulting in, if the acquiring company is taking the loan to buy the shares of the target company, to buy the compulsory convertible debentures that convert into shares of the target company. So basically, acquiring company is acquiring the shares, is taking the shares, buying the shares, the compulsory convertible debentures. So there is some control that is going in the hands of the acquiring company. So acquisition finance refers to a loan or financial assistance given to the eligible borrower entity for purchasing the equity shares, for purchasing the shares or compulsorily convertible debentures in a target company, so that there is some control that is taken by the acquiring company. Okay, there is some control that is coming in the hands of the acquiring company by purchasing the shares and the compulsory convertible debentures of the target company. Now, what is the objective of this kind of loan? What is the objective of this kind of acquisition finance? The objective is simple: by providing acquiring control over the target company. So if the borrower entity is taking the loan, there must be acquiring control that the borrower entity must have on the target company. So if the borrower entity is taking the loan from a commercial bank to acquire the target company, to buy the shares and compulsory convertible debentures of the target company, then the eligible borrower entity must have some acquiring control, must gain some acquiring control over the target company. Okay, so there must be some control. It's not like that the 100% of the company will be bought by the acquiring company, or it is not like that even 70% of the company will be bought by the acquiring company. No, maybe the acquiring company only has 26% of the control, but this is considered a substantial control. Even 51% of the control or 75% of the control is considered substantial control. So you can understand that the loan is being provided by a commercial bank to the borrower entity so that it can acquire a major control over the target company by buying the shares, by buying a major portion of the ownership, or by buying the compulsory convertible debentures in the target company. Any confusion? Yes, correct. So the basic idea is correct, that the acquisition finance is basically acquisition finance framework. It provides the conditions, it provides the norms, it provides the framework under which a company, the acquiring company, can acquire the target company by taking the loan from the commercial bank. Okay, so acquisition finance framework, it provides for the banks to provide the loan for the acquiring company to acquire the target company, and to acquire some control over the target company. This is the idea. So now, how you can acquire the control over the target company, how the acquiring company can acquire the control over the target company: by buying the shares of the target company or by buying the compulsory convertible debentures of the target company. Okay, so this is the basic idea. Now coming to the next point. Okay, just give me a second. Okay, acquisition finance may be extended by a commercial bank. So remember this, that acquisition finance is basically the loan or the financial assistance that is provided by the commercial bank to the borrower entity, to the eligible borrower entity. That is the acquiring company that wants to acquire the target company. Okay, so acquisition finance may be extended by a commercial bank. The loan can be given by a commercial bank to an Indian non-financial company for acquiring equity stakes, for acquiring the stakes, shares, control, ownership in domestic or foreign companies as strategic investments. That means that the investment or the acquiring company, if it is acquiring the shares of the target company, that should be for a long-term period. Those investments which are driven by the core objective of long-term investment. So acquisition finance can only be provided to the acquiring company. The acquisition finance can only be provided to the acquiring company to acquire the control over the target company for a long period of time. So this should be a long-term investment. It should not be a short-term restructuring. Okay, so this is the idea, that the investment which are driven by the core objective, the acquiring company taking control over the target company, should be for the long-term objective, for the long-term value for the acquirer, for the acquiring company, through potential synergies rather than mere financial restructuring for short-term gains. So this kind of control should not be only for the short-term gains. It should be for the long-term value. It should be for creating the long-term value and potential. Okay, so this is the idea. Now coming to the next point. So eligible entities, which are the eligible entities that can have the acquisition finance, that can take the acquisition finance from the commercial banks? So non-financial entities, we have discussed that the acquiring company being a non-financial company, can take the acquisition finance directly, or it can take the acquisition finance through its subsidiary, or it can take the acquisition finance through the special purpose vehicle. So the acquisition finance can be provided to the acquiring company directly. Let's say Tata Motors is acquiring XYZ company. Okay, so directly to the acquiring company, the loan can be provided, the acquisition finance can be provided. Or let's say Tata Motors is not taking the acquisition finance directly. There is some subsidiary of the Tata Motors, that is ABC is the subsidiary of the Tata Motors. Through this subsidiary, the acquisition finance is taken. Or the Tata Motors can have a special purpose vehicle. Special purpose vehicle is a special kind of subsidiary that is created for a special purpose. So a step down special purpose vehicle can be set up by the acquiring company for acquiring the target company, So acquisition finance did not compulsorily have to be taken by the acquiring company. The acquiring company can take the acquisition finance, but the subsidiary of the acquiring company can take the acquisition finance, or the special purpose vehicle that is created by the acquiring company can also take the acquisition finance to acquire the target company. I hope this is very much clear. Non-financial companies are basically that are in the automobile industry, that is not a bank, that is not a NBFC. So non-financial company is not a financial company, it is not a bank, it is not a NBFC and such. Okay, so non-financial companies are your clothing industries, clothing firms, your automobile industry, FMCG, all of this comes under the non-financial company. Okay, so acquiring company must be a non-financial company. The subsidiary special purpose vehicle, they must be non-financial subsidiary or special purpose vehicle. Okay, so acquisition finance can be taken directly by the acquiring company to acquire the target company, or acquisition finance can be taken by the subsidiary of the acquiring company to acquire the target company, or the special purpose vehicle can be created by the acquiring company to acquire the target company. Okay, so this special purpose vehicle can take the acquisition finance to acquire the target company on behalf of the acquiring company. That is the idea. Okay, because acquiring company do not want to change its own book value, and it does not want to change its own book accounts and such. So acquiring company creates a special purpose vehicle to take the acquisition finance to acquire the target company. So this is the idea. Now, coming to the next part, that is acquisition finance shall be subject to following conditions. And first we are starting with the financial criteria, that acquiring company must have certain basic financial criteria met. Okay, so that is the idea. So acquiring company, or where the acquisition is done through the special purpose vehicle or the subsidiary, so the acquiring company that is controlling such special purpose vehicle, or that is controlling the subsidiary, because as I have told you that the acquiring company can acquire the target company through a subsidiary or through a special purpose vehicle. So acquiring company must follow some financial criteria. The acquiring company must be completing some financial criteria. So acquiring company, or where the acquisition is through the subsidiary or the special purpose vehicle, the acquiring company controlling such SPV or subsidiary shall meet the financial criteria, shall meet these financial criteria. Now let's say the acquiring company is a listed entity that is listed on the stock exchanges, on the National Stock Exchange or the Bombay Stock Exchange. Okay, so Tata Motors, let's say it is a listed entity that is listed on the NSE or BSE. Okay, so for the listed entity, there should be some norms. So acquiring company that is borrowing, that is taking the acquisition finance, that is taking the loan, shall follow certain financial criteria. It should have the minimum net worth of 500 crores. It should have the minimum net worth of 500 crores, as well as the net profit after taxes. After deducting the taxes, the net profit reported in each of the previous 3 consecutive financial years. So in the previous 3 consecutive financial year, there should be net profit that the acquiring company is getting after taxes. So I hope this is clear, that the acquiring company that is taking the acquisition finance should follow these financial criteria. It should, if it is a listed entity, it should have a minimum net worth of 500 crores, as well as in the previous 3 consecutive financial year, it should have the net profit after taxes. Okay, that is the idea. Now remember that the acquisition finance can be taken by the acquiring company that is unlisted. It has not been listed, but there are certain norms that it has to follow. First of all, it should also have a minimum net worth of 500 crores, as well as it should also have the previous 3 consecutive financial year, it should have got the net profit after taxes. Okay, that means it should be a profitable entity that is acquiring the target company. So acquiring company that is unlisted will get the acquisition finance if it has the minimum net worth of 500 crores, as well as in the previous 3 consecutive financial years it has got the net profit after taxes, as well as there is another additional condition that it has to follow. The additional criteria for the unlisted entity is that the investment grade rating should be BBB minus or above from a credit rating agency. So this acquiring company that is unlisted should have got the rating of the investment grade rating of BBB minus or above from a credit rating agency. If there is no rating that is available for the acquiring company that is unlisted at the time of sanction of the acquisition finance, it shall be obtained. So rating has to be obtained before disbursing the acquisition finance, before disbursing the loan. So that is, I hope this is clear. Okay, of course, credit rating agency gives the rating, right? Credit rating agencies are the agencies that give these ratings. Chalo, now see, special purpose vehicle. So remember, special purpose vehicle. So let's say this is a acquiring company. Acquiring company has a subsidiary. Okay, like the Reliance Industries has the subsidiary Geo Financial that is engaged in the financial domain. Okay, now this acquiring company, now financial companies are not allowed here, so let's take some other example. Let's say acquiring company is Tata Group. Okay, now it has a subsidiary that is Tata Motors that is working in the domain of automobiles. Okay, or the Tata Group can through the subsidiary acquire the target company, or it can create a special purpose vehicle that is a separate entity that is created only for the purpose of acquiring the target company. So special purpose vehicles, they are a subsidiary of the acquiring company, but they have a special purpose. That's why they are known as the special purpose vehicle. So special purpose vehicle is nothing else. It is a subsidiary, step down subsidiary of the acquiring company, but it has a special purpose. It is only created for the purpose of acquiring the target company, while the original subsidiaries of a group, the original subsidiaries of a company, they have certain other functions also. Okay, so that is the idea. I hope this is clear. So acquiring company, if it is listed, it must have a minimum net worth of 500 crores and net profit after taxes for the 3 consecutive financial year. In the case of unlisted entity, the same rules will be followed, but one additional criteria is the investment grade rating of BBB minus or above. Okay. Now moving forward with the next conditions, that is coming to the control conditions. So control acquisition requirement. So acquisition shall result in the acquirer. So as we have discussed it in the starting only, that if the acquisition finance is provided to the acquiring company must gain some control over the target company. Okay. So acquisition finance, the acquisition shall result in the acquirer obtaining control of the target company through a single transaction. Now the acquiring company might be taking control of the target company through a single transaction. In one transaction, 5 lakh rupees has been given, or 5 crore rupees has been given, where a big chunk of control is taken from the target company. Or the series of interconnected transactions can happen, that 5 crore rupees is given in the first leg, 10 crore rupees is given in the second leg, and 30 crore rupees is given in the third leg. So a series of interconnected transactions can happen through which the acquiring company is taking control of the target company. But this kind of acquisition should be completed within 12 months from the date of execution of the acquisition agreement. That means if the acquisition agreement has been formed on 1st of January 2026, by the end of the 12 months, the acquisition should be completed. So the acquisition should be completed. The acquisition should be completed within 12 months of signing the agreement. That is the basic idea. Okay. So acquisition shall result in the acquirer obtaining control of the target company through a single transaction. The money can be given, or through a series of interconnected transactions, the control can be taken. But this kind of transaction should be completed within 12 months from the date of execution of the acquisition agreement. Okay. Now remember one thing. Let's say the acquiring company, that is Tata Motors, already have 10% of shares in the target company, okay, or 15% of the shares in the target company. This is a research and development company that is doing the research in the automobile industry. Okay. So now the acquiring company, that is Tata Motors, already has 10 to 15% of shares of the target company. That means it already has a good control, because 10 to 15% of shares in a company means a good control over that company, a good kind of rights or voting power in that company. So it already has some leverage, it already has some control over the target company. Now if it wants to increase the control, and the acquiring company is taking the acquisition finance to increase its control, to increase its acquisition of the target company, so it is allowed. That means acquisition finance is allowed for the acquiring company to increase its control in a target company, but there are certain guidelines that has to be followed. That means where the acquiring company already holds control over the target company, already has a good shares in the target company, acquisition finance may be extended. Acquisition finance can be given by the commercial bank only when the additional stakes are crossing a substantial threshold of 26% or 51% or 75% or 90%. That means if the acquiring company has 15% of the control in the target company, 15% of shares in the target company, so acquisition finance can only be provided to the acquiring company if it wants to increase its control to 26% or 51% or 75% or 90%. So that is the idea. Okay. So this is the basic idea. Any confusion here? So control, so where the acquiring company already holds control over the target company, has let's say 15% of shares in the target company, that means has a good chunk of control and power in the target company, has good chunk of voting power in the target company, acquisition finance can be provided by the commercial bank to the acquiring company to have more control over the target company when a substantial threshold is being crossed of 26% of the voting power, or 51% of the voting power, or 75% or 90% of the voting rights, so that there is enhanced governance or control rights that is given. Okay, so this is the idea. 26% of the shares basically of the voting power. I hope this is clear. Yes, 26%. See, 26% provides a veto power where the acquiring company, if the acquiring company has 26% of the voting power, it provides a veto to the company to block certain resolutions. 51% of the shares or 51% of voting power provides more power to the acquiring company. Okay, 75% of the voting power provides the power to the acquiring company to change the name of the company itself, to make major changes in the company. So you can understand that these are the substantial threshold: 26% of the shares, 26% of the ownership, 51% of the ownership, 75% of the ownership, or 90%. So if acquiring company had 10% of ownership, 10% of shares in the target company, if it wants to increase its control, acquisition finance can be provided if the control is being increased above 26% or 51% or 75% or 90%. That is the idea. Chalo, moving forward with the next point, that is related party restriction. Now, acquisition finance cannot be provided in case of related party transaction. Related party transaction means that in the same group, let's say Reliance Group or Reliance Industries want to have, Reliance Industries right now have 51% of the shares of Reliance Power. Now it wants to, Reliance Industry wants to have 75% of shares in the Reliance Power. So acquisition finance should be allowed because the control is increasing. But remember that there is a restriction that in the related parties, that is within the group itself, the acquisition finance cannot be provided, because within the group, if you are changing the control and such, that doesn't matter much, because you already have a lot of control, and within the group, if you are changing the structure, that is short-term restructuring that you are doing. You're just changing the board members, you're just within the group, you're just doing the basic changes. Okay, so this is internal restructuring that is happening. This is not benefiting the economy a lot. So that is the idea. So related party transactions or related party acquisition finance is not allowed. The acquiring company and the target company shall not be related parties. Where related party means that there are two conditions of the related parties. First is that the entities that have relationship, such as holding or subsidiary relationship, or associate companies. Reliance Industry or let's say Reliance Power, Reliance Telecom, they are associate companies, let's say. Okay, so in case the holding subsidiary relationship, associate companies relationship, a firm in which the director or the manager or its relative is a partner, so the Reliance Power has the director or the manager who are the relatives of the director or managers in the Reliance Telecom. So that means there is some kind of relationship that is already present in between the companies. Okay, common directors, Reliance Power and Reliance Telecom have common directors. Let's say key managerial personal relationship is there. Common key managerial personnel are there. CEO or CFO, or let's say the board of directors are common in the Reliance Power and Reliance Telecom. In this kind of situation where there is the related party, the acquisition finance cannot be provided. As well as related party also means that entities, if they are under the control, they are under the management, or they have the common promoter group, where whether indirectly or directly. So in this case also the acquisition finance cannot be provided. So the acquiring company and the target company, they shall not be related parties. They should not have the holding subsidiary relationship or associate companies relationship, or the common directors, common key managerial personnel. They should not have the common management or the common promoter group and such. So in this kind of situation, acquisition finance cannot be provided if there is some related party transaction that is happening. Acquisition finance cannot be provided. Okay, now coming to the next point, that is financing parameters. Okay, till now any confusion? So financial financing parameters, the credit assessment shall be conducted. The credit assessment shall be conducted on a consolidated basis. What does this mean? So banks evaluate the combined financial situation, okay, financial strength of the acquiring company and the target company. Because once the acquiring company has the control or has a major acquisition of the target company, you can understand that the acquiring company has 51% of the stakes in the target company, or the acquiring company has 75% of the stakes in the target company. So the target company financial strength also affect the financial situation of the acquiring company. So when the bank is evaluating that acquisition finance or the loan of 30 crore rupees should be given to the acquiring company or not. So in this case, when the acquisition finance or the loan is being provided, the bank has to evaluate the combined strength of the acquiring company and the target company, that once the acquiring company gain the shares of the target company, after that will the acquiring company be able to pay the debt comfortably or not. So that is the basic idea, that the bank should check whether the acquiring company, after taking the acquisition, will it have the same position to return the loan or not. Maybe after taking over the target company, the acquiring company will have a lot of different kind of debt situation. So acquiring company might go like for the short period of time, acquiring company might not be able to return the debt and such. So the bank has to evaluate the combined financial strength of the acquiring company and the target company, so that it can see that the acquiring company, after acquiring the target company, after taking over the control of the target company, will the acquiring company be able to return the debt or not. Okay. So credit assessment shall be conducted on a consolidated basis, incorporating the financial strength of both the acquiring and the target entities, and the bank has to see whether the acquiring company will be able to return the debt in a comfortable manner or not. Total bank financing. Now the acquisition finance. See, the acquiring company needs 30 crore rupees to acquire, or the acquiring company needs 100 crore rupees to acquire the target company. Out of this 100 crore rupees, acquisition finance can be maximum 75 crore rupees, that means 75%. So if the acquisition agreement is of 100 crores, the acquisition agreement is of 100 crores, through the 100 crores, the acquiring company can acquire 75% of control of the target company. So acquiring company wants to have 75% of control of the target company, and the acquisition agreement is of 100 crores. Now acquiring company can take the acquisition finance of maximum 75%. Okay. While see, if the acquiring company wants to take 51% of the control of the target company, then also acquisition finance is 75%. So acquisition finance, the total loan that can be provided is up to 75%, should not exceed 75% of the acquisition value. So that is the idea. Any confusion? So basically, the acquiring company, if it is acquiring 51% of stakes in the target company, that means it wants to have the major control of the target company, and the acquisition agreement is of 100 crores. The maximum acquisition finance that can be provided is up to 75%, that is 75 crores. The rest of the money, that is 25% of the money, that is 25 crores, should come from the own sources of the acquiring company. Okay, so 25% of the acquisition agreement money, 25% of the funds should come from the funds of the acquiring company. That is the idea. Okay. Now remember this, that if the listed company, if the acquiring company is a listed company, the valuation, and the target company is a listed company, so as independently assessed. Now acquisition value, how the acquisition value is decided, that the acquisition value is 100 crores, or the acquisition agreement is of 100 crores, and this is the correct value of the company, of the target company. So how this value is determined? So basically, the target company, if it is a listed company, the valuation of the target company shall be determined by one independent valuer to be appointed by the bank for valuing the shares which are not frequently traded. Because you can understand that the target company, if acquiring company has to acquire the target company, how the value of the target company is going to be decided? That if the acquiring company is having 51% of shares in the target company, if the acquiring company wants to have a major control of the target company and wants to buy major shares in the target company, so how the value of the target company is going to be decided? It can be decided on the basis of the share value in the market, in the market, right? But let's say that the shares of this target company are not frequently traded, and that's why the market price is not accurate for the target company. That's why in this case, for valuing the shares, if the shares are not frequently traded, in this case one independent valuer is appointed to value the target company, to value the shares of the target company. So this is the idea, okay? In the case of unlisted company, where the target company is not listed basically, so that means the share value is not decided on the basis of the market, the shares are not traded on the market, so its value is not determined on the market, on the NSE or BSE. So here, in the case of target company being the unlisted company, there should be the two independent valuers that has to be appointed by the bank for valuing the shares which are not traded at all in the market, because these are unlisted companies, so their shares are not traded in the market, okay? So this is the idea, that if the target is a listed company, its shares are not frequently traded. The target is a listed company, but its shares are not traded frequently in the stock exchanges. In this case, the acquisition value cannot be based simply on the market price. The bank must appoint one independent valuer so that the valuer can determine the fair value of the shares, and the bank can provide the loan on the basis of the fair value of the shares, okay? In the case of unlisted company, that is not traded on the stock exchanges, in this case two independent valuers have to be hired for the fair value of the shares to be identified. I hope this is clear. So this is the idea. Credit assessment shall be conducted on the consolidated basis, that after the acquiring company acquires a major control over the target company, the acquiring company, will it have the strength to pay back the debt that it has taken under the acquisition finance, okay? Total bank financing can be 75% of the acquisition value, and how the acquisition value will be decided on the basis of the valuation that is done by the one independent valuer or two independent valuer, depending upon the listed company or unlisted company, okay? So 75% of the acquisition value can be provided by the bank under the acquisition finance to the acquiring company, and the acquisition value is decided on the basis of the independent valuer in case the shares are not frequently traded, or in case the company is unlisted company, okay? Now coming to the next point, that 25%, 75% of the acquisition value can be provided by the commercial bank. So up to 75% of the acquisition value can be provided by the commercial bank to the acquiring company, but 25% of the acquisition value should come from the acquiring company itself, from its own fund. So acquiring company must contribute at least 25%, that is the remaining amount, or let's say the bank is only providing 60%. Because 75% is the maximum that the bank can provide of the acquisition value. So bank is not providing 75%, bank, let's say, is only providing 60%. So the rest 40% should come from the acquiring company own funds, okay? So acquiring company must contribute the remaining amount from its own fund, from the internal profit amount that it has, or the amount that it has, or from the fresh equity, that is by selling its own shares to get the money to acquire the target company, okay? This is the idea. So basically the bank can provide maximum up to 75% of the acquisition value to the acquiring company, and rest should come from the company itself. The bank can provide lower than the 75%. 75% is the maximum. So acquiring company must contribute the remaining amount from its own fund, from the internal accruals, from its own net profits that it has, or from the fresh equity that it is selling, okay? Next point is that the corporate guarantee from the acquiring bank has to be provided. What does this mean? So try to see this image. Let's take this example, and through that you will understand this point, okay? So acquiring company, let's say this is the XYZ company that wants to acquire the target company, that is the company B. So company A, let's say company A is the acquiring company, company B is the target company. So company A wants to acquire the target company, that is company B. So now it has been identified that 1000 crore is the acquisition value. 1000 crore is the acquisition value. This has been identified because the target company is not traded frequently. It is a listed company. But it is not traded frequently on the stock exchanges. So that's why there was how many valuers that were hired? One valuer has to be hired by the bank to identify the acquisition value, because in case of the listed entity in case of the listed target company. In case of the listed target company, the valuation has to be determined by one independent valuer appointed by the bank for valuing shares that are not frequently traded. So remember this, that in the case of company B, that is the target company, if it is listed on the stock exchanges but it is not traded frequently, so one independent valuer has to be hired by the bank to identify the acquisition value, okay. So now acquisition value has been identified to be 1000 crore. So 1000 crore is the acquisition value. What is the maximum that the bank can provide? The 75% of the acquisition value, this is the maximum that the bank can provide. So bank can provide maximum 750 crore loan, and the rest, that is 250 crore, should come from the acquiring company own funds. It can be the net profits that the acquiring company has, or by selling its equity it can get the 250 crores. Okay, now acquiring company is not acquiring the target company itself. It is acquiring the target company through a special purpose vehicle that is created for acquiring the target company. So I hope this is very much clear that the acquisition value is 1000 crore. The bank can provide the acquisition finance maximum of 75%, that is 750 crore. The acquiring company must have its own funds of at least 25%. Okay. Now, the acquiring company through the special purpose vehicle is acquiring the target company. In this case, the special purpose vehicle is a new subsidiary. It is just created for the purpose of acquiring the target company. It does not have its own major funds. It does not have its own major assets. It does not have a history. It is just created for acquiring the target company. So can the bank trust this special purpose vehicle? Blindly can we trust the special purpose vehicle? What if the special purpose vehicle is not able to give back the loan? Because the special purpose vehicle is acquiring the target company on behalf of the acquiring company, the special purpose vehicle is taking the loan, is taking the money to acquire the target company. But what if the special purpose vehicle says that, okay, I'm not able to pay back the loan. We do not have the funds to pay back the loan. And the special purpose vehicle is newly created. It does not even have the assets or history. So banks cannot trust the special purpose vehicle. So that's why a corporate guarantee has to be given from the acquiring company or its parent or the group holding entity. This shall be mandatory. Because we cannot trust a subsidiary of the acquiring company, we cannot trust the special purpose vehicle of the acquiring company. The acquiring company has to provide its own guarantee that if the special purpose vehicle fail to pay the loan, then the acquiring company and its asset will be used to pay the loan. I hope this is clear. Yes, correct. Guarantee has to be given from the parent company or from the acquiring company, major acquiring company. Okay, because its net worth that was looked upon, it was the profit that was of the acquiring company that was seen before giving the loan. So acquiring company should give the corporate guarantee. Okay, after the acquisition, debt to equity ratio of the acquiring company, consolidated balance sheet. Consolidated balance sheet means that after acquiring the target company, its consolidated balance sheet level shall not exceed 3:1. Okay, so this is the idea. Just a second. So basically, debt to equity. Debt, how much debt the company has taken, how much is the equity value of the company, basically debt to equity ratio. How much fund has been raised through the equity. So debt to equity ratio should not exceed 3:1. So if the debt is 100 crores or debt is 300 crores, equity value should be 100 crores. Okay, so that is the idea, that after the acquisition has been happened, after the acquiring company has acquired a major chunk of the target company, the consolidated balance sheet, in the consolidated balance sheet, the debt to equity ratio should not exceed 3:1 on a continuous basis. So debt to equity ratio should not exceed 3:1 of the acquiring company's consolidated balance sheet after doing the acquisition. I hope this is clear. I hope this is very much clear. Any confusion? Any confusion? Debt to equity. Debt, how much debt the company has taken, how much is... Any confusion, anyone? Now coming to the last few points, now coming to the bridge finance. Okay, while the acquiring company, if listed, the acquiring company, if it is listed, the acquiring company, if it is listed, may utilize bridge finance. Now, we have discussed that up to 75% of the acquisition value can be provided by the bank. 25% of the acquisition value has to be brought by the acquiring company from its own funds or by selling its own shares or by selling its own asset. Okay. Now, what if the acquiring company is saying that it does not have immediate funds to provide for the acquisition? Out of the 1000 crore, it has got 750 crores from the bank. Now 250 crores, the acquiring company is saying that, okay, for the acquisition of the target company, we don't have the immediate funds of 250 crores. So here comes the idea of the bridge finance. Bridge finance means the financing a borrower, providing loan to the borrower for an interim period, for a short period, not exceeding 1 year, for a legitimate business purpose. So this is a legitimate business purpose that the acquiring company wants to acquire the target company to expand its business, to expand its profitability and such. Okay, where the borrower has a firm plan. The borrower in this bridge finance, the borrower, that is the acquiring company here, should have a firm plan and capability to repay such loans by raising the financial resources. So what does this mean? This basically means that while the acquiring company, if listed, may utilize, if it is listed acquiring company, that means it is a established acquiring company, it can utilize bridge finance to satisfy the minimum own fund requirement of 25%. Acquisition finance in such cases shall be subject to these conditions. Clear repayment plan there should be. There should be a clear repayment plan. If the bridge finance has been taken for the 25%, that should have come from your own funds. So if a bridge finance, that is a short-term loan, is taken for this 25%, so a clear repayment plan should be there. There must be a clear source to repay the bridge loan, such as issuing the new shares in 2 months, 3 months. So it has to be notified that in the coming 3 months, 10%, 5%, and 3%. In this manner, the shares will be released for the public. Okay, and this must happen within 12 months. Within 12 months, there should be the repayment of the bridge loan. So this is the idea that the acquiring company, if it does not have 25% of the acquisition value immediately to acquire the target company, it can utilize the bridge finance. It can utilize the bridge finance, that is for a period of up to 1 year. 12 months. Within 12 months, the loan has to be repaid. Okay. Now, for taking the bridge finance, the clear repayment plan should be there. There must be a clear source to repay the bridge loan, issuing new shares. So the plan has to be shown that in what manner the new shares will be issued of the acquiring company to get the money to repay the bridge loan or selling the assets. This must happen within 12 months because bridge finance can be up to 1 year only. If a bank provides the bridge loan, it must be secured with the collateral. It must be secured with some additional collateral. Now, think about it. The bank is providing acquisition finance to the acquiring company up to 75%. So there is some collateral that is given by the acquiring company to the bank for providing the acquisition finance for providing the loan. So bank is providing loan to the acquiring company to acquire the target company, So the collateral is given by the acquiring company to the bank. So should the same collateral be used for the bridge finance? Should the same collateral be used for the bridge finance? No, right? So bank has to get a new collateral for the bridge loan. Okay, so if a bank provides the bridge loan, it must be secured with collateral. And remember that the bridge finance should not result in decrease or dilution of security coverage under the acquisition finance. Under the acquisition finance, the collateral shall not be diluted. The collateral shall not be used that is gone for the acquisition finance. That is the idea. Okay, I hope this is clear. So now we have discussed that the bridge finance can be provided, that has to be returned in 12 months. There should be a clear plan for repayment. Now, acquisition finance shall be, yes, debt to equity ratio is basically the debt of the company in its book divided by the equity of the shareholders, the equity or the share value that has been raised. Okay, that is the debt to equity ratio that we have to see for the acquiring company's consolidated balance sheet after it has done the acquisition. Now, acquisition finance shall be secured by the acquisition. Now, security. For the acquisition finance, what should be the security? So, basically, think about it that the loan is given to the acquiring company to acquire the shares that is the ownership in the target company. Acquire the shares or compulsory convertible debentures that convert into shares in the target company. So these equity shares or these compulsorily convertible debentures that is bought through the loan, they should be collateral that has to be kept with the bank, okay, as well as additional collateral also has to be provided by the acquiring company. So acquiring company, if it is taking loans to buy the shares, those same shares will be collateral, as well as additional collateral also has to be provided by the acquiring company. So acquisition finance shall be secured by the acquired equity shares or compulsorily convertible debentures of the target company. So the same shares, the same compulsory convertible debentures will become the collateral for the acquisition finance. Other assets also has to be provided by the acquirer, by the acquiring company or the target company. The asset has to be provided to the bank, okay. It can be any other additional asset that is provided as collateral. Now acquisition finance undertaken by overseas. Now we have the Union Bank, we have the Union Bank, we have the Punjab National Bank, we have the multiple banks in India. We have the Bank of India. Let's say they have foreign branches, they have overseas branches, okay. So acquisition finance undertaken by the overseas branches of Indian banks as part of syndication. So basically, acquisition finance can also be undertaken by overseas branches of Indian banks. That is, foreign branches of Indian banks can also do the acquisition finance as part of syndication arrangement, as part of syndicate arrangement. In the syndicate arrangement, there are a group of lenders that are coming together to provide the loan to a company, and a single agreement is formed, a credit agreement is formed where the company has to return the money of the lenders, okay. In this agreement, all the terms and conditions are written. So syndication agreement or syndication arrangement, it is basically the group of lenders, they are jointly lending to a company or to a single borrower under a shared agreement, So this is the idea. The syndication arrangement, group of lenders, they are lending to a single borrower under a single arrangement, okay. So acquisition finance undertaken by overseas branches of Indian banks as part of syndication arrangement shall not be subject to the directions that we have discussed above. So the limits and the directions will not be applied. The funding contribution by the overseas branch of the Indian bank should be limited to 20%, okay. Should be limited to 20%, then the above guidelines will not follow for the acquisition finance undertaken by the overseas branches of the Indian bank. So this is the idea. Acquisition finance can be undertaken by the overseas branches of the Indian bank as part of the syndication arrangement where there are a group of lenders. In this kind of acquisition finance by the overseas branches of the Indian bank, the funding contribution by the Indian overseas branch should not increase 20%. Of the total funding under the deal. Of the total funding under the deal, Indian overseas bank branch can only provide 20% in the syndication arrangement. I hope this is clear. Now coming to the last part, that is summary. Any confusion? No, Akshu, that is a guarantee is only a guarantee. It is not considered a collateral, okay. Collateral is different. Collateral is your shares or compulsory convertible debentures or your asset that you have, your building, factory that you have, okay. That is some physical asset or financial asset, okay. That is collateral. Guarantee is just a guarantee that the company has to give, that if the loan is not paid back by the special purpose vehicle, if the loan is not paid back by the subsidiary, then the guarantee will be used of the acquiring company, okay. That is the idea. I hope this is clear. Now acquisition financing by banks, commercial banks, banks participation in overseas syndicated acquisition finance is allowed, but it is capped at 20%. In the draft norms, it was said that this will be capped at 10%, but in the final directions, it has been said that 20% is the limit of the acquisition finance that can be given by the overseas bank branch of India in the syndication deal, okay, in the syndication deal. So this is the idea. Now so in the acquisition finance deal, that is happening in the foreign, that is acquisition finance deal, the overseas Indian bank branch can provide up to 20% in the syndicate arrangement, in the syndicate acquisition financing. Okay, acquisition financing allowed only for strategic long-term investment, not for the short-term restructuring, and the related party transactions are also not allowed. The related party acquisition is also not allowed under the acquisition finance. So basically the banks, like related party acquisition can happen, but the banks, they cannot provide the acquisition finance for the related party acquisition. Okay, so banks cannot provide the acquisition finance. The banks cannot provide the acquisition finance for the related party acquisition. So this is the restriction of the related party. Okay, so acquisition financing allowed only for the strategic long-term investment, and the acquisition financing is not allowed for the related party acquisition. Banks must frame a board-approved policy. Bank funding is capped at 75% of the acquisition value, while the acquirer company should have its own funds of 25%. And in this case, if there is a listed target company, one valuer should be there, one independent valuer hired by the bank should be there to identify the acquisition value if the shares are not traded much of the listed company. Okay, if there is an unlisted trading company that is not listed, that does not have the market value of the shares, it is not listed, it is not traded on the stock exchanges, so in this case the bank must hire two independent valuers that will value and that will identify the acquisition value. Okay, loans must be secured by the acquired shares or the convertible debentures with additional collateral permitted. Additional collateral can also be taken by the bank from the acquiring company. Bridge financing allowed for equity contribution with repayment within 12 months. So bridge finance is allowed for the self part, and 12 months is the timeline in which the return has to be done. Norms effective April 1, 2026. Existing loans allowed till maturity. Post-acquisition debt to equity ratio should not increase to 3 to 1. 3 to 1. Okay, so it should not increase 3 to 1. So this is the idea. Borrowers must meet 500 crore net worth criteria. Now, coming to this, so see, the acquisition finance norms or the acquisition finance framework, this is part of the detailed framework that is released by the Reserve Bank of India under the Reserve Bank of India Commercial Banks Credit Facilities Amendment Direction 2026. Okay, so this is the idea that the RBI has released the Reserve Bank of India Commercial Bank Credit Facility Amendment Direction 2026. In this, there are three different criterias or three different norms that have been released. So under this, the RBI has released loan against eligible securities, lending to capital market intermediaries, and acquisition finance norms that is allowed for the commercial banks. So this loans against eligible securities by the commercial bank, lending to capital market intermediaries by the commercial bank, this we have discussed in a previous session. Now we have also completed the acquisition finance norms that is a part of the broader guidelines. Okay, the above amendments, all these amendments, they shall come into force from 1st April 2026 or an earlier date as adopted by the bank. Okay, now coming to the first question, I hope you will be easily able to answer this question. If there is any confusion, kindly ask me. Chalo, thank you everyone. Thank you for joining. This is the first question. I hope you will be easily able to answer the question. Do answer the question in the comment section below, and whoever gives the right answer, I will reply in the comment that okay, this is the right answer. Okay, now this is the second question. I hope you will be easily able to answer this question also. So do try to answer this question. Okay, so this is your second question where you have to inform that regarding the RBI guidelines on acquisition finance, consider the following statements and which of the statements given above is or are incorrect. That is the question. So this is it. Thank you everyone. Thank you for joining the session. I hope you enjoyed the session. I hope you got the points. If there is any confusion, you can ask in the comment section below. Do give the right answer of the homework question. See you in the next session. Thank you everyone. Welcome to EduTap and welcome to today's Finance 360-degree session. In today's session, we are going to discuss three very important news articles, The first one is regarding the AI tool that has been deployed by the SEBI, that is Sudaran. Okay, so SEBI has removed the Finfluencer post, and we will discuss about the deployment of the AI tool Sudaran. The next news article is regarding Sri Lanka's first blue bond, and it has become the first blue bond on the NSE International Exchange in the IFSC. So we will discuss about the blue bond, that what are the blue bonds, how they help the aquatic life, how they help the ocean system and such, as well as we will discuss that what is this dually listed blue bond. Okay, so how this blue bond has got dually listed, there is the MOU that has happened between the stock exchanges in India and Sri Lanka. So this we are going to discuss that what is this MOU that has been signed, and this is very important for you to understand. Okay, the third news article is regarding the RBI that has released certain guidelines for the NUCFDC, and now the NUCFDC will be allowed to privately place the shares with over 200 subscribers. So what does this mean? All of this we are going to discuss in today's session, and all these news articles are important for your understanding perspective as well as from the factual perspective they are important. Okay, you need to understand about the blue bond, the blue economy, the blue projects and such, as well as you need to understand about the dually listed shares or the dually listed financial instruments that are going to be allowed with this MOU between the stock exchanges. Okay, so let's get started with today's session. But first of all, give me a thumbs up if I'm clearly audible and the screen is visible. Okay, so I hope everything is fine. Chalo. So let's get started, and good morning Avnish. Good morning everyone. So first of all, before starting with the session, do subscribe to the YouTube channel of EduTap so you continue getting the relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. Okay, there you will get the PDF within 24 hours. Chalo. Now starting with the first news article, so SEBI has removed more than 1.2 lakh misleading social media posts by unregistered financial influencers that are also known as Finfluencers. Okay, so what has happened in the recent time, you must have seen various posts, various videos, shorts that were providing the advice that okay, you should invest in these particular shares, you should invest in these particular bonds, or you should invest in these in the instruments of some particular companies. Okay, now there are various videos, there are various shorts that are coming up on YouTube or Instagram or various platforms that are providing you the advice, that are making claims that okay, these shares are the best shares, you should invest in this kind of mutual fund, you should invest in these kind of financial instruments in the financial market. Now many of these financial influencers or many of these people that are making the videos, they are not registered with SEBI. So they are providing the advice just on their own understanding basis, or they are getting some sponsorship due to which they are providing such kind of advice that can be harmful for the regular investors. Because if we trust such videos that okay, this video has got lakhs of views, so some of the investors, some of the people thinking that okay, this must be a trustworthy video, they invest in such shares, they invest in such mutual fund, or they invest in the future and options market that can be harmful for the investors. Okay, that can lead to the losses to the retail investors. So basically SEBI has removed more than 1.2 lakh misleading social media posts that were doing false claims or that were providing certain advice without getting registered with the SEBI. So by unregistered financial influencers, and the SEBI is leveraging the artificial intelligence tools to track violations in the digital space, as said by the chairman Tuhin Kanta Pandey. Okay, so this is the idea that SEBI has removed more than 1.2 lakh misleading social media posts. Now SEBI regulations clearly mandate that investment advice can only be given by registered entities. So it is only the registered investment advisors or registered research analysts that can provide the investment advice, that can provide such kind of advice that where you should invest, in which shares you should invest, in which financial instruments you should invest. So this kind of advice can be provided by the registered entities like the registered investment advisor or registered research analyst. Okay, so this is the idea that after you get the registration or after you get the SEBI permission, then only you should be able to advise the people. Then you are responsible also, as well as then you have the knowledge of the market, then only you are getting the registered feature. Okay, so that is the idea. Now, to strengthen oversight, SEBI has deployed an in-house artificial intelligence system named Sudaran. So this is the in-house artificial intelligence system named Sudaran. This tool scans large volumes of audio, video and text content on a multilingual basis across digital platforms to identify the patterns of unregistered advisory activity and false claims. So basically SEBI has started using the in-house artificial intelligence named Sudaran. Okay, now this artificial intelligence tool, it scans large volumes of audio, video and text content on a multilingual basis on different digital platforms to identify the patterns of unregistered advices that are being provided and the false claims that are being made. Okay. Now, the AI framework is designed to proactively flag suspicious narratives rather than relying solely on complaints. Let's say various investors, they invested in future and option market on the advice of some video content or some audio content or some text content. Some post has been some community post has been given in YouTube by a big Finfluencer, by a big financial influencer, that you should invest in this particular segment, futures and options, okay, in this particular derivative segment. So now many of the investors have invested. As you know that SEBI always says that the retail investors, 9 out of 10 retail investors are making losses. So investors are ignoring these kind of warnings that 9 out of 10 investors are making losses in the future and option market. So the retail investors should not invest in the future and option market. But just seeing some video content, audio content or text content, the investor will feel that okay, I can make huge profits in the future and option market, ignoring the warning of the SEBI. And after the investor has invested the money, then the investors realize that okay, we are making losses, we are making huge losses. Okay, then the investors can make the complaints to the SEBI that okay, we got the advice from this particular video, we got the advice from this particular audio, and we have made the investment that has come up with huge losses. Now this kind of complaints, SEBI will hear to these kind of complaints, SEBI will take actions, will remove such videos or audio. So this is the removal of the audio video on the basis of the complaints. Now what this Sudaran is going to do, what this AI tool Sudaran is going to do is proactively flag suspicious narratives that are being provided through the video, audio, text without any complaints being raised. On the proactive basis, these kind of videos, audios will be removed. Okay, so you can understand that the proactive measure is being taken. So this is the summary. So basically AI Sudaran, SEBI's digital guardian. So AI Sudaran, this is the tool that is the SEBI's digital guardian. Now you can understand that this Sudaran name has been taken from the Sudarshan Chakra, we can say. Now this is the advanced surveillance of India's financial content ecosystem. Okay, so AI Sudaran, this is the advanced surveillance that is happening on the digital platforms to root out or to take out such certain videos and audio or the text content that is providing false claims or that is providing false narratives. Now there is the multilingual scanner that is present on the multilingual basis in the audio, video or text format. If there is any false narrative, that will be removed. Detects false claims, it detects the narratives and it focuses on the narratives, that how the videos and the audios, they are focusing on or they are providing the false claims or they are leading to the advice without being registered. Okay, so the narrative focus, it curbs the hyped up narratives promoting risky trading. Okay, so through the AI Sudarshan, such videos, such audios will be targeted that are providing the false advice. Calibrated intervention. See, it has been said very clearly that there is the freedom of speech, there is the freedom of expression. So yes, you can make videos on the financial education, on the financial literacy, you can promote the financial education, but you should not provide any particular advice on the particular investment on shares or financial instruments, because that can only be done by the registered investment advisors or the registered research analyst. So there is calibrated intervention. The education, the financial education, financial literacy, if the channels are spreading that is good, because the channels are trying to promote the financial literacy and financial education. But there is a thin line between the financial education and the advice that is being given by unregistered financial influencers. So the line should not be crossed. If you are giving the financial education, financial literacy, your post, your video, your audio will not be removed. But if you are giving the advice without being registered, then that will be removed. Okay, real-time monitoring is being done under the AI Sudarshan, and there is the target to the Finfluencers, there is the target to the financial influencers. Okay, so that is the idea. Now coming to the second news article, that is Sri Lanka's first blue bond dually listed on NSE International Exchange at Gift City. So first of all, what has happened, that there is the first blue bond that has been admitted for trading within India's International Financial Service Center. Now anyone that has any idea that where do we have the IFSC? In India, where do we have the IFSC? We have the International Financial Service Center. Only one IFSC we have in Gift City. That is Gujarat International Finance Tech City. So India only has one IFSC, that is in the Gift City, that is in Gujarat. Okay, now for the first time, a blue bond has been admitted for trading in the IFSC, in the NSE International Exchange. So NSE International Exchange, this is the subsidiary of the National Stock Exchange. So NSE International Exchange, this is the subsidiary of the National Stock Exchange, and this NSE International Exchange, this is present in the IFSC. So the blue bond, this is admitted for trading in the NSE International Exchange in the IFSC, and it has become the first blue bond to be admitted for trading within India's IFSC. What is blue bond? So blue bond is basically, a bond that is the financial instrument, that is a debt instrument that raises the fund from the investors. Okay, from multiple investors, the money is being raised. From multiple investors, the money is being raised, and this money, because this is a blue bond, so the money is being raised from multiple investors in the market, and then this money will be invested in the blue economy, in the blue projects. Now, what are the blue projects? That we will discuss. But basically, blue bond is a debt instrument that is raising the funds, that is raising the money from the investors, and this money will be invested in the blue projects. Now, investors will get certain returns, that is, they will get the interest rate, as well as you can understand that these investors that are investing in the blue bond, they are the aware. They have the awareness, they are environmentally aware investors, and they want to make the environmental impact. That's why they are investing in the blue bond. That's why they are investing in such kind of bonds that are investing in the blue projects, that are investing in the ocean ecosystem and such. Okay, so blue bonds, they are the debt instruments. So blue bonds, they are the financial instrument, they are the debt instrument through which the money is raised from the investors to invest this money in the blue projects. Now, why do investors invest in these kind of blue bonds? Because first of all, the investment is happening in the blue projects, in the blue economy, so that there can be sustainable use of the ocean resources. There is sustainable use of the ocean resources. Okay, and the investors in return, they also get the interest, as well as the investors are able to make the environmental impact. So this is the idea. Okay, now let's understand more about the blue economy so that you have the clarity. So according to World Bank, see, blue economy or the blue bonds, these kind of terminologies are important because there have been questions on sustainable development, there have been questions on the green bond and such. Now you have to understand about the blue bond. According to World Bank, the blue economy is the sustainable use of ocean resources. So blue economy is the sustainable use of ocean resources for economic growth. So see, ocean has a lot of resources. It has the marine resources, it has the fishes, it has the tidal waves and such that can create the renewable energy. So basically there are various ocean resources that we need to use, as well as ocean through the international waters. There is the transportation that takes place from one country to another. Okay, so this is the idea that the ocean resources are very much important for the transportation, for the creation of the, or for the generation of the renewable energy, for the fishery and such. So ocean resources, we cannot ignore it. We have to use the ocean resources, but the ocean resources should be utilized in such a manner that we are not losing these resources. Okay, and the future generations, they are able to use these resources. Okay, so blue economy, according to World Bank, the blue economy is the sustainable use of ocean resources for economic growth, improved livelihood and jobs, while preserving the health of ocean ecosystem so that the future generations also can use these ocean resources. Okay, so basically sustainable development means that the current generation should use the resources, and should utilize the resources while keeping in mind that the future generations, we have to leave the resources for the future generations also. Okay, so sustainable development basically says that, okay, you have to use the resources, but use the resources in a sustainable manner so that we are able to leave the resources for the future generation also. So blue economy focuses on sustainable use of ocean resources. Ocean resources are important for fisheries, aquaculture, renewable ocean energy, marine transport and logistics, sustainable tourism in the ocean. Like many of the countries, they depend on the beaches and they depend on the ocean for their whole economy. Okay, marine biotechnology and research, drug discovery, genetic resources, innovation and science. So through the ocean, there are various genetic resources that we are able to find, that we are able to use in the medicines and such. Ocean knowledge and conservation. So basically the blue economy is harnessing the ocean resources for the economy, for the job creation, for the livelihoods. So that is the idea. Okay, so I hope blue economy is clear. Blue economy is the sustainable use of ocean resources for economic growth, improved livelihood and jobs while preserving the health of the ocean ecosystem. Now eligible blue projects are basically sustainable fisheries and aquaculture. Fishery, the people are doing the fishery, the people are doing the aquaculture, so that is fine. But the fishing should be done in such a manner that it is sustainable, that we are not creating some problem in the ecosystem of the ocean. Okay, so sustainable, there should be fishing and the aquaculture that should be in a sustainable manner so that the species are able to survive and we are not making the species endangered or extinct. Okay, reducing the ocean plastic and pollution. So eligible blue projects also include trash collector, waste management, reducing the ocean and plastic pollution, decarbonized marine transport. Marine transport is important, we cannot stop it because many of the countries are connected through the oceans. Okay, so marine transport is important, but it should be decarbonized. Okay, we have to use the eco-friendly ship and green port. Offshore renewable ocean energy. So ocean energy is also used to create the renewable energy, wind turbines, tidal devices and such. Sustainable tourism. So again, many of the countries, they depend on the tourism, the economy is dependent on the tourist and such. Okay, so tourism should be continued, but it should be in a sustainable manner. Marine ecosystem restoration and conservation. So all of these are the eligible blue projects. So through the blue bond, the money is raised from the investors and this money is invested in the blue projects. Blue projects are those projects that are linked to the blue economy. Okay, that are linked to the sustainable use of ocean resources, and these are some of the eligible blue projects. So blue bonds, basically they collect the money from the investors to invest the money in the blue projects, and the investors in return, they get certain interest rate as well as they are able to make the environmental impact. So Sri Lanka's first ever blue bond is worth 3 billion Sri Lankan rupees. Okay, issuance by DFCC Bank. So DFCC Bank is the one that has issued this first ever blue bond of Sri Lanka that has been dually listed. Now what is the meaning of dual listing? So dual listing has been facilitated under a MOU between NSE International Exchange and the Colombo Stock Exchange. So basically Colombo Stock Exchange and the NSE International Exchange, they have entered into strategic partnership, they have entered into the MOU. So Colombo Stock Exchange and NSE IFSC Limited, that is NSE International Exchange we can say, or NSE IFSC Limited, an international multi-asset exchange, wholly owned subsidiary of the NSE, they have signed the MOU. So NSE IFSC Limited and the CSC, they have signed a MOU, the Memorandum of Understanding, recently to strengthen the capital market cooperation between Sri Lanka and India. Now under this arrangement, what is happening? Under this arrangement, both institutions will work towards introducing dual listings and cross listings. Dual listing and cross listing basically mean that it enables the companies to list the same shares on both exchanges simultaneously or to establish a presence on both markets through separate listings. So you can understand that the same shares or the same bonds can be listed on the Colombo Stock Exchange, and the same shares and the same bonds can also be listed on the NSE IFSC exchange. So this is the idea. This is the meaning of the dual listing. So as per the MOU between the CSE and the NSE IFSC Limited, as per the MOU, the dual listing has been allowed. So the same bonds that are listed on the CSE, the same bonds are allowed to be listed on the NSE International Exchange or the NSE IFSC. So I hope this is clear. Yes. So the dual listing has been facilitated under the MOU between the NSE International Exchange or the NSE IFSC and the Colombo Stock Exchange, which aimed at strengthening the cross-border capital market collaboration, enabling dual listings or cross listings, which enable companies to list the same shares, the same financial instruments on both exchanges simultaneously, or to establish a presence on both markets through separate listings. So dual listings and cross listing, they offer listed companies a greater opportunity. See, basically, if you are able to list your shares, if you are able to list your financial instruments in the Colombo Stock Exchange, as well as you are able to list your shares, you are able to list your financial instrument in the national stock, in the NSE International Exchange or in the NSE IFSC. So you can understand that you have the wider access to the investors, and you can raise the money from the Sri Lankan investors, as well as you can raise the money in the IFSC in India, where there are multiple investors, where there are investors from different countries. So you can understand that dual listing and cross listing, it provides the listed companies a greater opportunity to increase liquidity through a broader and more diverse investor base, and you can raise the money from various investors or different kind of investors. So this is the idea. So it has been allowed, the dual listing has been allowed between NSE IFSC or NSE International Exchange and the Colombo Stock Exchange. So this is the idea. Now, so coming to the next point, and Colombo Stock Exchange operates the only stock market in Sri Lanka. The CSE is licensed by Securities and Exchange Commission of Sri Lanka. Now, primarily listed. Now this blue bond, the Sri Lanka's first blue bond, this has been introduced by DFCC Bank of Sri Lanka. So this blue bond has been introduced by, this bond has been launched by the DFCC Bank. Okay, so it is primarily listed on the Colombo Stock Exchange. The bonds admission, now it was listed on the Colombo Stock Exchange, and now it has been admitted, it has been allowed on the NSE IFSC Limited or NSE International Exchange also. This expands its international visibility, because it is not only listed in the Sri Lanka, but it is also listed in the IFSC now. Okay, it helped diversify the investor base by enabling the participation through the GIFT Cities network or through the GIFT Cities regulatory framework, as well as remember that the International Financial Service Center, it has easier economic rules and regulations. Okay, so the IFSC, the Indian IFSC as well as the IFSC in different countries, they have easier rules and regulations, they have easier economic norms. Okay, they have regulatory framework that is easier, while in reinforcing. So basically the primarily listed the blue bonds launched by the DFCC Bank or released by the DFCC Bank, it was primarily listed on the Colombo Stock Exchange, and now they have also got listed in the NSE International Exchange or NSE IFSC. Now, DFCC Bank in November 2025 introduced the blue bonds to finance the sustainable use of marine resources, aquatic pollution control, promotion of related sustainable economic activities, while offering an attractive return to the investors. So basically, the blue bond is going to raise the money from the investors and will provide the interest to the investors, and this money that is raised from the investors is going to be invested in the blue projects such as the sustainable use of marine resources, aquatic pollution control, promotion of related sustainable economic activities through the ocean. Blue bonds channel proceeds or the money that is collected by the blue bond that is used toward marine conservation, sustainable fisheries, ocean-based economic activity, and broader water-related environmental projects. So this is the whole idea that we have discussed. So basically, Sri Lanka's first ever blue bond, it is worth 3 billion Sri Lankan rupees. Okay, that is usually tagged as LKR, Sri Lankan rupees. So that is the idea. Sri Lanka's first ever blue bond has been launched by the DFCC Bank. This is worth 3 billion Sri Lankan rupees. This has been dually listed on the NSE International Exchange, on the NSE IFSC Limited at the GIFT City, as well as this is also introduced, or this was first launched in CSE. CSE and the NSE International Exchange have done a MOU. Okay, so this is the idea. Now this is dually listed, so I hope you know that dual listing basically means it is listed in NSE International Exchange as well as Colombo Stock Exchange, but it was primarily listed on the Colombo Stock Exchange, then it got admitted in the NSE International Exchange. And who has released this particular bond? So DFCC Bank. Now coming to the next news article, any confusion anyone has in this particular article? Coming to the last news article, Reserve Bank of India, Non-Banking Financial Companies Miscellaneous Amendment Directions 2026. So basically RBI has brought a major amendment that we have to understand. So NUCFDC can make offer or invitation to subscribe to its equity, to its shares on a private placement basis. So we will understand that why this kind of amendment had to be brought first. Okay, so first let's understand about the NUCFDC, then we will understand about the amendment that has been brought. So National Urban Cooperative Finance and Development Corporation Limited, this is an umbrella organization. This is the umbrella organization for the urban cooperative banks in India. So NUCFDC has been set up with a specific purpose to function as an umbrella organization to provide a place to the urban cooperative banks to come together and to raise their concerns or to get the funds that they require and such. So NUCFDC has been set up with a specific purpose to function as an umbrella organization for primary urban cooperative banks with an overarching mandate to strengthen the UCB sector by providing various kinds of fund-based support and non-fund-based services to its member UCBs. Now NUCFDC, how it can get the members. So a urban cooperative bank, if it wants to become the member of the corporation, it basically has to invest in the shares of the NUCFDC. So the member UCBs, the member urban cooperative banks, they can become the member, or a urban cooperative bank can become a member if it gets the shares, if it buys the shares of the corporation. I hope this is clear. So who can become the member of the NUCFDC? Only the urban cooperative banks can become the member of the NUCFDC. How they can become the member? By buying the shares of the NUCFDC. So major shareholders of the corporation are the urban cooperative banks only. Okay, so NUCFDC is the umbrella organization for primary urban cooperative banks with an overarching mandate to strengthen the UCB sector by providing various kind of services to the urban cooperative banks that are the member of the corporation. Now, to achieve its objective, it is necessary that the corporation grants membership to all 1400 plus urban cooperative banks as early as possible. That means all the urban cooperative banks, 1400 plus urban cooperative banks, should be the member of this corporation. How they can become the member of the corporation? By buying the shares of the corporation. Okay, that's why it has been said. See, before the statutory provisions or the legal provisions, the statutory provisions of the Companies Act 2013 read with Companies Prospectus and Allotment of Securities Rules 2014, it limit the private placement offered to 200 persons in aggregate in a financial year. So basically it means that private placement offer is limited. Private placement means selling the securities to a pre-selected number of institutions or individuals rather than publicly in the open market. So private placement basically means that you have the gym membership. You have the gym membership. If you have the gym membership, then only you can enter the gym. If you do not have the membership, you cannot enter the gym. Similarly, private placement of securities basically means that if you are under the pre-selected, there are pre-selected investors. If you are in this pre-selected group of investors, then you can buy the shares or then you can invest in the securities in the private placement. So private placement basically means selling the securities to a pre-selected group of investors. Okay. Now, as you know that in this corporation, the urban cooperative banks can invest. It is the urban cooperative banks that can buy the shares of the corporation to get the membership of the corporation. So urban cooperative banks have to buy the shares of the corporation to get the membership of the corporation. Now it is said that in a financial year, there are only 200 persons, that is 200 entities that can buy the shares under the private placement offer. So if the corporation is giving the private placement offer, if the corporation is giving the private placement offer of its shares to the pre-selected group of the urban cooperative bank, you can understand that in a year it can only raise the funds, or it can only provide its shares to 200 companies, to 200 urban cooperative banks, while the urban cooperative banks are 1400 plus in number. So it will take nearly 7 to 8 years for the corporation to get all the urban cooperative banks as its members. So it can take a lot of time. That's why it was creating certain problem. So NUCFDC, first of all, this corporation, it is the umbrella organization for the primary urban cooperative banks. So it can, the primary urban cooperative banks, if they want to become the member of the corporation, they need to buy the shares of the corporation. Okay, they need to have some interest in the corporation, so they need to buy the shares of the corporation. Now the NUCFDC, as it is selling its shares to the urban cooperative banks majorly, or to the cooperative development corporations majorly, so NUCFDC, it is selling its shares majorly to the urban cooperative banks. It cannot sell its shares to the retail investors or to the other investors. Okay, so as it is selling its shares to the urban cooperative banks, it is doing the private placement offer. That is, through the private placement, it is selling its shares to the pre-selected group, that is the urban cooperative banks. So through the private placement offer, the corporation is selling its shares to the urban cooperative banks. Now under the private placement, the shares could be sold. So the statutory provisions, it limit the private placement offer to 200 persons in aggregate in a financial year. That means in a year, only from 200 urban cooperative banks the money can be raised and the share can be sold to only 200 urban cooperative banks in a year. So to make 1400 UCBs your member, it will take a lot of time. That's why the RBI has made certain changes. So the restriction would constrain. Now this restriction, this particular restriction, that in the private placement offer, when you are privately placing the shares, when you are privately selling the shares to only a certain group, when you are privately selling the shares to only a particular group, you are limited to offer the shares to only 200 persons or 200 entities in aggregate in a financial year. So this restriction would constrain the corporation from granting membership to all urban cooperative banks in a faster manner. It will take a lot of years, 7 to 8 years it will take to provide the membership to all the urban cooperative banks, so it became a problem. Now it has been said that the above rules, they shall not be applicable to NBFCs. The above rules, they are not applicable to the NBFCs which are registered with the Reserve Bank of India under the RBI Act of 1934 if they comply with the regulations made by the Reserve Bank of India in respect of offering or inviting the private placement, the group of the investors for the private placement. So basically the NBFCs that are registered under the Reserve Bank of India under the RBI Act of 1934, and these NBFCs, they are following the rules set by the Reserve Bank of India for the private placement. So these kind of NBFCs will not have to follow the other rules. So basically NUCFDC, this is a NBFC that is registered under the Reserve Bank of India. So RBI can make certain rules for the private placement done by the NUCFDC of its shares. So it will not have to follow the previous rules. Okay, it will not have to follow the Companies Act 2013 rules. This is the idea. So now, therefore, in exercise of the powers conferred by the Section 45L of the RBI Act and all the powers enabling it in this regard, RBI being satisfied that it is important in the public interest, the RBI has released these directions, which is stating that NUCFDC may make offer or invite the different urban cooperative banks, or it can invite the investors to subscribe to its shares on a private placement basis to more than 200 persons in aggregate in a financial year. So this kind of restriction of 200 persons has been removed for the NUCFDC. So usually under the private placement, if you are selling your shares to a particular pre-selected group of entities or individuals, so basically you were limited to 200 persons in a financial year. You can only raise the funds, or you can only sell the shares to 200 persons in the financial year. But now, as per the RBI regulation, or as per the RBI amendment, the NUCFDC particularly, if it is doing the private placement of its shares and it is selling the shares to the urban cooperative banks, or it is selling the shares to the pre-selected group, then it can raise funds, it can sell the shares to more than 200 persons in a financial year. I hope this is clear. Any confusion? So now there are certain restrictions or there are certain conditions that has to be followed, that the offer or invitation for the private placement of the shares under these guidelines shall only be made to UCBs and the National Cooperative Development Corporation. That means if the private placement of the shares is being done by the NUCFDC and the NUCFDC is selling the shares to a pre-selected group, then and the more than 200 persons, the private placement of the shares is happening to more than 200 persons, then in this case the funds can only be raised and the share can only be sold to the urban cooperative banks and the NCDC. So this is the idea. So private placement of shares can only happen to the urban cooperative banks and to the NCDC. Okay. So offer or invitation for the private placement of shares under these guidelines shall only be made to UCBs and NCDC. NUCFDC, that is the corporation, shall not extend any loan or advance or any kind of financial accommodation against the security of its own shares. That means the corporation against its own shares cannot provide any kind of loans or advances. As well as proceeds of the share capital raised, the money that has been raised from the sale of the shares shall be used for the purposes consistent with the mandate of the corporation as approved by the Reserve Bank of India. So whatever money has been raised by selling the shares to the urban cooperative banks and to the NCDC, so whatever money has been raised, that should only be used for certain purposes as approved by the Reserve Bank of India. The corporation shall submit a quarterly statement containing the amount of equity that has been raised, that means the shares that has been sold and the money that has been raised, the number and category of subscribers, how many subscribers have subscribed to the shares, 300, 400 and such, subscription amount, how much money has been raised basically during the quarter as well as cumulatively till now. To Department of Regulation, Reserve Bank of India Central Office within 15 days from the close of the quarter. So quarterly report has to be sent to the Reserve Bank of India Department of Regulation and the quarterly report should be within 15 days of the end of the quarter. This is the idea. So basically the private placement offer of the shares was limited to 200%. So you can offer your shares in the private placement to a pre-selected group. You can offer your shares, but it was limited to 200 persons only or 200 entities. You can offer your shares to only 200 entities in a financial year under the private placement. This kind of restriction has been removed for the NUCFDC. NUCFDC can do the private placement of shares and can sell the shares in the privately placed market to a pre-selected group of more than 200 entities in a financial year. Okay, but the NUCFDC can only sell its shares in the private placement to the UCBs and the NCDC. NCDC is basically a statutory organization under the Ministry of Corporation, Government of India. This was established in 1963 with the objective of promoting, strengthening and developing the farmer cooperatives and such. So this is a major change that has happened, as the NUCFDC may make offer or invite to subscribe to its shares on a private placement basis to more than 200% in aggregate in a financial year. The direction above shall remain in force from the date of issue. That means this is immediately applicable, as well as this will be applicable till March 31st, 2029. Okay, so this will be applicable till 2029. This is the idea. Now we are done with the articles, the 3 articles. Coming to the first question, this you have to answer, that which country has released the first ever blue bond of 3 billion. This is issued by the DFCC Bank. This has been dually listed on the NSE International Exchange and the Colombo Stock Exchange. Now this is the first blue bond to be admitted for trading within India's IFSC. So this is the first question that you have to answer. The second question is in front of you. This is the multi-statement based question from the NUCFDC. So you have to tell that which of the statements given below is or are correct. So there are the 3 statements. So do tell that which of the statements given above are correct. Okay, is or are correct. So this is it for today. Thank you everyone. Thank you for joining the session. I hope you enjoyed the session. If there is any confusion, do write in the comment section below. So this is it for today. Thank you everyone. Welcome to today's Finance 360-degree session in which we are going to discuss a very important notification of the Reserve Bank of India. So RBI has released different notifications for the commercial banks, for the small finance bank, for the regional rural banks, local area banks and the payment bank. So all these notifications are regarding the declaration of dividend. Okay, so today we will discuss that how the different banks are allowed to declare their dividends, what are the limits that have been imposed by the Reserve Bank of India, what are the criteria, what is the criteria that is given for the different banks. So all of this we are going to discuss in this video, where I will provide you the important points as well as I will provide you the idea that how you can remember the table, how you can remember the important points. Okay, there is logic behind the table, there is logic behind all the points. So once you understand the logic, you will be easily able to understand and remember from the examination point of view. So this notification is very important from the examination perspective that we are going to discuss in today's session. Okay, so in March 2026, the RBI has released a notification regarding the declaration of dividend and the remittance of profits for the commercial banks, as well as declaration of dividend by the small finance banks, regional rural banks, local area banks and the payment bank. All of this we are going to discuss in today's session in the easy terms. So give me a thumbs up if I'm clearly audible and the screen is visible, and the different percentages have been mentioned in the notification that we will be discussing, and this is very important from the phase 1 as well as from the phase 2 perspective of the RBI Grade B 2026 examination. So let's get started. But before that, do subscribe to the YouTube channel of EduTap so that you continue getting these relevant videos, as well as to join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is given in the description box below. Okay. So now RBI commercial banks. First we will discuss the directions from the commercial banks perspective, then we will move forward with the other banks and the direction that has been given for the other banks. Okay, so RBI has released multiple notifications. Okay, RBI has released different notifications for the commercial banks, for the small finance banks, for the regional rural banks, for the local area banks and for the payment bank in regards to the declaration of dividend. So first we are going to discuss the perspective from the commercial banks side, and once we understand the regulations from the perspective of the commercial banks, it will be very easy for you to understand for the other banks also. Okay, so let's get started. The RBI has released the RBI commercial banks Prudential norms on declaration of dividend and remittance of profits directions 2026. So first of all, RBI had previously also issued rules for banks about how they can declare the dividends to shareholders. First of all, I hope you know that the profit, a company, let's say a company is making the profit, how the profit is going to be distributed, in what areas the profit is going to be distributed. So there are three main areas where the profit is distributed. Okay, first of all, from the profit, the corporate profit tax has to be paid, or the tax has to be paid. Okay, after paying the tax, let's say the profit is 100 and 30 rupees has been paid as the corporate profit tax or as the tax, then whatever is left, 70 rupees is left now. From this, the company will keep some retained earnings. The company will keep some retained earnings, that is also known as undistributed profits. Undistributed profit. Why the company is keeping with itself the retained earnings or the undistributed profit? For the further expansion of the company, or for handling the distress situation in the future, or for maintenance of the funding, or for maintenance of its expenses. Okay, so basically the company keeps some of the profit as retained earnings, as the undistributed profit, so that the company can handle the distress situation, so that the company can handle the expenses in the future operations, as well as if the company wants to do the expansion in the future, the company also keeps some retained earnings for that. So let's say the company is keeping 40 rupees as the retained earnings with itself. The rest of the money, that is now 30 rupees is left. Now this is given in the form of dividend to the shareholders. Okay, so this is the idea. So the dividend is given to the shareholders. Shareholders are the ones that own the shares, so they must be given some part of the profit, so that is dividend. So I hope you know that broadly the profit in the economic sense is divided into three parts. The corporate profit tax, first tax has to be paid, then the company keeps some retained earnings, the company keeps some undistributed profits. After that, whatever is left is given in the form of dividend to the shareholders. Now remember that the RBI is at the apex, top of the monetary system. if the banks give too much of the dividend to its shareholders, then the bank will not have enough of the retained earnings. The bank will not have enough of the money left with itself to maintain its expenses or to handle the distress situation. So RBI is saying that there are certain rules that the banks have to follow, so that they are not giving too much of the dividend, so that the banks are keeping some retained earnings to handle the distress in the future or to maintain its operations in the future. I hope this is very much clear that in a year, if a bank is earning the profit, the bank should not give too much of the dividend, that the bank do not have enough of the retained earnings to maintain its expenses in the future or to handle the distress situation. The bank should be keeping enough of the retained earnings. The bank should be keeping enough of the money in the form of capital with itself to handle the situation in the future. So this is the broad idea. So RBI previously had issued the rules for banks about how they can declare the dividends to shareholders, how much dividends they can issue to the shareholders. And foreign banks having branches in India, they can send the profits to their head office in the foreign country, but they also have to follow certain rules. Okay, so basically the banks in India, how much dividend they can provide to the shareholders, there are certain rules regarding that given by the RBI, as well as the foreign banks that have the branches in India, they can send the profits to their head office abroad, but they also have to follow certain rules. Now RBI has now repealed the 2025 rules governing the dividend declaration by the commercial banks and replace them with the new rules. So now the 2025 earlier rules have been repealed, they have been cancelled out basically, and the new rules have been brought forward by the Reserve Bank of India. Now these new rules are effective from financial year 2026-27, that is from the 1st April 2026. These new rules are going to be applied for the new financial year. Okay, so the RBI has now repealed the earlier rules governing the dividend declaration and the remittance of the profits. Now the new rules have been brought by the Reserve Bank of India. These are the RBI Commercial Banks Prudential Norms on Declaration of Dividend and Remittance of Profits Directions 2026. These are the new rules that are effective from financial year 2026-27. Now these directions shall be applicable to all the banking companies, corresponding new banks, State Bank of India and foreign banks that have branches in India, excluding small finance banks, local area banks, payment bank and regional rural banks. As I have told you that for these categories of banks, there are separate notifications that RBI has brought. Okay, so right now the directions that we are studying are from the perspective of the commercial banks and the foreign banks having branches in India. Okay, now coming to before starting with the directions, before starting with the data point, first you have to understand certain terminologies. Once you understand the terminologies, everything will become easier. Okay, so first of all, what is profit after tax? So profit after tax, the PAT is the profit after tax. Let's say this is the total revenue of a company. The total revenue of the company is 200 crores, let's say 200 crores. Okay, from the total revenue, deduct the total cost of producing the goods. Okay, cost of the goods. So you will get the total profit, that is also known as gross profit in finance or accounts terms. Okay, so total revenue, whatever is the total revenue, deduct the total cost, you have the total profit or the gross profit. Now from the gross profit, deduct the operational expenses of the company. Okay, so from the gross profit, deduct the selling cost like the marketing expenses, general and administrative expenses. So deduct the operating expenses of the company. Then from the gross profit, you are getting to the earning before taxes and interest. So you have got the earning before the, so total profit was total revenue minus total cost. Then from the total profit or from the gross profit, you have deducted the operational expenses. You have come to the earning before interest and tax. Now from the earning before interest and tax, deduct the interest expenses. That has to be like the interest that has to be given on the debt that the company has taken. So now you have earnings before tax because you have deducted the interest. So now this is the earnings before paying the tax, or this is the profit before paying the tax. Now once you have paid the tax, from the earning before the tax, deduct the tax, okay, tax payment, and then you have the profit after tax or the earnings after tax. Earnings after tax is the net income or the net profit of the company that is left with the company. So from the revenue, deduct the cost. From the gross profit that you have got, deduct the operational expenses. From the earnings before taxes and interest, deduct the interest expenses. Then you have earnings before taxes. So deduct the taxes, all the payments. When the company has made all the payments, then you are left with profit after tax. So from the profit after tax, this is the profit from which the tax has been paid. This is the profit from which the tax has been paid. All the expenses have been paid. Okay. So now whatever is left should be going for the retained earnings, that is undistributed profit. From this profit after tax, the company will keep the retained earnings, undistributed profit, and the rest will be given in the form of dividend to the shareholders. That is the basic idea. Okay. That is the basic idea. So now there is something called adjusted profit after tax. What is the adjusted profit after tax? So the RBI has given the definition for the adjusted profit after tax. Adjusted profit after tax is nothing else. It is the profit after tax for a financial year in which the dividend has to be given, because from the profit after tax, after paying the tax, then whatever is left is kept in the form of retained earnings or the undistributed profits, and the rest is given in the form of dividend to the shareholders. So from the profit after tax, the dividend has to be paid to the shareholders. Okay. So from the profit after tax in a financial year, the dividend has to be paid. Now from the profit after tax, deduct the 50% of the net NPA. Net NPA is what? Net NPA is equal to gross NPA minus the provisions that the bank already has to cover the NPAs. Okay. So if the gross NPAs are, let's say 80, the provisions that the bank has is 50. Let's say out of the 80 crores of the gross NPAs, the bank already has the provisions. The bank already has the provisions of 60 crore. So net NPA is of 20 crores. Okay. So the adjusted profit after tax is profit after tax minus the 50% of the adjusted profit after tax is nothing else. It is the profit after tax minus the 50% of the net NPA. Okay, net NPA is the net non-performing asset, the net non-performing asset. If the net non-performing asset is 20 crores, so 50% of 20 crores is 10 crores. Okay, so whatever is the profit after tax minus the 50% of net NPA. So that is adjusted profit after tax. So now after discussing the terminologies, is there any confusion in the terminologies? So this is the idea. Now moving forward with the directions. So profit after tax is basically the profit from which the tax has already been paid. So after tax, whatever is the profit, from that the retained earnings will be kept by the company itself to handle the distress situation using the money, or to maintain its expenses in the future, while the rest will be given in the form of dividend to the shareholders. So from the profit after tax, the company keeps the retained earnings or the undistributed profits. Chalo. Now why declaring? Now board oversight and eligibility criteria for providing the dividend. As we have discussed that the company, that is the bank here, can provide the dividend. So there is board oversight while declaring the dividend or while sending the profit outside. So while declaring the dividend by the commercial bank in India, or while remitting the profit by the foreign bank that has branch in India. So if the foreign bank that has branch in India is remitting the profit from India to abroad, so the board of directors shall consider the current and projected capital position of the bank against the applicable regulatory requirement, against the applicable minimum regulatory requirement. So basically the board of directors has to consider that what is the current capital that the bank is having, what is the future capital that the bank is having. If the bank has enough of the capital with itself against the minimum capital requirement, then it is fine to declare the dividend, then it is good to remit the profit. But if the company do not have a good capital position in the current perspective or from the future perspective, if the board of directors think that okay, the bank does not have good capital position against the minimum requirements, then the board of directors have to decide that the dividend will not be shared Okay, so this is the idea. So basically, while declaring the dividend or while remitting the profits outside, the board of directors shall consider the current and the future capital position of the bank. The bank should have a good capital position, then only the dividend can be provided to the shareholders. Applicable capital buffers. The bank should also be maintaining applicable capital buffers. Okay, there is the capital conservation buffer. I hope you know that against the risk-weighted assets, the bank has to maintain the capital, because the loans, they have different kind of, the loans are the asset for the bank which is earning interest for the bank. So against the different loans, there is a different risk weight. Some loans have more risk, some loans has less risk. So against these risk weighted assets, against these loans or the assets of the bank that has risk weight, the bank has to maintain certain capital to handle the distress situation. If the distress come, to handle the distress situation, the bank has to maintain the capital with itself. So bank should have enough of the capital with itself in the current period. For the future also, good capital the bank should be holding, then only the bank can declare the profit. The bank should also have the capital buffers, additional capital buffers, other than maintaining the CRAR, that is the capital to risk weighted asset ratio. Other than maintaining the capital to risk weighted asset ratio of 9%, this is the minimum requirement. Okay, for the scheduled commercial banks, against the risk weighted asset, against the risk weighted loans, the bank has to maintain the capital of 9%. This is the capital to risk weighted asset ratio. Okay, the bank has to maintain minimum of 9% of capital against the risk weighted asset. Other than this CRAR, there is the capital conservation buffer of 2.5% that the bank has to maintain. So bank has to maintain the additional buffers for capital of 2.5%. So bank should also have applicable regulatory capital buffers, and the bank should also have adequate provisions, because as I have told you that the net NPA is what? It is gross NPA minus the provision. So bank should also have enough of the provisions to handle its NPAs, okay, to handle its NPAs. Taking into account the economic environment, the bank's long-term growth plans, so bank should be holding, because from the profit after tax, bank should be holding the retained profits or the undistributed profits for its future operations, for its future expansion also. After seeing how much money the bank requires, then only the dividend should be shared with the shareholders. Auditor's report of the financial statement, so the bank should have a good financial condition also. So this is the basic idea. Now, eligibility criteria, board overview, board oversight we have seen. Now coming to the eligibility criteria, a bank shall meet the following prudential requirements to be eligible to declare profits, to be eligible to declare dividends or remit profits. So if the bank want to declare the dividends and provide the dividends to the shareholders or remit the profit to its own country, basically they have to follow these conditions. Bank complied with regulatory capital requirement, as I have told you that the scheduled commercial banks, they have the minimum CRAR requirement of 9%. That means against the risk-weighted assets, against the risk-weighted loans, the bank has to maintain the capital of 9%. Okay, as well as there is the capital conservation buffer. Additional buffers that the bank has to maintain is 2.5%. So bank complied with regulatory capital requirement at the end of the previous financial year. In the previous financial year also, the bank was maintaining good capital buffers, as well as the bank had the CRAR, as well as continue being compliant in the current financial year in which the bank is declaring the dividend. So in the previous financial year also, in the current financial year also, the bank should have enough of the CRAR, the bank should be meeting the minimum requirements, and the bank should have enough of the buffers also. After paying the dividend, the bank must still meet the minimum capital requirement. So after the dividend has been paid from the profit after tax, the dividend, when the dividend has been paid to the shareholders, after that also the bank should have the CRAR, the minimum CRAR and the capital conservation buffer. That means if the bank has paid the dividend, the bank cannot say that now we do not have the money in the capital buffers, now we do not have the money in the capital requirement. So bank cannot say so. Bank should have the minimum requirement met. Okay, the bank incorporated in India shall have positive adjusted PAT. So adjusted profit after tax, as I have told you, adjusted profit after tax is profit after tax minus the 50% of net NPA. So the bank that is incorporated in India, that is the Scheduled Commercial Bank of India, should have a positive adjusted profit after tax, then only it will be allowed to provide the dividend to its shareholders. Okay, that is the idea. Now, a foreign bank operating in India through the branch mode, so a foreign bank having a branch in India shall have a positive profit after tax. So in the requirement of the foreign bank having branch in India, they do not need to have the positive adjusted profit after tax. They just need to have the positive profit after tax. Then they can remit the profits to their head office. Okay, the bank is not subject. So the foreign bank having a branch in India or the Scheduled Commercial Bank of India, they should not have any restriction from RBI or other authorities on declaring dividend or emitting profit. So if the bank is following all these conditions, then the bank can declare the dividend or the bank can remit the profit. Okay, this is the idea. Any confusion? Chalo, moving forward of the quantum of dividend. Now we have understood the board oversight, the eligibility criteria. Moving forward with the quantum of dividend payable by banks incorporated in India. That means how much dividend can be paid by a bank incorporated in India, or how much dividend can be paid basically. Okay. So first of all, the dividend can be paid on the basis of common equity tier 1 ratio. Now first of all, I hope you know that the CRAR. Now the CRAR is how much for the scheduled commercial banks? The CRAR for the scheduled commercial banks is 9%. This is the minimum requirement by the Reserve Bank of India, that the scheduled commercial bank should be holding the capital against the risk-weighted assets of 9%. So banks should have the capital of 9% against the risk-weighted assets. Okay. So this is the CRAR requirement. This is the capital requirement. Now the capital can be held by the bank in the tier 1 capital form or tier 2. Okay. So the capital can be tier 1 capital or tier 2 capital. So the capital to risk-weighted asset ratio that the banks have to hold can be in the form of tier 1 capital or tier 2 capital. Okay, tier 1 capital is the common equity tier 1 capital. See, tier 1 capital is the liquid capital that the banks can use during the time of distress. Okay, this is the go-to capital that the bank can use during the time of distress. Whenever there is distressful situation, the bank can use this kind of capital. Now, tier 1 capital consists of common equity tier 1 capital and additional tier 1 capital. Common equity tier 1 capital, this is the most liquid capital that the bank has. This in the common equity tier 1 capital, like out of the profit after tax, the bank is keeping the retained earnings or the undistributed profit. So this retained earnings or the undistributed profit, they go under the common equity tier 1 capital. So this is the most liquid capital that the bank has, because the bank has the liquid money. Okay, so you can understand common equity tier 1 is the most liquid capital. Tier 2 capital is like a capital that the bank has, the assets that the bank has in the physical form, or the tier 2 capital is not so liquid. CRAR requirement is 9%. This is the minimum requirement for the scheduled commercial banks. Out of this, the tier 1 requirement is 7% and tier 2 is 2%. Okay, so basically CRAR of 9%, tier 1 should have 7% at least, tier 2 2%. Okay, common equity tier 1 capital 5.5%. Additional tier 1 capital is 1.5%. These are the requirements. Okay, so tier 1 capital should have minimum of 7%. Tier 1 capital should be minimum of 7% of risk-weighted assets. Out of this, 5.5% is common equity tier 1 capital. Now, other than this 9% of the CRAR, you can understand that the capital conservation buffer is 2.5%. Okay, this is all static. I'm giving you the understanding so that you can understand the table and you can remember the table. Capital conservation buffer is 2.5%. That is the additional buffers that the bank has to maintain. Now, these additional buffers that the bank has to maintain is in what form? In the form of tier 2 capital or tier 1 capital? In the form of common equity tier 1 capital or additional tier 1 capital? Anyone knows that the capital conservation buffer, if the bank is maintaining the capital conservation buffer, that should be in the form of common equity tier 1 capital. That means in the common equity tier 1 capital, the bank has to maintain additional 2.5% of capital. Okay, so in total 8% is the common equity tier 1 capital that the banks have to maintain. So basically CRAR requirement is 9%. under the capital against the risk weighted asset, tier 1 capital should be 7%, minimum 7%, and tier 2 capital is the left out 2%. Okay, in the tier 1 capital, there is the common equity tier 1 capital, that is the most liquid capital, that should be 5.5%, minimum of 5.5%. Rest 81 capital, additional tier 1 capital can be 1.5%. The bank also has to maintain additional capital conservation buffer that should be in the form of common equity tier 1 capital. So the bank has to maintain additional capital conservation buffer of 2.5% in the form of common equity tier 1 capital. So in total, how much of the common equity tier 1 capital the scheduled commercial banks have to maintain, adding the capital conservation buffer of 8%. So if the bank has less than 8%, if the bank has less than 8% of common equity tier 1 capital, should the bank be allowed to provide the dividend? If the bank has less than 8%, if the bank has less than 8% of the common equity tier 1 capital, that means the bank do not have enough of the liquid capital as per the minimum requirement. Common equity tier 1 capital with the capital conservation buffer should be 8%. So common equity tier 1 capital should be 8% as per the minimum requirement. So if the bank does not have 8% of common equity tier 1 capital, that means the bank does not have enough of the liquid capital. That means the bank cannot give dividend. This is the basic idea. This is the basic idea. I hope this is clear now. If this is clear, that means the whole article is clear. It will be very easy for you to understand the other paragraphs now, the other ideas now. Okay, so if the bank has up to 8% of the common equity tier 1 capital, that means the bank should not be allowed to give the dividend because the bank does not have enough of the liquid capital. But if the bank has above 8% of the common equity tier 1 capital, that is the most liquid capital that the bank has, or up to 10%, then the bank should be allowed to give 20% of the dividend from its adjusted profit after tax, from its adjusted profit after tax. Okay, here you can see till the bucket 5 by 2%, by 2% the bracket is increasing. After bucket 5 by 1% the bracket is increasing, that's it. And 20% is the difference in the, like, initially 10% is the 10% is the increase in dividend. Got it? So now it is easy for you to understand the table. I hope it is easy for you to remember the table also, because if we are talking about the commercial banks, they have to maintain the common equity tier 1 capital of 8%. 5.5% generally, and including the capital conservation buffer of 2.5%. So 8% is the minimum requirement of the common equity tier 1 capital. If the banks have up to 8% only, that means they can only they cannot provide any dividend. But if they have more than 8%, up to 10%, they can provide 20% of the dividend, 10% to 12%, 30% of the dividend, and so on and so forth. Till the bracket 5, the percentage is increasing by 2%. After the bracket 5, the percentage is increasing only by 1%. What is this Z now? What is this Z now? Have you heard about domestic systemically important banks? Have you heard about domestic systemically important banks? I hope all of you have heard about domestic systemically important banks. They are too big to fail banks. And which banks are under the category of domestic systemically important banks? The State Bank of India, the HDFC Bank and ICICI Bank, they are the banks that are under the domestic systemically important banks. And these banks have to maintain additional common equity tier 1 capital. That means all the scheduled commercial banks have to maintain the CRAR of 9%, the common equity tier 1 of 5.5% with additional capital conservation buffer of 2.5%. But these domestic systemically important banks have to maintain even higher common equity tier 1 capital of 0.80% for the State Bank of India. HDFC Bank has to maintain 0.40% high additional common equity tier 1 capital. So basically this Z shows that domestic systemically important banks have to maintain the higher buffer. So basically for the State Bank of India, the Z will be 0.80. For the HDFC Bank, it will be 0.40, and so nothing much to discuss here. Any confusion, anyone? Any confusion here? So basically this Z is nothing else. This is the Z. This is applicable to the domestic systemically important banks because this Z is the additional common equity tier 1 capital that the domestic systemically important banks have to maintain. Z shall be 0 for the other banks that are not in the category of domestic systemically important banks. That is it. Okay. So what is the minimum, 0% of the dividend will be allowed from the adjusted profit after tax for which category of banks? For which category of banks that have up to 8% of common equity tier 1 capital. Okay, so this is what you have to keep in mind. If the bank has above 20%, if the bank has above 20% of common equity tier 1 bank, this is the normal banks that we are talking about, not the domestic systemically important banks. So if the bank has above 20% of common equity tier 1 capital, the bank will be allowed 100% of the adjusted profit after tax, the dividend from the adjusted profit after tax. Okay, so bank will be allowed to provide 100% of the dividend from the adjusted profit after tax. This is the idea. Now, one more thing that you have to keep in mind is this spatial line that we have not discussed till now, that we are going to discuss now. So basically, let's say that the profit after tax, let's say the profit after tax is 100. Okay, let's say the profit after tax is 100 rupees. What is adjusted profit after tax? Adjusted profit after tax is profit after tax minus the 50% of net NPA. Net NPA, let's say, is 20. So 50% of net NPA is 10. So what is the adjusted profit after tax? What is the adjusted profit after tax? It is 90. Adjusted profit after tax is 90 crores. Let's say adjusted profit after tax is 90. From this, the dividend can be provided. Now let's say that the bank is in the bucket 4. The bank is in the bucket 4. That means 40% of the 40% of the adjusted profit after tax. But what if the bank is in the bucket 10? The bank is in the bucket 10 and the bank is allowed to give 100%. The bank is allowed to give 100% of the dividend from its adjusted profit after tax. That means the bank can give 90 crores as dividend. The bank can give 90 crore as dividend. So the bank is giving a lot in the dividend form. Here there is a clause that has been added that these are the buckets that the bank has to follow. But in aggregate, the bank should not increase its dividend more than 75% of profit after tax. That means profit after tax is 100 rupees. The bank can maximum give 75% of the profit after tax as dividend, that is 75 rupees. So will the bank be allowed to give 90 rupees as dividend? No. Even if the bank is falling in the bucket 10, the bank will not be allowed to give 90 rupees as the dividend because the maximum that the bank can give is 75% of profit after tax. I hope this is very much clear that the bank can fall in any of the bucket. The bank can provide, let's say the profit after tax is 100 crores, deduct the 50% of the net NPA to come to the adjusted profit after tax. Now net NPA is 80 crore. So 50% of 80 crore is 40 crore. 40 crore minus profit after tax. Profit after tax is 100 crore. Now what is the adjusted profit after tax? That is 60 crore. That is 60 crore. Now, if the bank is falling in bucket 10, if the bank is falling in bucket 10, that means 100% of dividend can be given against the adjusted profit after tax of 60 crore. So, bank can give 60 crore, 100% of adjusted profit after tax means 100%, that is 60 crores, the bank can give as dividend. Is it allowed? Yes or no? You have to tell me yes or no. Is it allowed to give 60 crore as dividend? Yes, it is allowed. Why? Because it is under the limit of 75% of profit after tax, that is 100 crore. So the bank can max give 75 crores. If the 100% of adjusted profit after tax is 60 crore, that is under the limit of 75 crore. That is not exceeding 75 crore. So this is the idea that a bank incorporated in India which satisfies the eligibility criteria above. If the bank is satisfying the eligibility criteria, the bank can declare and pay dividend up to the limits that has been determined. If the bank is in bucket 10, it can give 100% of dividend as a percentage of adjusted profit after tax. But in aggregate, the bank cannot provide more than 75% of profit after tax. So if the 100% of adjusted profit after tax is within the limit of 75% of profit after tax, that is fine. That is fine. But if the 100% or if a percentage of adjusted profit after tax is higher than the 75% of PAT, that is not allowed. Only up to 75% of profit after tax can be given in the form of dividend. Okay. Now, why is this clause made? Why only up to? Because profit after tax should be distributed. Profit after tax has been paid from the profit, so the profit after tax money should go in the form of retained earnings or undistributed profit that should be kept with the bank, and the rest should be given in the form of dividend to the shareholders. So 75%, it has been mandated that up to 75% of the profit after tax can go to the dividend, so that at least 25% is kept with the banks in the form of retained earnings. Okay, so this is the idea. So basically 100%, even 100% of the dividend can be given, but from the adjusted profit after tax that cannot exceed 75% of profit after tax. Okay, so this is the idea. Chalo. Moving forward, of quantum of dividend payable by banks not incorporated. Not incorporated in India, now we will discuss. So a foreign bank operating in India in branch mode that satisfies the eligibility criteria, that means it has a positive profit after tax, it is maintaining the capital adequacy ratio, it is maintaining the capital to risk weighted asset ratio and such, they can remit net profit or surplus earned arising out of their business in India from their branches in India. They can remit the profit outside without prior approval of the Reserve Bank of India, subject to the conditions that the accounts of the bank are audited, and in the event of more remittance, that means more money has been remitted by mistake to the head office that is in foreign, the head office of that foreign bank immediately shall return the excess remittance. So basically the foreign bank operating in India in the branch mode, if they satisfy the eligibility criteria, that means they are maintaining good capital adequacy ratio, they have good capital in the previous financial year, in the current financial year, they have good like positive profit after tax, they can send the money, they can send the net profit, that is the profit after tax, they can send the net profit to their head office, and they do not require the prior approval of the Reserve Bank of India. But if there is any excess remittance, that has to be returned to India. Okay. Profits not eligible for dividend or remittance. So there are certain profits that are not eligible for dividend or remittance, that is extraordinary profit earned by banks from one time or unusual event. So that cannot be given in the form of dividend or remittance. If the audit report by the statutory auditor, if by the legal auditor, the audit report states that there is overstatement of the profit after tax, that is there is the increase, there is the overestimation or there is the overstatement of profit after tax, the bank has reported higher profit than what the bank has actually earned. So the excess portion of the profit that has been declared by the bank cannot be provided in the form of dividend, because that excess profit is not present. The bank has just overstated its profit. So then the bank is not allowed to give the dividend from that overstated amount, because that overstated amount is not present as per the auditor. Bank shall not pay dividend or repatriate profits, send profits out of net unrealized gains arising on fair valuation of level 3 financial instruments. Level 3 financial instruments are the illiquid financial instruments which have unobservable valuation. That means the valuation is not easily observed in the market space. Okay, and they are very illiquid, they are not liquid, they are not easily sold and purchased. Okay, so bank, if they think that there are the gains that are happening from the level 3 financial instrument, but these gains they have unrealized, they have been unrealized, that means they are not still the bank has not still got them. So if there are the unrealized gains, from these unrealized gains the bank cannot provide any dividend or such. Okay, these are the unrealized gains that the bank can show in its book, but the bank cannot share the dividends on behalf of the unrealized gains on behalf of the valuation of level 3 financial instruments, because they are very illiquid, they are very much unobservable in terms of valuation. Next, a bank paying dividend or remitting profits to head office shall report to the Department of Supervision of the RBI within a fortnight of declaration of dividend or remitting profits to head office. Now coming, so we have completed the article from the commercial bank perspective. Now we will discuss the article from the perspective of small finance banks, payment bank, local area banks and regional rural banks. As I've told you that separate notifications have been released for these other categories of banks. Okay. So first of all, for the small finance banks and the payment banks, they have to maintain the CRAR of, anyone knows that how much of the CRAR, how much of the adequate capital the small finance banks and the payment banks have to maintain. It is not 9%. So what percentage is it? What percentage they have to maintain? Anyone? So see, the small finance banks and the payment banks, they have to maintain 15% of the CRAR. So the small finance banks and the payment banks, they have to maintain higher CRAR of 15%. So they do not require the capital conservation buffer. The RBI has not stated the capital conservation buffer for the small finance bank and the payment bank separately, because already the small finance bank and payment bank are maintaining very high CRAR of 15%. This is the minimum regulatory requirement. Okay. This is the minimum regulatory requirement. Out of the CRAR, tier 1, like the capital against the risk-weighted asset should be maintained in the form of tier 1 capital and the tier 2 capital. It is said that the tier 1 capital should be minimum of 7.5%. So that's why if the small finance bank or payment bank, if they have up to 7.5% of the tier 1 capital, then they are not allowed to provide any dividend. Okay, so this is the basic idea that I hope you have understood, that the CRAR, the tier 1 in the CRAR of the small finance bank and payment bank, tier 1 capital should be minimum of 7.5%. If the small finance bank and payment bank have up to 7.5% of the tier 1 capital only, that means they are not able to maintain the tier 1 capital, or they are only maintaining minimum of the tier 1 capital, so they cannot pay the dividends. But if they have more than 7.5% of the tier 1 capital, then they can provide the dividend. Okay, here you can see initially same in the form of like the starting 5 buckets increase by 2% of in the category, and the rest increase by 1%. Okay, that you can see. The same idea will continue. Now for local area banks, the CRAR requirement is 9%. Directly for local area banks, the CRAR requirement is 9%. This is the minimum requirement. If the banks are only, local area banks are only able to maintain the minimum requirement, then they cannot give the dividend to their shareholders. But if they are maintaining more than 9%, then they can give the dividend. And similarly, in this initial 5 buckets, the percentage increases by 2%, while in the rest of the buckets, the percentage is increasing by 1% only. That is the idea. Now tier 1, again for regional rural banks, for RRBs, like for the scheduled commercial bank, they have to maintain the CRAR of 9%, out of which tier 1 capital should be 7% and the tier 2 capital can be 2%. So the regional rural banks have to maintain minimum of 7% of the tier 1 capital. They have to maintain minimum of 7% of tier 1 capital. So if they are only maintaining minimum, they cannot give the dividend from their adjusted profit after tax. But if they are maintaining more than 7% of tier 1 capital, then they can give the dividend. That is the basic idea. Any confusion, anyone? Chalo. So this is the idea that I have made you understand, that first of all, the scheduled commercial banks or the commercial banks, they can provide the dividend from their adjusted profit after tax if they have the common equity tier 1 capital of more than 8%. Okay, if they have common equity tier 1 capital of less than 8% or equal to 8%, the dividend from the adjusted profit after tax will be 0%. Okay, but if they have more than 8% of the common equity tier 1 capital, they will be allowed to give the dividend, okay, of 20%, 30% and so on and so forth. Now for the small finance banks and for the payment banks, if they are maintaining the tier 1 capital, if they are maintaining the tier 1 capital of more than 7.5%, then they can give the dividend. If they are maintaining less than 7.5% or equal to 7.5%, they cannot give the dividend. Dividend from the adjusted profit after tax will be 0%. For the local area banks, it is on behalf of the CRAR. They have to maintain 9% of the CRAR. So if they are maintaining more than 9% of the CRAR, then they can give the dividend. For the RRBs, if they are maintaining the tier 1 capital of 7%, more than 7%, then they can give the dividend. Okay, more than 7%, then they can give the dividend. More than 9% of the CRR for local area banks, then they can give the dividend. More than 7.5% of tier 1 capital for small finance bank and payment bank, they can give the dividend. Okay, so this is the idea. And for the starting till 5 buckets, till bucket 5, there is the increase by 2% in the percentage form, and after that there is only 1% increase in the percentage form. That you can keep in mind. Okay, so the top parameter and the last, this keep in mind. Now, regardless of the bucket limit, like in the commercial banks case, the adjusted profit after tax, the 100% of dividend can be given from the adjusted profit after tax, but from the profit after tax only 75%. This is the maximum limit. Okay, so even though 100% of dividend can be given from the adjusted profit after tax, but this is limited to 75% of the profit after tax for the commercial bank. For the scheduled commercial banks and for the payment banks, the same limit will be followed. That is 100% of dividend can be given from the adjusted profit after tax, but this is limited to 75% from the profit after tax. But for the local area banks and for the RRBs, this limit is 80%. This limit is 80%. That means 100% of the dividend can be given from the adjusted profit after tax, but only 80% can be given from the profit after tax. This is the limit. So even though you can give 100% of the dividend from the adjusted profit after tax, but this is limited to 80% of profit after tax. Okay, it should not increase, it should not exceed 80% of profit after tax. So this is it. This is it for today. I hope you understood everything very clearly. And as I have told you that for the regional rural banks, for the small finance banks, for the payment banks, for the local area banks, there are separate notifications that the RBI has released. Now remember that when we talk about the commercial banks, when we talk about the commercial banks, here we are also talking about the foreign branches. That's why we are talking about the declaration of dividend by the commercial bank and the remittance of profit by the foreign bank branches in India. So they remit the profit. But when we talk about the RRBs, when we talk about the small finance banks, when we talk about the local area banks and the payment banks, in the notification of the RRBs, SFBs, LABs, there is only the mention of declaration of dividend. There is only the mention of declaration of dividend because the foreign branches are discussed in this commercial bank direction only. Okay. So when we talk about the RRBs, small finance bank and the payment bank and such, there is directly only the mention of declaration of dividend. And the other norms are more or less same, just the table was different that I have shown you. And how you can remember the table is tier 1 capital for small finance bank, the minimum requirement of tier 1 capital is 7.5%. CRAR for LABs, minimum requirement is 9%. That is same for the scheduled commercial bank also. Tier 1 requirement for the RRBs, that is 7%. Okay. Common equity tier 1 requirement of the scheduled commercial bank, that is 8%, because the scheduled commercial bank, they also have to maintain the capital conservation buffer, which the other category of banks are not as much required to maintain. Chalo. Now, a bank declaring dividend, a regional rural bank. See, this is the slight difference, because the regional rural bank, they are supervised by the NABARD. They are regulated by RBI, but they are supervised by NABARD. That's why in the case of RRBs, a RRB declaring dividend shall furnish the report to the Department of Supervision of the NABARD. While the other category of banks, small finance bank, regional small finance bank, local area banks, payment banks, scheduled commercial bank, they have to provide the report to the Department of Supervision of RBI. But only the RRBs have to provide the report to the Department of Supervision of NABARD. Okay, as well as the RRBs, they do not. The RRBs, the other directions is same. The profit not eligible for dividend for RRBs. So yes, first and second point is same, but this third point, this is not valid for RRBs. This is not valid for RRBs because I think the RRBs, they do not invest in the level 3 financial instruments. So this third line is not applicable for RRBs. The rest of the direction is same for the different kind of banks. Okay, RRBs, they have to provide the report to the Department of Supervision of the NABARD. And when we talk about the profits not eligible, so the third point is not eligible for RRBs. That's it. Chalo. So this is the first question. I hope you will be easily able to answer this question. Okay, Avnish, do share your doubt. So this is the first question in which you have to tell that RBI has recently released Prudential norms on declaration of dividend directions 2026. Which of the following statement is or are correct? Correct statement you have to tell, okay? And read the statements very, very carefully and then try to answer the question, okay? So RRBs, do they have, can they provide like 75% of the PAT? Their dividend should not exceed 75% of the PAT. Small finance bank, their dividend should not exceed 80% of the profit after tax. Adjusted profit after tax is profit after tax minus 50% of the net NPA. So do read the statements very, very carefully and then try to answer this question. The second question is direct a bank incorporated in India which satisfies. So as per the RBI Commercial Banks Prudential norms on declaration of dividend by the Commercial Banks of India, by the Scheduled Commercial Bank of India, and remittance of profit by the foreign bank branches in India, they remit the profit to outside. So basically, as per these directions, a bank incorporated in India which satisfies the eligibility criteria above may declare and may pay dividend up to the limits prescribed, but in aggregate not exceeding how much of the PAT. That means as per the table, the dividend can be given from the adjusted profit after tax, but it should not exceed what percentage of the profit after tax. So that you have to answer, okay? Chalo. Any confusion anyone has, any doubt, any query anyone has? Because then if there is no confusion, I will be closing the session. So this is it for today. Thank you everyone. Thank you for joining. I hope you enjoyed the session. Avnish, that is not notified by the RBI. Like, I will have to see it more carefully. Okay. Do comment down below. Okay. Do comment down below your query. I will also search upon it because I'm not able to remember the exact limit or if it has been defined in the pilot or not. So I will also have to see it. Okay. Chalo. Okay. Thank you everyone and thank you for joining the session. I hope you enjoyed the session. See you in the next session. If there is any question, any query you have that on, welcome to EduTap and welcome to today's Finance 360-degree session in which we are going to discuss a very important notification that has been recently released by the Reserve Bank of India, in which the Reserve Bank of India has revised the add-on factors. Okay. So where the add-on factors have been revised, in which particular contracts and how these have been revised, all of this we are going to discuss from the examination perspective. This is very, very important as well as it is quite technical also. So we will discuss it in the manner so that you are able to understand. Okay. So a very important notification has been released by the Reserve Bank of India regarding the add-on factors that we are going to discuss in today's session. And I have broken this down so that you have the clear understanding. Okay. So first of all, give me a thumbs up if I'm clearly audible and the screen is visible. Good morning, Fruity. Good morning, Akshu. Good morning, everyone. So welcome to the session. So RBI has tightened the counterparty credit risk rules for the commercial banks. The add-on factors have been increased, or there is a change in the add-on factors that have been brought for the market-related off-balance sheet items. Okay. So let's understand the whole guideline. Let's understand the key terms in the easy manner going forward. So now before starting with the session, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. Okay. So you will get the PDF in the Telegram channel. Now let's get started with the article. So I hope I'm clearly audible. Okay. So the Reserve Bank of India Commercial Banks Prudential Norms on Capital Adequacy Third Amendment Directions 2026. So basically the RBI has brought a major amendment in the prudential norms on the capital adequacy. I hope that everyone knows that the banks, the different banks, let it be the payment banks, let it be the small finance bank, commercial banks, they have to maintain the adequate capital. They have to maintain the adequate capital with themselves. Why do they require the adequate capital? Why should the bank maintain the adequate capital with themselves? So the bank has to maintain the capital adequacy. The bank has to maintain the capital adequacy so that the bank can handle the distress situation if there is any. If there is any stressful situation, if there is any liquidity crunch that is happening, or if there is any distress situation that is happening with the bank, with the help of the adequate capital that the bank is maintaining, the bank can handle such kind of distress situation. Okay. So against the risk-weighted assets, see, the banks have different assets. The bank has the loans that the bank is providing. So bank is giving the loans against which the bank will get the interest. The bank also has the other market related transactions, or let's say the bank has different financial instruments that are the assets of the bank. Now these assets have some risk weight. What if the financial instruments, their prices are volatile? What if their prices decline and the bank make losses? In the loans also, the loans are also very risky, that what if the borrower do not return the loan? Okay, so the loans and the financial instruments, they are risky. They have some risk weight. Certain loans, let's say the loan is given to the central government, it has 0% risk weight. The loans given to the state government has, let's say, 20% or 10% of the risk weight. The loans given to the corporates, let's say it has 50% of the risk weight. The loans given to the micro, small and medium enterprises, let's say it has a 70% of the risk weight. The financial instruments, let's say it has 80% of the risk weight. So different assets of the bank that is earning some profit, that is earning some returns, that is earning some interest. So different assets of the bank has different risk weight. Okay. Against these risk weighted assets, because the assets have risk attached. Okay. The assets, the loans, the financial instruments, they have risk attached. They are risky. Okay. What if some of the loans do not come back? What if the financial instruments prices drop? So the assets have risk weight, and against these risk weighted assets, the banks have to maintain the capital. Okay. The banks have to maintain the adequate capital. This is known as the capital to risk weighted asset ratio, the capital adequacy ratio. The bank has to maintain the adequate capital against the risk weighted assets. Now for the commercial banks, what is the CRAR? For the commercial banks, the capital to risk weighted asset ratio is how much? Is it 15%? Is it 12%? Is it 9%? What is the capital to risk weighted asset ratio? It is 9% for the commercial banks. For the small finance banks, for the payment banks, what is the capital to risk weighted asset ratio? What is the CRAR that the small finance banks, that the payment banks have to maintain? I hope you remember that the small finance banks have to maintain the CRAR of 15%. The payment bank have to maintain the CRAR of 15%. Okay, so this is the idea that all the banks, they have to maintain adequate capital with themselves. Commercial banks have to maintain the CRAR of 9%, and the small finance bank, payment bank have to maintain the CRAR of 15%. So this is the requirement, that there should be capital adequacy that the bank should have. The bank has to maintain adequate capital, and regarding that, there are some prudential norms which have recently been amended. So this is the crux, or this is the basic idea that we are going to discuss. Now RBI has decided to amend the Reserve Bank of India Commercial Banks Prudential Norms on Capital Adequacy Directions 2025 to provide greater clarity. Now why the amendment has happened? To provide greater clarity and to largely align the capital adequacy norms, the prudential norms, with the international standards, Okay, so this is the idea, that the amendment has happened to provide the clarity regarding the capital adequacy norms, as well as to largely align the capital adequacy norms with the international standards. Okay, and this has happened for the commercial banks. There is also the guidelines that is released for the small finance bank, for the payment banks, and for the all India financial institutions. Okay, so basically the RBI has also amended the prudential norms on capital adequacy for the small finance bank, payment bank, and all India financial institutions and the commercial banks. Okay. Now these amendment directions shall come into effect from the date of the issue, that is immediately these amendments are applicable, as well as the applicability of the direction is on the commercial banks, small finance banks, payment banks, and all India financial institution. That is the idea. Okay. So I hope the basic idea is clear, that okay, the amendment has been brought, in what guidelines the amendment has been brought. Now before moving forward, first we have to understand that what is the counterparty credit risk, because the traditional credit risk, we understand it very clearly. Okay, but what is the counterparty credit risk, that we have to understand? See, in the traditional credit risk is basically the loans that the bank is giving. If the bank is giving the loan to the borrower, where the risk is, Who is handling the risk? Who is having the risk? Does the borrower have the risk or the bank has the risk? In the traditional credit, that means the loan that the bank is giving, in this case, which party has the risk? The bank has the risk or the borrower has the risk? The bank has the risk because the bank is providing the loan. What if the loan does not come back? What if the borrower defaults? So the bank has the risk. The bank has the risk. That is a unilateral risk, we can say. This is a unilateral risk. And the bank knows that, okay, 10 lakh rupees has been given as the loan. So this is the exposure of the bank. This is the exposure of the bank. Okay. Against which, so this is the 10 lakh rupees that is given as the loan. This is the exposure of the bank to the borrower, and against the exposure, the bank has to maintain the capital against the risk-weighted asset. Okay. Now, in the case of counterparty, credit risk, basically the counterparty credit risk says that the risk is bilateral. Risk is bilateral. That means both the parties have the risk. Now, in what case both the parties will have the risk? So usually in the off-balance sheet transactions, that is usually in the case of financial instruments like the derivatives, both the parties have the risk. Have you heard about derivatives? Have you heard about derivatives? So derivatives are what? Derivatives, they derive the value from some underlying asset. Derivatives are the financial contracts that derive their value from some underlying asset. It can be stocks, it can be interest rate, it can be the currency, the foreign currency. Okay, it can be gold or like other precious metal and such. So basically derivatives are the financial contracts between the two parties, and the derivatives derive their value from some underlying asset. It can be shares, it can be interest rate or XYZ. Okay, so now these derivatives, they are called off balance sheet item. Balance sheet item. Why they are off balance sheet? Because they are not directly recorded in the balance sheet. In the balance sheet, the loans of the banks are recorded, the deposits that the banks is taking is recorded. So these kind of immediate assets or liabilities. Loans are the asset for the bank. Deposits are the liability of the bank that the bank has to return in the future. So in the balance sheet, we record, or the bank record, the immediate asset and liability. So at this point of time, what are the asset and the liability of the bank? That is recorded in the balance sheet. Off balance sheet items are basically derivatives like the future contracts, the forward contracts, the swap contracts, the option contracts. They have some future date. They will be maturing on some future date. So these are the off balance sheet items. They are the future exposure, or they are going to mature in future in the coming time period. Okay, so these are derivatives, are the off balance sheet item that will expire or that will mature in future, and that's why they are not recorded in the balance sheet. They are off balance sheet items. So these off balance sheet items, that is derivatives. So derivatives, that is the off balance sheet item. They are like the forward derivatives or the futures or the options or swap contracts. They are off balance sheet item. Now the derivatives, many of the banks, they are coming into derivatives, they are coming into forward derivatives, or they are coming into future derivatives or options and such. Now these have counterparty credit risk. They have counterparty credit risk. That means, let's say Bank A of India is having a derivative contract with Bank B of England. Now there is a counterparty credit risk that what if the Bank A does not fulfill the conditions or does not fulfill the contract, or the Bank B does not fulfill the contract. So there is a counterparty credit risk that what if a party do not fulfill the contract. Okay, so let's understand this with an example, then you will have better clarity. But this is the basic idea that the traditional credit risk is basically the unilateral one-sided risk. The bank is providing the loan to the borrower. So bank has the risk. Now the bank know that how much is the risk. The exposure is stable. We know that, okay, the bank has given 10 lakh rupees. So this 10 lakh rupees is the exposure of the bank. This is the asset, or this is the exposure of the bank. Okay. So who loses or who is at the risk? The lender, that is the bank, is at the risk. But in the counterparty credit risk, that is the derivative contracts or the market transactions that is happening, the financial instruments that are being signed, they are off balance sheet. If they are off balance sheet item, basically That means they will be settled in the future, they will be maturing in the future. So they have a counterparty credit risk. That means both the parties, any of the party can default. Indian bank can default or the foreign bank can default. Okay, so any of the party can default. So either party, both the parties basically have the risk. Both the parties have the risk, as well as there is uncertain exposure that we will discuss. Okay, so basically take this example. Let's say that the Indian bank wants to have $1 million. Okay, the foreign bank has said that, okay, the foreign bank will provide the Indian bank the $1 million after 3 months. After 3 months. Okay, so the foreign bank has agreed to provide $1 million to the Indian bank after 3 months at the rate of 83 rupees per dollar. Okay, 83 rupees per dollar. Okay, so we will have to give 83 million rupees to get $1 million. Okay, so this is the basic idea. So Indian bank wants $1 million. Foreign bank has agreed to provide the $1 million to the Indian bank at the rate of 83 rupees per dollar. Now this is a forward derivative contract. This is a forward derivative contract where the two parties have agreed to do the transaction, and the forward date is after 3 months. That after 3 months this settlement will happen. Now let's say that right now the Indian bank has agreed to purchase $1 million from the foreign bank at 83 rupees per dollar. Okay, what if after 1 month, now the contract will be settled after 3 months, but after 1 month, let's say now per dollar is equal to 85 rupees. So if the foreign bank provide per dollar at 83, if the foreign bank provides per dollar at 83 rupees, so is it a loss for the foreign bank? Yes or no? Is it a loss for the foreign bank? Yes. If the foreign bank provide the Indian bank $1 million at 83 rupees per dollar, so it is a loss. It is a loss for the foreign bank, because right now it can sell the dollars at 85 rupees. So 2 rupees per dollar is the loss for the foreign bank, while for the Indian bank this is a profit. Because if the Indian bank is getting it the per dollar at 83 rupees, it does not have to pay 85 rupees per dollar. That means the Indian bank is making the profit of rupees 2 per dollar. Now, because the foreign bank is making the loss, it might default. It might say that, okay, we do not have dollars to give. We do not have dollars to give. So it can say that, okay, we do not have dollars to give and we are getting out of this contract. So Indian bank is exposed to the foreign bank in this case. In this case, the Indian bank is exposed to the foreign bank. So Indian bank has exposure. And what is the exposure of the Indian bank? 2 rupees per dollar. That is 2 million rupees, we can say, basically. So 2 rupees per dollar is the exposure of the Indian bank for the foreign bank. Is it making sense? So basically, Indian bank and the foreign bank had agreed to provide, $1 million at 83 rupees per dollar. But now after 1 month, per dollar is of 85 rupees. So if the foreign bank is providing the dollar at 83 rupees, this is loss for the foreign bank, but this is gain for the Indian bank at 2 rupees per dollar. The Indian bank is saving 2 rupees per dollar. Okay. So now if the foreign bank defaults, it is the Indian bank is exposed to the foreign bank, and if the foreign bank defaults, the Indian bank will be making the loss now. Okay. In the second case, what happens that after 2 months, let's say after 2 months, now the per dollar is 81 rupees. Per dollar is 81 rupees. The Indian bank has agreed to pay 83 rupees for per dollar. So now the foreign bank is making the gain. Now the foreign bank is making the gain because foreign bank is getting 83 rupees rather than getting 81 in the market. So foreign bank is making the gain of rupees 2 per dollar. So basically the idea is that the exposure is uncertain. The Indian bank may be at the exposure or the foreign bank may be at the exposure. Whichever party is gaining, it is at the exposure. Because if the other party defaults, then the gaining party will lose. So this is the idea that there is uncertain exposure. Any party can be at the exposure. If the party is gaining, let's say before the Indian bank was gaining, so Indian bank was exposed to the foreign bank. In the second case, the foreign bank is gaining, and in this case if the Indian bank defaults, then the foreign bank is exposed to the Indian bank. So there is uncertain exposure because of the volatility in the market. There is a lot of uncertain exposure, and both the parties can be at the risk. So this is known as counterparty credit risk. Okay, so this is the idea, that in this case when 81 rupees per dollar, in this case when there is 81 rupees per dollar, the foreign bank is gaining and the Indian bank is losing, because Indian bank has to pay 83 rupees per dollar, while it could have paid only 81 rupees in the market. Okay, so in this case the Indian party is losing and the foreign party is winning. Okay, so foreign bank is exposed to the Indian bank, so whichever party is gaining, it is exposed to the other party, and if the other party defaults, then the gaining party will lose. And that's why there is uncertain exposure. Both the parties can be at exposure, both the parties can be losing, any of the party can lose. So that is counterparty credit risk. In the case of traditional risk, there is only unilateral risk, but in the counterparty credit risk, in the derivative contracts that are off balance sheet contracts, in this case both the parties are at risk. So counterparty credit risk is the risk that the counterparty, that is the other party to a transaction, could default before the final settlement could happen. So CCR, that is counterparty credit risk, creates a bilateral risk of loss. The gaining party might lose if the other party default, and the gaining party can be any party, the losing party can be any party. Okay, so both the parties have the risk in the derivative contracts. Now if the bank has the risk, if the Indian bank or the foreign bank has the risk, okay, so they against the risk they also should maintain some capital. So that is the CRAR basically states that against your risk weighted assets, so if the Indian party is gaining, basically in this case the Indian party was gaining, we were saving rupees 2 per dollar, so nearly we were saving 2 million rupees against the dollars. Okay, so in this case Indian party was exposed to the foreign bank. Okay, so there is some risk weight to the gain that we have, to the asset that we have. Against the risk weighted asset, the banks have to maintain the capital. Okay, so in the counterparty credit risk also, against the risk weighted assets, the banks have to maintain the capital. Okay, so how much capital the bank has to maintain? The commercial banks have to maintain 9% of the CRAR. The small finance banks, the payment bank has to maintain 15% of the CRAR. Okay, so this is the idea. Any confusion? If default happens, the banks will have to use its capital to handle the distress, to handle the loss, as well as the banks also maintain some provisions that will help the bank to handle the loss. Okay, so if the default happens, then that's why against because the asset, if you are gaining basically, your asset has some risk weight, that what if the other party defaults? So against your risk weighted asset, you have to maintain certain capital so that you can handle the distress situation if the other party actually defaults. So all the assets, basically all the contracts, all the loans, they have some risk weight. So against the risk weighted asset, the bank has to maintain the capital. Okay, chalo. Now coming to the calculation, so basically this is the calculation that is given, or this is the formula that is given that you have to keep in mind. So credit equivalent. Now derivative, do they have stable exposure or do they have uncertain exposure? What kind of exposure do they have? The derivatives, do they have stable exposure? That we know that this is the exposure, that rupees 2 per dollars, or rupees 1 per dollar, or rupees 10 per dollars, or they have uncertain exposure, that as per the market volatility, it can be 15 rupees per dollar, or it can be 2 rupees per dollar, or 1 rupees per dollar is the change in the price that is happening. So derivative have uncertain exposure. Any party can have the exposure to the other party, as well as the fluctuation in the value can be extreme. There can be extreme fluctuation in the value. Right now you have made a contract of rupees 83 per dollar. Now this price can increase in the market to rupees 100 per dollar. So exposure is very much uncertain. Because of the uncertain exposure, it is very hard to understand that how much is the asset for the bank, how much the bank is actually gaining from the derivative, or how much the exposure the bank has. So because there is uncertain exposure, that's why the derivative contracts or the derivative value has to be converted into the credit equivalent amount through the current exposure method that has been given in the notification that the RBI has recently released, that the derivative value or the exposure, the derivative exposure has to be converted into credit equivalent amount so that we can know the actual exposure that the bank has to the other bank, okay, or a party has to the other party. So credit equivalent amount of the market related off balance sheet transactions, that is basically for the derivatives that is market related. In the market the transaction is happening and these are off balance sheet items. These are off balance sheet items. So what is the credit equivalent amount for the derivative? So this can be calculated through the current exposure method. So credit equivalent amount for the derivative, this has the formula, the current exposure plus the potential future credit exposure. Okay, so current exposure is basically, in this example, let's say the first month is going on. So the Indian bank had decided to pay 83 rupees. The Indian bank had decided to pay 83 rupees per dollar. Right now, the price of per dollar is 85 rupees. So what is the exposure of the Indian bank? How much the Indian bank is gaining? Indian bank is gaining rupees 2 per dollar, and Indian bank has agreed to get $1 million. So that means Indian bank is gaining rupees 2 million by having this contract. So this is also the exposure of the Indian bank. That if the other party defaults, the Indian bank will lose 2 million rupees. Okay, so this is the idea, that Indian bank had made the contract at 83 rupees per dollars. Right now, at this point of time, the per dollar is 85 rupees. 85 rupees per dollar. Okay, so Indian bank is making rupees 2, the profit of or the gain of 2 rupees per dollar, because it does not have to give the extra 2 rupees per dollar. So it is basically making 2 million rupees. Okay, so this is the exposure. So what is the current exposure? That is dependent upon the mark to market value. Mark to market value means the current value of the contract. It does not matter that what was the price at which you signed. What is the current value of the contract? On the basis of that, you can see the current exposure. So Indian bank has the exposure to the foreign bank, that if the foreign bank defaults, then the Indian bank will make the loss, and the current exposure is 2 million rupees. Okay, so that is the idea. So current exposure is easy to find because we can see that what is the current value of the contract in the market. Potential future credit exposure. Now what is the future exposure? Because the contract is not going to finish right now. Contract will finish after 3 months. So we have seen the current exposure. Now what is the future exposure? How much exposure can the bank have in the future? Okay, so to see the future exposure, there is a formula that is used. That is, for the future exposure, we see the notional value, that is the value of the contract, basically the original value and the notional value of the contract, multiplied by the add-on factor that is provided by the Reserve Bank of India for different contracts. So basically, if we want to see the credit equivalent value or amount of the derivative contract, because the derivative contract have fluctuating exposures, they have uncertain exposure. So if we want to see a set exposure for the derivative contracts, if we want to see the credit equivalent amount of the derivative contract, we want to see the current exposure on the basis of the current market value, that is also known as the mark to market value, plus the potential future exposure, because the contract will expire in the future. So we want to see the potential future exposure also, that is calculated by taking the notional value of the contract multiplied by the add-on factor. For different derivative contracts, the RBI has given the different add-on factors. So this is the basic idea to get to the derivative value, the credit equivalent amount of the derivative value. So once the credit equivalent amount is calculated, so adding the current exposure and potential future exposure, adding these two, we have got to the credit equivalent value of the derivative. Okay, deduct any collateral. Let's say the Indian bank has taken a collateral from the foreign bank. Okay, the collateral was worth, so the contract is of $1 million. So let's say the collateral is of $10,000 only. Collateral is 10% of the whole value, let's say. So deduct the collateral because this is the collateral that the Indian bank has already taken for the security of the contract, for the safety of the contract. Okay. So deduct the collateral because this is not the exposure of the Indian bank. This money the Indian bank has already got, or this is the collateral that the Indian bank has already got. So this is not the exposure. This money the Indian bank has received. So this is the safety net basically. Okay. Or let's say $5,000 the Indian bank has already received as the collateral. So out of the credit equivalent amount, deduct the collateral value, then we have got the exposure that the Indian bank actually has at default. If the other party default, so Indian bank, the exposure Indian bank actually has is, let's say, the rest of the amount. Okay. So against the exposure at default, the risk weight is calculated. Multiply it with the risk weight, and against the risk weighted asset, against the risk weighted exposure, the capital has to be maintained by the bank. This is the basic idea. You do not have to go too much in depth. This is just for your understanding purpose. This you have to remember that the credit equivalent amount for the derivative contract is the current exposure plus the potential future exposure. This is the credit equivalent amount. From the credit equivalent amount, we see that what is the exposure at default. From the credit equivalent amount of the derivative, we see that what will be the exposure of the Indian bank at default. Okay, if the default happens from the other bank. So this will be the exposure. Now, what is the risk weight? That is how much risk there is. So we multiply it with the risk weight. That is, we multiply the exposure with the risk weight. Okay, and then against this, we are maintaining the capital. This is the idea. Any confusion? Any confusion here? So now, the largely why these add-on factors have been provided, why the add-on factor has been provided under the potential future exposure. Potential future exposure is the notional value multiplied by the add-on factor. So why this add-on factor is provided? Add-on factors are provided for the calculation of the potential future exposure in the current exposure method for interest for the different contracts, so that the potential future exposure calculation can align with the Basel Committee on Banking Supervision guidelines. Basel Committee on Banking Supervision, this is the global standard setter for the prudential regulation of the banks, So basically, to align with the Basel Committee on Banking Supervision guidelines, that is the global standard setter for the regulation of the banks. So to align the guidelines of Indian banks, or to align the Indian banks with the international standard, these add-on factors have been introduced or they have been updated. Okay, so for the interest rate derivative contracts, you can see that these are the add-on factors. For the exchange rate contracts, where the currency, where the exchange rate, basically the example that we have taken, that we are giving the rupees for the dollars. Okay, so for the exchange rate contracts, for the gold contracts, these are the add-on factors. For the equities, for the shares, stocks, these are the add-on factors. For the precious metals except gold, so precious metal means silver, platinum, palladium, these are the add-on factors. And for other commodities like the agricultural contracts, energy contracts, base metals like aluminum, copper, zinc, and any other non-precious metal commodity contracts, these are the add-on factors. Add-on factors basically multiply with the notional value to get to the potential future exposure, to calculate the potential future exposure. Okay, so this is the basic idea. Let me summarize that. First, we calculate the credit equivalent amount for the derivative contract by taking the current exposure plus the potential future exposure, which is calculated through the notional value multiplied by the add-on factor, which is provided by the RBI for the different contracts. Okay, once we have the credit equivalent amount, that means this is the credit amount that the bank has given to the other bank, or this is the exposure that the bank has to the other bank, okay, that the Indian bank has to the other bank. So we will see through this exposure or through this credit equivalent amount of the derivative, we see that what is the exposure at default. At default, what will be the exposure? Okay, so exposure at default, once we have the exposure at default, we multiply it with the risk weight, and against this risk weighted exposure, the bank has to maintain the capital. Okay, so this is the idea. So these are the add-on factors for the derivatives for the market related off balance sheet items, that are the derivatives. So these contracts have the add-on factors. Okay, so you can see that the highest add-on factors are for the other commodities, Okay, the lowest add-on factor is for interest rate contracts. So remember that the other commodities has the highest add-on factor, then the precious metals except gold, then the equities, then the exchange rate contracts and gold, and the least add-on factor is for the interest rate contracts. Okay, so they can be said to be the least risky, and that's why they have least add-on factor. The higher the time period for the contract, the larger the time period for the contract, the larger the add-on factor also. Okay, the larger the time period for the contract, the larger the add-on factor is. Okay, so now the revision has happened of the add-on factors. This will improve the risk weight calculation for off-balance sheet contracts, because now the potential future exposure is calculated by taking the notional value multiplied by the add-on factor. So through this credit equivalent amount, we see the exposure at default, that what is the exposure of the bank at default. Against this, we calculate the risk weight and the capital that the bank has to maintain. So with the add-on factors, this will improve the calculation for the risk weight. Okay. One more important point is that in the case of payment banks, there is only the add-on factor that is provided for the exchange rate contracts and gold. That means for the payment bank, the other contracts add-on factors do not apply. For the payment bank only the add-on factor is provided for exchange rate contracts and gold. This is very, very important. A question can come on this, that for the payment bank, the add-on factor is provided for which contracts? For the interest rate contracts, for the exchange rate contracts and the gold, for the precious metal contracts, or for the other commodity contracts. So for payment bank, the add-on factor contract or add-on factor for the contract is provided for exchange rate contracts and gold only. Okay, so this is the idea. Now next point is that, see, certain contracts, let's say a contract is for 3-year time period. A contract is for 3 years time period. Okay, that the Indian bank will get $1 million at the rate of rupees 83 per dollar from the foreign bank after 3 years. Now the contract is for a long period of time. The contract is for a long period of time, and the longer the time period, the higher the add-on factor. The longer the time period, the higher the add-on factor, So to safeguard the bank from this, the bank can have such kind of contracts that are structured to settle the exposure at a specified payment date. That means the bank has decided, the Indian bank and the foreign bank have decided that this contract is for 3 years. But at every 6-month interval, there will be the settlement that will happen of the exposure. That means if the Indian bank is gaining, Indian bank will get the profit. If the foreign bank is gaining, the foreign bank will get the profit amount. So whichever the settlement is, that will happen. The exposure will be settled. Okay. So basically, rather than signing new contracts every 6 months, this 3-year contract has been divided into 6-month part, and at every 6 months the exposure will be settled, but the final settlement will happen after 3 years. So basically the contract design is such that the total maturity is of 3 years, but the reset will happen, or the exposure will be settled, the profit or loss will be settled every 6 months. So the contract restarts every 6 months. Okay. So timeline is such that after every exposure becomes 0, that after every 6 months the exposure of the banks becomes 0. So where is the actual risk? So actual risk is only for the 6-month time period rather than for the total 3 years. So this is the basic idea. So core rule is that after every 6 months the exposure will be settled, the profit and loss will be settled between Indian bank and the foreign bank, so that this long term contract do not become a problem for a particular bank. Okay. So residual maturity, so basically the maturity is 6 months, but the final maturity is 3 years. Okay. So this is the idea. So for contracts that are structured to settle the exposure following specified payment date, so specified payment date is 6 months. If after every 6 months the exposure will be settled, so that the contract is not for a very long period of time. Okay. So even though the contract is of 3 years, but after every 6 months, the exposure is getting settled. So both the banks have some kind of safety. So this is the idea. However, in the case, so add-on factor will be how much? So even if the exchange rate contract is of 3 years, but because this after every 6 months, the exposure is being settled, so there is no add-on factor that has to be maintained, right? Because after every 6 months, the exposure is being settled. or there is the add-on factor that is 1%. There is the add-on factor that is 1%. So basically, the add-on factor for the exchange rate contract would have been, for the 3-year contract, the add-on factor would have been 1 year to 5 year, that is 5%. This would have been the 5% of the add-on factor for the 3-year contract. But because the settlement is happening after every 6 months, so 1 year or less, so the add-on factor for the 1 year or less contract is 1%. So instead of maintaining 5% of the add-on factor, how much add-on factor has to be maintained? Only 1% of add-on factor. So I hope this is very much clear that if the contracts are structured in such a way that even though the contract has a long-term maturity period, but if they are settled in the meantime, if they are structured in such a way that they are being settled after every 6 months, so the add-on factor will be applied on the basis of when they are getting settled. Okay, so every 6 months, so according to that, add-on factor will be applied. However, in the case of interest rate contracts, which have residual maturity of more than 1 year, so the interest rate contract that have the residual maturity of more than 1 year, over 1 year, so they have to maintain the minimum of 0.50% of add-on factor. So in the case of interest rate contracts specifically, if the maturity is more than 1 year, if the residual maturity is more than 1 year, even if the contract is of 5 years or more than 5 years, doesn't matter. If the residual maturity is more than 1 year, so the add-on factor of 0.50%, this is the floor, this is the minimum add-on factor that has to be maintained. Even in the case where the reset is happening after every 6 months or 3 months, doesn't matter. This is the add-on factor that will have to be maintained. So this is the idea that even if the contract is for the long term, if in the meantime, if in the 6-month time period, the reset is happening, so then the add-on factor will be applied on the basis of when the reset is happening. So add-on factor will be applied on the basis of the 6-month time period. But in the interest rate contracts, if the residual maturity, doesn't matter that when the reset is happening, if the residual maturity is more than 1 year, then minimum of add-on factor will be 0.50%. Okay, so this is the idea. Now coming to the next point, that is the bank can act as a clearing member. The bank can act as a clearing member. Let's say that there is the settlement that has to happen. So in the stock market, in the stock exchange, in the NSE or BSE, in the National Stock Exchange or Bombay Stock Exchange, there is the contract, there is the future derivative that is signed between X and Y, and the bank is a clearing member that is helping in the settlement of the contract, So clearing members, they clear and settle the contracts. Okay, they clear and settle the contracts, they clear and settle the amount that has to be paid. So bank is acting as a clearing member of the SEBI recognized stock exchanges in the equity derivatives and commodity derivative segment. So banks can act as the clearing member that clear and settle the trade between two parties in the equity derivatives or commodity derivative segment. Shall compute. So now the bank, if it is the clearing member, it also has to maintain the counterparty credit risk or the capital for the counterparty credit risk. So even if the bank is acting as a clearing member, because it has to clear the trade, because it has to settle the trade between X and Y, and let's say that the Y is defaulting, then also the clearing member, that is the bank, has to clear and settle the trade even if a party defaults, because the transaction is happening through the stock exchange. So the clearing member has the responsibility to complete the transaction. So in this case also, if the bank is working as a clearing member to clear and settle the trade, in this case also there is the counterparty credit risk that the bank can face if the other party defaults. So in this case also the bank has to maintain the capital against the risk-weighted asset. Okay, so this is the idea. So banks may act as a clearing member in the derivative market, in the equity and the commodities derivative market, in the stock exchange. Even as a clearing member, the bank can face counterparty credit risk if a party defaults. So banks must compute and maintain capital for the counterparty credit risk arising from such exposure. Okay. So the bank does not necessarily trade in derivatives, but if it is acting as a clearing member that clear the trade on behalf of other participants, then also the bank has to maintain, even if the bank is acting as a clearing member, it still has to maintain the capital for the counterparty credit risk. Okay, because if a client defaults, then the clearing member has the responsibility to clear the trade. Okay, so while calculating the exposure in such cases, the add-on factor, The add-on factor will be applied for the equity derivatives and for the commodity derivatives, because in these market, the bank is acting as a clearing member. Okay. Now, this kind of provision of the clearing member, that the bank is acting as the clearing member of, or the All India Financial Institution is acting as a clearing member, this kind of provision will not be applied to the payment banks, because the payment banks, they are not permitted to act as the clearing member. That means this particular direction is applied to all the other banks, the commercial banks, small finance banks, All India Financial Institution, but this particular direction is not applicable to the payment bank, because the payment bank cannot act as the clearing member in the stock exchange. Okay. Next point is that where a bank act as a clearing member of a qualified central counterparty. Usually what happens that when the trade is happening between X and Y, there is a counterparty. There is a central counterparty. There is a central counterparty that acts as a buyer to the seller and seller to the buyer. Okay. So the central counterparty acts as a buyer to the seller and the buyer to the seller and seller to the buyer. Okay. So central counterparty is the counterparty. It is the intermediary that is coming between the X and Y clients, that is coming between two clients. Okay. So central counterparty has the responsibility to clear to settle the trade. Okay, or to complete the trade, and then the clear and the settlement happens through the clearing member. So this is the idea that the central counterparty, it is in between the two counterparties. It is in between the X and Y. Central counterparty has the responsibility to complete the transaction, and then the clearance and the settlement finally happens through the clearing member. Now the central counterparty has the responsibility to clear the trade or to finalize the trade. So now in this case, qualifying central counterparty is an entity that is licensed to operate as a central counterparty that is permitted by the appropriate regulator overseer to operate between the two clients. Okay, so central counterparty is the intermediary that is coming between two clients so that the trade happens smoothly, and if a party defaults, then the central counterparty is responsible. To settle the trade. Now, where a bank acts as a clearing member. So let's say the bank is acting as a clearing member of a qualified central counterparty. So qualified central counterparty is between the two clients X and Y. Now the clearing member is still a bank. Let's say the bank is the clearing member. So qualified central counterparty is the buyer to the seller and seller to the buyer. Okay. So if a party defaults, then the qualified central counterparty has to complete the transaction so that the other party do not lose. In this case, if let's say the qualified central counterparty is saying that I cannot complete the trade, then again the responsibility will fall on clearing member to clear and settle the trade. That is the idea. So where let's say situation 1 is that bank clears its own trades through a qualified central counterparty. So bank is a clearing member, but it is on its own account, the bank is doing a trade. So basically the bank is a clearing member as well as it is initiating the trade, and there is the qualified central counterparty and the trade is happening with another bank, foreign bank, let's say. Okay, so let's say the bank clears its own, the bank is clearing its own trade through a qualified central counterparty. So trade cleared may include OTC, that is over the counter derivative transactions. These derivative transactions does not happen through the stock exchanges, or if there are exchange traded derivative transaction or securities financing transaction, if any of these transaction is happening for the bank is a party to the transaction and the bank is also clearing the trade. So in this case, the bank has to have a risk weight of 2%. Okay, for these kind of transaction, there is the risk weight of 2% that the bank, against this, the bank has to maintain the capital. So this is the idea. Because the qualified central counterparty is there, so if the second party defaults, then also the bank is free of mind, then the bank is safe because the qualified central counterparty has the responsibility to settle the trade, okay, or to complete the trade. So bank is the clearing member and the bank is clearing its own trade where there is the qualified central counterparty and there is the other bank, that is a foreign bank. So if the foreign bank defaults, the qualified central counterparty has to settle the trade, okay, has to complete the trade in this manner. In this case also, the risk weight that is applied is 2% because the risk is still there, but there is minimum risk because there is the qualified central counterparty that can complete the trade. Situation 2 is the bank cleared trade for its client, not for itself. The bank, there is a client X, there is a qualified central counterparty, and the trade is happening with Y. So the bank is clearing the trade, or bank is the clearing member for the X party, okay, or the bank is the clearing member and it is clearing the trade of its own client. In this case, if the Y party defaults, then the qualified central counterparty has the responsibility to complete the trade. But what if the qualified central counterparty says that, okay, we cannot complete the trade? Then again the responsibility will fall on the bank to clear the trade. And in this case also there is 2% of risk weight that is applied. Okay, so bank cleared the trade for its client through a qualified central counterparty. The bank act as the clearing member for its client. If the bank is legally responsible to compensate the client, let's say the default happens by Y and the bank is responsible to compensate the client, then the bank, in this case, the bank has to maintain the risk weight of 2%. So that is the idea. Got it? Any confusion here? So where a bank acts as a clearing member, so if the bank is clearing its own trade through the qualified central counterparty, any of the trade, if it is the bank is clearing its own trade through a qualified central counterparty, that means there is a qualified central counterparty that is in between the bank X, that is acting as the clearing member, and the bank Y. So if the bank Y defaults, then also there is a qualified central counterparty that can handle and that can complete the trade. So in this case, the risk weight is applied 2%. Let's say the bank is clearing the trade of its client through a qualified central counterparty. So here the bank is not a part of the transaction. The transaction is happening between X and Y, and there is a qualified central counterparty. Okay, the bank is just a clearing member. But let's say the bank is acting as a clearing member for its client. If the bank is legally responsible to compensate the client if the Y party defaults, then the bank has to maintain the risk weight of 2% on its exposure. In case the first responsibility is of the qualified central counterparty to settle the trade or to complete the trade. But if in case the qualified central counterparty is not able to complete the trade, then the bank has the responsibility. So this is the idea. Okay, so provided that a clearing member is not required to maintain the capital for such transactions for the trade exposure where the qualified central counterparty is present, if there is a legal written document where it has been said that the bank will not take the responsibility to compensate the client. Okay, so the bank has to maintain 2% of risk weight if there is qualified central counterparty that is present. So basically the qualified central counterparty has the responsibility to complete the trade. Okay, so in this case, if the bank is clearing its own trade through the qualified central counterparty, then also there is 2% of the risk weight. If the bank is clearing the trade for its client through a qualified central counterparty, then also if it is legally responsible to compensate the client if the qualified central counterparty figures, then also it has to maintain 2% of the risk weight. Okay, but if it has written document that we will not handle any kind of compensation to the client, then it will not have to maintain the risk weight. Any confusion here? So this is a little confusing, but I hope the basic is clear. So where a bank acts as a clearing member, where there is a qualified central counterparty that is also present. So if the bank is clearing its own trade, in this case a risk weight of 2% shall be applied for the bank's trade exposure to the qualified central counterparty. Okay, because there is a central counterparty that is present. Where the clearing member, that is the bank, offers clearing services to its client, a 2% of risk weight also applies to the bank even though there is a qualified central counterparty, because the bank has obligated to reimburse the client if the qualified central counterparty fails, then the bank will reimburse the client. That's why 2% of risk weight against this 2% of risk weight, capital has to be maintained. But if the bank has legally agreed not to pay the client, then there is no capital, then there is no risk weight. Okay, that is the idea. Now this is the first question. I hope you will be easily able to answer this question. Try to answer this question. And based on the add-on factors for market related off balance sheet items, which of the following correctly represents the descending order of add-on factors for contracts with maturity of 1 year or less? Okay. Next is a bank acting as a clearing member of a qualified central counterparty has trade exposure arising from OTC derivatives. So if a bank is acting as a clearing member and there is a qualified central counterparty for a trade if the bank is obligated to reimburse the client. So if there is a client and the bank is obligated to reimburse the client, then how much is the risk weight that will be applied for such trade exposure? So try to answer this question, okay? So this is it. Thank you everyone. Thank you for watching the video, and I hope you were able to understand, though it was a very complicated direction, but I tried to bring it. Hello everyone, welcome to EduTop and welcome to today's Finance 360-degree session. So today we are going to discuss two very important news articles, as well as we will discuss a very important notification, the press release of the Reserve Bank of India. So first we are going to discuss about the PRARAMBH 2026 that has been recently launched, that has been recently initiated. So we'll discuss that what is this PRARAMBH 2026, what is the full form of PRARAMBH 2026, and what is the Kar Sarthi and such. So we will discuss about it, and then we are going to discuss about digital week awareness program. Okay, so that is also launched, and this is launched by the Reserve Bank of India as per the RBI press release. Then we are also going to discuss that the RBI has recently released the Payments Vision 2028. That is yesterday only, on 27th March, the RBI has released the Payments Vision 2028. So I'm not going to discuss the whole Payments Vision today, but I will inform you that okay, this has been launched and when we are going to cover it. Okay, so let's get started for today's session, and let me tell you that the PRARAMBH 2026, the Digital Payments Awareness Week, these both news articles have certain important facts that you have to keep in mind, okay, from the examination point of view. So let's get started. Give me a thumbs up if I'm clearly audible and visible, and I hope the screen is also visible and my voice is quite clear. Okay, give me a thumbs up. And welcome to the session everyone. Good morning to all of you. Okay, so starting with the session now. First of all, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join the Telegram channel where you will get the PDF of the session. And the link for the Telegram channel is provided in the description box below. Okay, so do join our Telegram channel, the Telegram channel of EduTap, so that you can get the PDF of the session. Now let's start with the first article, the first news that we are going to focus on. It is about PRARAMBH 2026. Okay, so the Union Minister for Finance and Corporate Affairs, Srimati Nirmala Sitharaman, launched PRARAMBH 2026. This is the initiative of the Income Tax Department. So this is the Income Tax Department's nationwide awareness campaign on Income Tax Act 2025. So why at this point of time there is the awareness campaign on the Income Tax Act 2025? What is the requirement of this PRARAMBH 2026 to make the people aware about the Income Tax Act 2025? So first of all, try to understand about the Income Tax Act 2025, how this is so important and why the awareness campaign is being run. Okay, so first of all, the Income Tax Act 2025, it has been enacted to provide a streamlined and simplified and modern tax code with reduced compliance burden, consolidated provisions and clear definitions. Over 6 decades, the Income Tax Act 1961 had accumulated numerous amendments. So basically, previously we had the Income Tax Act 1961. So any changes, all the changes, they were added under the Income Tax Act of 1961. You can understand that this act became very old and there were amendments and changes that were happening. All were added in this Income Tax Act of 1961 that became very very big and complicated. So that's why it was thought by the government that we have to replace this Income Tax Act of 1961 with the Income Tax Act of 2025. So now the Income Tax Act 1961 is being replaced with the Income Tax Act 2025. This was announced, and the 1961 Act stands repealed as on 1st April 2026, and the new Act, that is the Income Tax Act of 2025, this is going to be applicable. This is going to be in effect from 1st April 2026, that is from the next month onwards. That's why right now the awareness campaigns are being run by the Income Tax Department to make people more aware about the Income Tax Act 2025, and that's why this PRARAMBH 2026 has been launched. So I hope this is clear that the Income Tax Act 1961 is going to be replaced by the Income Tax Act 2025 with effect from 1st April 2026. And that's why now the PRARAMBH 2026, now the awareness campaigns are being run to make people more aware about the new Income Tax Act 2025. So the Income Tax Act 2025, it is more streamlined, simplified, and this is the modern tax code with reduced compliance burden, consolidated provisions, clear definitions. Over the 6 decades, the Income Tax Act 1961 had accumulated numerous amendments, provisions, explanations, making it complex and difficult to navigate. The new act, that is the Income Tax Act of 2025, it aims to present the same tax policy in a more logical, accessible, and reader-friendly format. Here you can see that the Income Tax Act 1961 had 819 sections, which have been reduced by 35% to only 536 sections in the new act. 14 schedules have been increased to 16 schedules so that there is more clarity that is provided. 511 rules have been decreased to only 333 rules, decreasing the rules by 35%. 399 forms that had to be filed, this has been reduced to 52%. This has been reduced by 52% to only 190 forms. So you can understand that the Income Tax Act 2025, it is more simplified and it reduces the compliance burden on the people. Okay. Now to make the people more aware about the Income Tax Act 2025, the PRARAMBH 2026 has been initiated. So this is the idea. Income Tax Department rolls out PRARAMBH 2026. This is a nationwide awareness campaign on the Income Tax Act 2025 that is going to be in effect from 1st April 2026. So PRARAMBH, what is the full form of PRARAMBH? It is Policy, Reform and Responsible Action for Mission Viksit Bharat. It is very complicated to follow a income tax that is complex, that is difficult to understand, and that has too many compliances to be followed. That's why the Income Tax Act 2025 has been brought to make the compliance easier for the people. PRARAMBH. Now what is PRARAMBH? It is the nationwide awareness campaign run by the Income Tax Department to make the people more aware about the Income Tax Act 2025. The full form of PRARAMBH is Policy, Reform and Responsible Action for Mission Viksit Bharat. This is guided by the spirit of Nagrik Devo Bhava. Okay. PRARAMBH is a multimedia initiative through the multiple channels, through the multiple platforms. The awareness campaign is being run through the print media, through the radio, television, outdoor, through digital and social media. This awareness campaign will be run. This has been designed to build awareness about the key features of the new act, which is set to come into effect from 1st April 2026. Now, the campaign includes creative communication initiatives, taxpayer guidance materials such as guidance notes, tutorial videos, brochures, and extensive public engagement through digital and on-ground platforms, including the My Government Quiz initiative. So the brochures will be released in 10 regional languages along with English and Hindi for wider reach and to make more and more people aware about this Income Tax Act of 2025. Okay. Now the campaign, that is the PRARAMBH 2026, it reflects the Prime Minister's vision of a human-centric digital era and to spread the information through the on-ground efforts as well as through the digital means. Okay. Now, the campaign reflects the Prime Minister's vision of a human-centric digital era through Manav. Manav is M for moral and ethical systems, A for accountable governance, N for national sovereignty, A for accessible and inclusive AI, V for valid and legitimate systems. Okay. Now, citing the vision of the Prime Minister, Srimati Nirmala Sitharaman reiterated that the Income Tax Act 2025 must be rooted in moral and ethical systems. Okay. So, as well as there is also the launch of National Website 2.0. So, the Union Finance Minister also inaugurated the Income Tax Website 2.0 as part of the Income Tax Department's ongoing digital transformation efforts. The upgraded platform is designed to offer improved usability, simpler navigation, and more efficient service delivery for taxpayers. So, what you have to remember from this article is what is the full form of PRARAMBH, why it has been launched, what is the full form of Manav, and what is the brochure, like in how many languages the brochure has been released. Okay. Now coming to the next idea, that is Kar Sathi. Now the Kar Sathi, it is AI driven tax help. So I went to the Income Tax Department's website, and as soon as I logged in or as soon as I went into the Income Tax website, this chat box came up. that is Kar Sathi. Okay, so AI enabled chat box Kar Sathi was also launched, which is an easy to approach companion for taxpayers seeking information on the new act, rules, forms, and related queries and support. See, basically, I wanted to know more about the Income Tax Act 2025, how it has replaced or when it is going to be replacing the previous Income Tax Act of 1961. So I went to the income tax website to get to the information about the previous act and the new act. And as soon as I went to the income tax website, this Kar Sathi chatbot came up. Okay, so this is the idea that this chatbot is to make people more aware or to take the queries of the people. So AI enabled chatbot Kar Sathi, this was launched with which is an easy to approach companion for taxpayers that want to have the information. So if you have any query regarding the new act, regarding the income tax rules, if you have any query regarding the forms, so you can raise your queries here, as well as here you can see that if you have the query you can raise here, as well as you can report tax evasion also. So this Kar Sathi is a very easy to use or easy to raise your queries from. Okay, so AI enabled chatbot has been launched. This will support will also remain available through Ayakar Seva Kendras as well, reflecting the department's commitment to citizen centric, technology enabled and empathetic tax administration. So this is your Kar Sathi. That is an artificial intelligence driven conversational tool designed to assist taxpayers by providing them the information, answering queries regarding the new Income Tax Act rules and forms. So this is the idea. Okay. Now going forward with the next news article, that is Digital Payment Awareness Week 2026. Any confusion anyone has in the PRARAMBH 2026 or any confusion in this Kar Sathi? No confusion? Moving forward with the Digital Payments Awareness Week 2026. Okay, so basically the 6th edition of the Digital Payment Awareness Week has been observed during March 9 to 13th March 2026. As part of this initiative, as part of the Digital Payment Awareness Week, the Governor Shri Sanjay Manotra launched the pilot program titled Awareness Program on Digital Payments to spread the awareness about the digital payments. Okay, so this pilot program has been launched to spread the awareness regarding the digital payments. Now where the pilot is going to work, so the pilot is to be conducted in Maharashtra in partnership with the CSC E-Governance Services India Limited. So the pilot was announced to be conducted in Maharashtra in partnership with the CSC E-Governance Services India Limited. Okay, the pilot will include conduct of in-person awareness programs for 10 lakh participants in the rural and semi-urban areas through village level entrepreneurs to make them more aware about the digital payments and the safe use of the digital payments. As well as at the launch event of the pilot, the Reserve Bank also launched a multimedia awareness campaign Thoda Dhyan Se, so that the people can be made alert and they be careful, which encourages users to be careful while making payments and transacting online. Okay, so this is the Digital Payments Awareness Week that was launched and that has been observed from March 9th to March 13th. And under this Digital Payment Awareness Week, the pilot that has been launched that I have informed you, this pilot is regarding the digital payments awareness. Okay, and it has been launched in Maharashtra in partnership with the CSC E-Governance Services India Limited. These are the important points that you have to remember. Other than this, the RBI has also launched Thoda Dhyan Se awareness campaign. Now you can use these points in your answer writing if there is any question regarding the consumer centric initiatives that have been taken by the Reserve Bank of India or the Government of India, that how the consumers are being made more aware, what are the consumer centric initiatives by the RBI or the government. Okay, so these are the things that you can mention in your answer writing, as well as the questions can come directly from these initiatives, from these PRARAMBH and the DPAW 2026. Okay, the direct factual questions can come, or you can use the things in your answer writing also. Now coming to the Payments Vision 2028, I'm going to take a detailed session on the Payments Vision 2028, but just to show you, this has been launched. This is a very important document of the Reserve Bank of India because this is released for a period of 3 years. Okay, so the Payments Vision 2028 was released yesterday only, that is on March 27th, 2028. 2026. So RBI has been periodically preparing payments vision since 2001. This includes providing strategic direction for structured development of the payment and settlement system in India. So payments vision 2028, or the payments vision, it provides the vision, it provides the mission for the development of the payment and settlement system in India. Okay, that how the development should happen in the payment and settlement system domain in India. Okay, the previous such document covered the period up to 2025. So RBI has now released the payments vision 2028 for the duration up to December 2028. Okay, so this payment vision 2028 is still the duration that is up to December 2028. So this vision that is going to be provided, or that is being provided under the payment vision 2028, it is going to affect the development of the payment and settlement system in India. Okay, and this is the document till December 2028. It has been prepared after considering inputs from various stakeholders, from various regulators. So it consists of 15 specific initiatives which are to be taken up during the course of the next 3 years. So in the next 3 years, there are 15 specific initiatives that have been mentioned that have to be undertaken. Okay, so as I've told you that this particular document, it provides the vision for the development of the payment and settlement system in India. The vision document focuses on user empowerment, strengthening the safeguards against the fraud, enhancing the efficiency of the cross-border payment frameworks, and promoting ease of doing business, among others. So this is the payment vision 2028 that has been launched by the Reserve Bank of India. We are going to have a detailed session on this whole document so that you have the clarity that what are the initiatives, why these initiatives have been launched and such. Okay, so next week we will have a detailed session on the payments vision 2028. This is just to show you that, okay, this document has been released, and this is a very important document from the RBI, as this document is relevant till December 2028. So this is a very important document of the Reserve Bank of India. Even if your exam happens in July or August, this document will be very important from the objective point of view, from the phase 1 point of view, as well as from the phase 2 objective and descriptive point of view. Okay, so do focus on this, and when I will take a detailed session, we will discuss the important points about this document. So this is it for today. Thank you everyone for joining. First of all, before ending the session, let's see the questions that you have to answer in the comment section below. So the first question is in front of you. Union Minister for Finance and Corporate Affairs has launched PRARAMBH 2026. This is a nationwide awareness campaign. Now you have to tell that what is the full form of the acronym PRARAMBH. Okay, so try to answer this question. The next question is about the 6th edition. So this is the question number 2. The 6th edition of Digital Payment Awareness Week, observed from March 9 to 13, included the launch of the pilot program. And with this, the pilot program will be implemented in partnership with which of the following organization, that you have to tell. Okay, and with the launch event, in the launch event of this pilot, there was also the awareness campaign that was launched. What is the theme, or what is the title of that awareness campaign launched with the pilot under the Digital Payment Awareness Week? So the awareness campaign has the theme Thoda Dhyan Se. Okay, so now try to answer the first question in the comment section below, and try to answer the second question. I hope that easily you will be able to answer both the questions. So this is it. Thank you everyone. Thank you for joining the session. Let's meet in the next session on Tuesday. Okay, and next week I will also take a detailed session. Today's Finance 360-degree session. So today's session is very important, very special, because today we are going to discuss the Payments Vision 2028. This is a very important document that has recently been released by the Reserve Bank of India. So I hope you know that this is one of the most important documents that the RBI has recently released. Okay, so the free AI report that was released by the Reserve Bank of India, from that the descriptive question came in the RBI Grade B 2025 examination. There were also objective questions in the phase 1, descriptive question in the phase 2. So these kind of reports, these kind of documents are very important from the RBI. The Digital Payment Index, the Financial Inclusion Index, these indexes are very important. Similarly, the Payments Vision 2028, this is a document that is released for a 3-year time period. So this document is also very important from the examination point of view for your RBI Grade B point of view. Okay, so RBI's Payment Vision 2028, this is what we are going to discuss. This document is divided into 3 sections. So what are these 3 sections, and what are the important points that you have to remember? What are the previous documents? All of this we are going to discuss in today's session. So give me a thumbs up if I'm clearly audible and the screen is visible. I hope I'm clearly audible and the screen is visible. Is there any issue that is coming in the audio or the visual? Hi everyone. Good morning everyone. Give me a thumbs up if everything is fine, if I'm clearly audible and visible, loud and clear. Very good. Thank you. So now, before starting with the session, this session is going to be very important, okay? Now, before starting with the session, there is a very, very big announcement from EduTap that from 1st April, there is going to be a up to 30% price increase in the different regulatory body courses, okay? So from tomorrow onwards, there is going to be up to 30% increase in the prices for the regulatory body courses. So if you want to join the courses, if you want to take any of the EduTap's course, then you should join today with a flat discount of 77% with the old fee. Okay, so from tomorrow onwards, there is going to be the increase in the prices for the regulatory body courses. Up to 30% increase can happen. And today you are getting the course at the previous price with flat 77% off. So this is the idea. So if you are thinking of purchasing the courses for the regulatory body examination, then today is the time that you should purchase the courses. If you are the serious aspirant and want to get the course, then you should get the course at today's price, that is the older price with 77% discount. From tomorrow, there is going to be the price increase. This is the disclaimer I can say for all of you, an important announcement for all of you. Now, starting with today's session, that is going to be important. This is the Payments Vision 2028. This is the document that has been recently released by Reserve Bank of India on 27th March 2026. Okay, so this document is going to be very important from the descriptive and objective point of view from the exam, from the RBI Grade B examination, as well as for NABARD Grade A also. This document is going to be important because in the NABARD also we have seen the descriptive question on the financial inclusion and such. So the Payments Vision 2028 document is important for RBI Grade B descriptive and objective part, as well as for NABARD Grade A descriptive and objective part. Starting with the Payments Vision 2028, so RBI has been periodically preparing the Payments Vision since 2001. So this is important that since 2001, the Payment Vision document has been released by the Reserve Bank of India. Now this Payment Vision document, it includes providing strategic direction for structured development of the payment and settlement system in India. You can remember, like a few decades ago, we were using the cash only. And if we had to give a huge amount, either we had to give it in cash or there were checks that were being used. And these checks were being transferred between the banks in the physical manner, that in the truck or in the van of the bank, the checks were going from one bank to another bank in the physical format. So there were no online system that we use today, UPI, RTGS, NEFT. So these kind of instruments, these kind of digital platforms were not provided a few decades ago. So these UPI, NEFT, RTGS, you will see that how they have developed through these Payments Vision. Okay, so the RBI has been periodically preparing Payment Vision since 2001, and this Payment Vision, it provides a medium term strategic roadmap for the evolution of the payment systems. Okay, so this Payment Vision, it provides a medium term strategic roadmap for the evolution of the payment system in the country. Medium term strategic roadmap. Why medium term? Why not short term or why not long term? Because the Payment Vision is a document that is usually for a time period of 3 years. So short term, usually we say less than 1 year. Okay, long term we say 5 to 10 years. Okay, so this Payment Vision is a medium term strategic roadmap that is providing the ideas regarding the evolution of the payment system. Okay, so it provides the strategic direction, it provides a roadmap for the evolution of the payment and settlement system in the country. So I hope this is very much clear. Now the RBI has released Payment Vision 2028 for the duration up to December 2028. So you can understand that this document is released for a period of 3 years, the 2026, 2027 and 2028. So this document is valid up to December 2028. So RBI has released the Payment Vision 2028 for the duration up to December 2028. It has been prepared after considering inputs from various stakeholders, from various regulators. It consists of 15 specific initiatives which are to be taken during the course of the 3 years. So there are 15 specific initiatives that have been mentioned in the Payment Vision 2028 that are the initiatives that have to be taken under these 3 years up to December 2028. Okay, so this is the idea. So this is the Payment Vision 2028. This is the document that the RBI has released, and this is divided into 3 sections. First section is about Payment Vision documents over the years. Over the years, how the Payment Vision document has evolved and how the payment system has evolved. What are the outcomes from this Payment Vision documents? Okay, then we will discuss about the Payment Vision 2028. What is the theme of this document? What are the important areas and what are the focus areas? Then we will discuss about the specific initiatives. Okay, so this is the idea. Now, Payment Vision 2028, it is released by the Department of Payment and Settlement System of the Reserve Bank of India. Okay, and this document is valid till December 31st, 2028. So remember that the Payment Vision 2028, this document is valid up to December 31st, 2028. Now the vision document, it focuses on the user empowerment. That is, there is customer centricity, that is the focus area. So the vision document focuses on the user empowerment, the empowerment of the users, the empowerment of the customers who are using the digital payments, who are using the payment and settlement system, strengthening the safeguards against fraud, enhancing the efficiency of cross-border payment frameworks. Because if you see the domestic transactions that happen through UPI, through RTGS, NEFT, so the domestic transactions are quite smoother now. But the problem comes in the cross-border payment and the cross-border transactions. So it is said that we have to focus on the cross-border payment framework also, so that the cross-border transactions and the remittances that come from outside, they become even easier and through the digital format. Okay, promoting ease of doing business, among others. So these are the focus areas of the Payment Vision 2028. Now, as we have discussed that the Payment Vision 2028 has 3 sections that we have to discuss. First is the Payment Vision document over the years, Payment Vision 2028, and the third is the specific initiatives that have to be taken under the Payment Vision 2028. Okay, so now first we are starting with the first section. So now we are going to start with the first section, that is Payment Vision document over the year. This is the first section that we are taking up. So Payment Vision documents over the years. RBI has been making continued efforts to enhance the efficiency, security, accessibility of the payment systems, fostering a more inclusive and resilient digital payment ecosystem. It's not only that we have to start the digital transactions, we have to build a digital payment ecosystem. We also have to focus on its safety and the resilience, that if a payment system has started, it should be resilient, it should be able to continue functioning. It's not like that we are using UPI today and for 3 days it will not be available from tomorrow because the system has a downtime and such. So if a system is provided, if a digital payment ecosystem is provided, that should be used in a continuous manner, that should be resilient. Okay, it should be able to safeguard itself from the outside attacks. So this is the basic idea. So RBI has been making continued efforts to enhance the efficiency, security, accessibility of the payment systems, fostering a more inclusive and resilient digital payment ecosystem. Now, can you name some of the ecosystems, or can you name some of the instruments that have been provided by the RBI or NPCI? Like the UPI, that is a digital payment ecosystem. RTGS is there, NEFT is there. Any other digital payment ecosystem or any other instrument that you can name? BBPS, Bharat Bill Payment System. Anything else? There is also the check truncation system that we are going to discuss. There is also TReDS that we are going to discuss. There is also the Aadhaar enabled payment system. So you can understand that since 2001, there is a lot of development that has happened in the domain of the payment and settlement system. And all these developments are under some of the Payment Vision documents that we have to discuss. Okay. Yes. So now, as a result of this endeavor, as the result of the Payment Vision documents, India has solidified its position as the global leader in the real-time digital payments by processing nearly 50% of all real-time payments, global real-time payments. The role of RBI has evolved further from not only being the regulator of the payment system, but also as a catalyst to the enablement of the innovation in the payments. So as a result of these Payment Vision documents, as the result of having the medium-term strategic roadmap, we have this medium-term strategic roadmap that is showing that how we can evolve in the domain of the payment and settlement system. So as a result of this endeavor, India has solidified its position as the global leader in real-time digital payments by processing nearly 50% of all global real-time payments. What is the pride of our country? UPI is one of the prides of our country. Like, we take pride on UPI because this kind of system, and that also being used by so many of the people, is not available in any of the other country. Like, there is massive use of UPI that is happening in India. This is not present in any other country in such a massive scale. So you can understand that UPI is the pride of our country, and many of the other countries, they see towards India, they look towards India, towards the digital transformation that we have. So this is the pride of our country, right? So global leader in real-time digital payments, India has become the global leader in real-time digital payments. India accounts for nearly 50% of the global real-time payments that are happening. And the key focus areas that RBI focuses on is the efficiency, so that there are faster transactions that are able to happen with lesser and lesser downtime, security, fraud prevention, accessibility, the financial inclusion, that all the businesses, individuals should be included in the digital transformation, should be included in the payment system. Okay, so this is the idea. Now let's move forward with the documents now. The payment vision documents over the years, so different documents, we will discuss that which phases they have seen. So different documents have seen different phases. Okay, like the first document has seen the foundational phase. So there are different phases for the different documents, and there are different outcomes of the different document. Okay, any confusion anyone has till now? Any confusion anyone? All clear? Chalo. Then moving forward, now we will talk about the different payment vision documents and their key outcomes, okay, with the different phases that the documents have gone through. So starting with the first payment vision document, that is 2001 to 2004. So the first payment vision document had this timeline of 2001 to 2004, and this was the foundational phase. Okay, so payment vision document 2001 to 2004, it had the foundational phase. Remember this, it had the foundational phase because at that time the foundation was being built. So see, till that time we were more dependent on the physical instruments. Till 2001 we were more dependent on the physical instruments. Okay, RTGS was not there, UPI was not there, Bharat bill payment system was not there, TReDS was not there, Aadhaar enabled payment system was not there. So the transactions that were happening were through the physical instruments, as well as the checks were also being transferred through the physical system. Okay, so if you are depositing the check in a bank, the check had to be physically transferred to another bank for its clearance and for the payment and settlement. Okay, so you can understand that till 2001 there were the physical instruments that were massively used, and they were the only solution for your transaction needs, and the checks were also physically transferred. So the foundational phase payment vision document first, that was from 2001 to 2004, it had the foundational phase. It led to the foundation for a modern technology driven payment infrastructure. So there was a shift towards electronic modes and centralized settlements. Okay, so this document, it led the foundation for a modern technology driven payment infrastructure. This document led the shift towards electronic modes and centralized settlements. So we went from the paper instruments to digital instruments or electronic instruments. Okay, so what were the key outcomes of this payment vision document or for this timeline? The real-time gross settlement was launched in 2004. Now real-time gross settlement, that is the RTGS, it is used for the large value transactions with the minimum transaction value that should be 2 lakh rupees, and there is no maximum transaction value as decided by the RBI. Okay, so the banks, they have the freedom to decide that what maximum value transaction they will allow through the RTGS, that is a digital system through which real-time settlement can happen. So you just have to go to your internet banking and such, and you just have to fill in the details for your large value transaction. Minimum transaction value is 2 lakh and there is no maximum transaction value decided by the RBI, but the bank can decide the maximum transaction value for themselves. So the bank can decide 10 lakh rupees or 50 lakh rupees or 40 lakh rupees as the maximum transaction value that they allow through the RTGS. But you can understand that before we were dependent on the checks. And 2001, you can think that the checks used to take at least 2 to 3 days for getting cleared. So the receiver had to wait for 2 to 3 days that will the check pass or will the check fail. The other party might default and the check might bounce. So the party was afraid that what if after 2 to 3 days the check do not settle. But in the RTGS system, the real time settlement will happen. The real time gross settlement happens. So the large value transactions could immediately be carried forward. Okay, and this is the idea. So real time gross settlement was launched in 2004 so that the real time settlement can happen of the large value transactions. There was expansion of electronic clearing services. So electronic clearing services is an electronic mode of payment and receipt for transactions that are repetitive and periodic in nature. Can you name some of the repetitive transaction? Your salaries, they are the repeated transaction because every month you will get the salary, right? Your the tax collections, they are also repeated because every year the tax collection has to happen. The water dues, the electricity dues, loan installment repayments, the periodic investment that you do, mutual fund transfers that you do, insurance premium, the salary, pension, interest, the dividend has to be paid by the companies every quarter. So these are the regular, periodic, repetitive transactions. Now the electronic clearing services is used by institutions for making bulk payments of amounts towards distribution of dividend, because the bulk dividend, I have bought the shares of, let's say, CDSL. So this is the company that has to pay me dividend. Even if I have the shares worth only 1000 rupees, let's say, then also dividend has to be paid to me, 10 rupees or 20 rupees dividend. Okay, so many of the people, let's say lakhs of people have bought the shares of CDSL. So to lakhs of people, the dividend has to be transferred. So the electronic clearing services, it allows the institutions to do the bulk payments for amounts such as the interest has to be paid, the banks have to pay the interest, the NBFCs have to pay the interest, let's say, the dividend has to be paid, salary, pension, and other collections might also be required, okay, or the company has to do the collection. So the electronic clearing services, it facilitates the bulk transfer of money from one account to multiple accounts or from multiple accounts to one account. So if the dividend has to be transferred, so one account to multiple accounts. If interest has to be transferred, one account to multiple account. If salaries have to be transferred, one account to multiple account. If, let's say, a collection has to happen, insurance premium collection has to happen, so from multiple account to one account and such. So the collection of the payments or the transfer or the payment, that can be done through the electronic clearing services. So this electronic clearing services is an electronic mode of payment or receipt for transactions that are repetitive and periodic in nature. So this was expanded under the foundational phase. Early development of the check truncation system. Check truncation system, as I've told you, that there was paper clearing that used to happen, and the check clearing that used to happen through the physical mode from one bank to another bank. In the truck, or let's say in the van, the checks had to be transferred in the physical mode. In the cars, the checks had to be transferred in the physical mode. So there was the check truncation system that was brought so that the checks could be passed on in the digital manner. Okay, let's say you are depositing your check. Let's say you are depositing your check in your bank. Okay, you have the account in the State Bank of India, and the person who is paying you the money. So let's say there is transaction that is happening between X and Y. So X is selling the property to Y, and Y has to pay the amount. Okay, so X is selling the property to Y, and Y has to pay the money. Now the Y is giving the check. So X has the account in the State Bank of India, Y has the account in ICICI Bank. So Y has given a check to the X. Now X, having the account in State Bank of India, is depositing the check in the State Bank of India, that is the presenting bank. Now this bank will now this is the check. In the check, there is the MICR data. MICR data is the MICR is the magnetic ink character recognition. Okay, magnetic ink character recognition data. That is usually a 9-digit code that can be recognized through the machine. Okay, that can be recognized through the machine. So the check has a MICR data. Now this check MICR, the scanning of checks and maintaining of MICR data will happen in the bank itself, in the State Bank of India. Now the State Bank of India will send the digital images of the check with the MICR data, and the digital image of the check and the MICR data will be sent to the clearing house, which will verify that the check is valid or not, and then outward check will be transferred, or the check digital images as well as MICR data will be transferred to the ICICI Bank, from where the money has to be settled, from where the payment has to be settled. So rather than physical transfer of the check, now what is happening, that the digital images of the check is being transferred, and the MICR data that is recognizable by the machine, this is being sent. So I hope this is clear, that there was the early development of the check truncation system under the foundational phase, that rather than sending the physical format of the checks to the banks, what we can do is we can send the digital images of the check with the MICR data that is readable by the machine, and you can check the check through the MICR data. So I hope this is very much clear, that now there is the digital format, or there is the digital process through which the checks can be transferred without the physical transfer. In the digital manner, the check can be transferred from one bank to another. So this was the foundational phase from 2001 to 2004. Then next, from 2005 to 2008, there was the institutional and regulatory phase that focused on building legal and institutional infrastructure to support a rapidly evolving payment ecosystem. So Department of Payment and Settlement System created within RBI in 2005. So you can understand that Department of Payment and Settlement System, which has released the Payment Vision 2028, it was set up in 2005. The Payment and Settlement System Act 2007 and the Payment and Settlement System Regulations 2008, they were granted statutory. They granted the legal authority to the Reserve Bank of India to regulate and supervise all payment system. So there was the Payment and Settlement System Act of 2008 that was established, and Payment and Settlement System Regulations of 2008 that were formed to provide the statutory authority, legal authority to the Reserve Bank of India to regulate and supervise all payment system. National Payment Corporation of India, that we know as the NPCI, this was established in 2008 as the umbrella organization for the evolvement or for the evolution of the retail payments. Okay, so the NPCI is the umbrella organization for the retail payments. NPCI has developed the Bharat Bill Payment System, the UPI, the IMPS that is used by us, by the common people basically, or even by the businesses and such. So NPCI was established in 2008 as the umbrella organization for the retail payments, okay, that can happen between like person to person, person to merchant. So that is the idea. Now, oversight and expansion phase. Next was the oversight and expansion phase. So first was the foundational phase that we started, that okay, we have to develop the digital modes, electronic modes for the check transfer and such. Then there was the institutional and regulatory phase. We have to develop the institutions that can handle and that can further focus on evolving the payment and settlement system. Then there was the oversight and expansion phase that focused on operational efficiency, safety and inclusion while aligning domestic oversight, domestic regulation with the international standards. In this time period of 2009 to 2012, the NEFT and the RTGS systems were expanded. So NEFT is the system through which the transactions, the digital transactions can happen. Okay, but this is not in the real time. In 30, like there are the half yearly batches, half hourly batches through which the transaction happens. So let's say you are initiating the transaction. So in the half hourly batch, your transaction will be settled. So in one day, that is in 24 hours, there are 48 batches under which the transaction is completed. Okay, so this is the idea, and there is no minimum or no maximum limit that is decided by the RBI. The banks have the responsibility, or the banks have the freedom to decide the minimum limit under the NEFT. But RTGS, it is the real-time gross settlement system through which the large value transactions can happen, and that's why there is the minimum transaction limit of 2 lakh, that at least minimum 2 lakhs should be transferred or above than that. Okay, so NEFT and RTGS systems, they were expanded further. Electronic transactions gained traction. The electronic transactions slowly improved, and the people started using these transaction systems. Okay, now RBI enhanced its supervisory role over the financial market infrastructures. As you know that there are financial markets that are under the control of, or that are regulated by the Reserve Bank of India. Can anyone name that which of the financial markets are under the regulation of the Reserve Bank of India? Anyone? Any idea? So the financial markets that are regulated by the Reserve Bank of India are the government securities market. Okay, government securities, RBI issues the government securities on behalf of the government, as well as the forex, as well as the money market, the interbank borrowing and lending that is happening, the call money, the call market, the notice market and such. So call money market and such. Yes, money market. So these are the markets under the regulation of the Reserve Bank of India, under the supervision of the Reserve Bank of India. In the money market, where the interbank transactions are happening, interbank borrowing and lending is happening for a short time period, for the 14 days, for the 7 days, for overnight. So the money market transactions where the interbanks are where the banks are transacting, interbank transaction, borrowing and lending is happening. The foreign exchange market as well as the government securities market, all of this is under the regulation of Reserve Bank of India. So RBI enhanced its supervisory role over financial market infrastructures. Okay, so this is the idea. So the NEFT and RTGS. NEFT is the National Electronic Fund Transfer. National Electronic Fund Transfers. This allows the transactions to happen in the 48 batches, half hourly batches. Okay, RTGS is real-time gross settlement when the real-time transaction is happening. Okay, so this is the idea. So NEFT and RTGS were expanded and RBI enhanced its supervisory role over the financial market infrastructures. Now coming to the next part or the next document. So inclusion and standardization phase. Now the focus was given after the oversight and expansion. The focus was given to inclusion and standardization. Now that we have to include more and more people in the digital transformation, in the digital ecosystem and the payment and settlement system. So 2012 to 2015, this was the inclusion and standardization phase. The explicit goal of achieving a less cash society, emphasizing interoperability, inclusion and customer protection, consumer protection. So under this document, there were licenses and expansion of the prepaid payment instruments. These are the like digital wallets and such. So prepaid payment instruments were licensed and expanded. Groundwork was laid for trade receivables discounting system and Bharat bill payment system. Now what is the trade receivables discounting system? That is TReDS, trade receivables discounting system. This was initiated in this time period, or the groundwork was laid for the trade receivables discounting system in this time period. Anyone knows about the TReDS? So see, TReDS platform, this allows the factoring or the bill discounting basically. So let's say the micro, small and medium enterprises, they are selling their product to a public sector undertaking of the government. Okay. Now the PSU, the MSMEs are selling the product worth of 10 crores to the PSU. Now the PSU is saying because so much of the money has to be released, so basically the PSU requires 3-month time to get the signature of the higher ups and to release the money. Now the MSME is saying that we cannot wait for wait for 3 months. Okay, we have sold table and chairs to you worth 10 crore. So kindly give us money right now. So PSU is saying that we cannot give the money right now. You can take back your products. MSME do not want to lose the customer. MSME do not want to lose the business. That's why MSME is saying that, okay, we will provide you the tables and chairs and do provide us the 10 crore rupees after 3 months. So there is a bill invoice. There is a bill invoice. Bill invoice is nothing else. It is a bill. Like you get the bill in the shopping mart when you do the transaction, right? So bill invoice is basically a bill in which the MSME has stated that the MSME has sold the table and chair worth 10 crore rupees and the PSU will give the money after 3 months. But the MSME has to pay to the laborers. The MSME has to pay for its rent, for its warehouse and such. MSME has to pay money for its raw materials. The MSME needs the money right now basically for its further continuation of the business. Okay, so what the MSME can do, that it cannot receive the money from the PSU right now, but it has got this bill invoice. So supplier, that is the micro, small and medium enterprise, it supplies the goods and services, it delivers the products or services to the buyer. So the seller, that is the MSME, has sold the product to the buyer. Now the supplier cannot get the money from the buyer immediately. So supplier, the seller upload the invoice in the TReDS platform. there are multiple TReDS platforms that are licensed by the RBI. They are operated by different companies. Okay, so the MSME can go to any of the TReDS platform. It can be RXIL, or it can be the DTX, or it can be the M1. That is also a TReDS platform. Okay, so there are different TReDS platform, multiple TReDS platform that are operated by different companies, different operators. They have got the license from RBI. So let's say MSME is going to the M1 TReDS platform, and the MSME, the supplier, the seller is uploading the bill invoice, logs into the TReDS platform, uploads invoice for the receivables. Okay. Now the buyer verifies, the PSU, the government verifies, the public sector undertaking of the government verifies that okay, this is the material that has been bought by the government, by the PSU, and this much of the money has to be given to the MSME. Approves the invoice. The buyer also approves the invoice. The authenticity of the bill invoice has been confirmed. Now this bill invoice will be converted into factoring unit. Factoring unit basically shows that how much is the worth of this bill invoice. This bill invoice is worth 10 crore rupees. Okay, and the money has to be taken on, let's say, 31st June 2026. Okay, so this is the time when the money will come from the buyer. Okay, so invoice is split into units for bidding by financiers. Now the financiers will bid. Financiers means it can be banks, it can be NBFCs. So they will bid that okay, if the MSME wants the money right now, so we can give the money to the MSME at 5% discount rate. 5% discount means 50,000 discount. 50,000 less, 50 lakhs less, sorry. 5% discount means 50 lakhs, 5 lakh less, 50 lakhs. Okay, so this is the discount. Or let's say at 10% discount, so the financiers are saying basically that we will pay to the MSME at 10% discount. That is, we will pay 1 crore less, we will pay 9 crores to the MSME, or we will pay at 5% discount. So there are different bidding that is happening. Some bidders are saying 10% discount, some bidders are saying 5% discount, some bidders are saying let's say 7% discount. So the supplier accept the best bid. That is the discount of 5%. So supplier is having the bill of 10 crores and discount of 5%, that is 50 lakhs, let's say. So the supplier is able to get 9 crore 50 lakhs immediately. On the immediate basis, the seller is able to get 9 crore 50 lakhs. Now the M1 generates the settlement instruction for debiting the financier, for debiting the bank or the NBFC that has done this bid, and the supplier will get the money. The supplier is getting 9 crore 50 lakhs. The financier is the one that is going to wait for 3 months now. The bank is the one that will wait for 3 months, and after 3 months, the settlement instruction will take place for debiting the buyer and crediting the financier. So financier will get the money after 3 months, and financier is making the profit of 50 lakhs because for waiting 3 months, the financier got this 50 lakh rupees. Okay. So MSMEs can operate without facing irregular flow of in their operational funds. The MSME needed the money right now, as well as the MSME is ready to get the money at the discounted rate. Okay, so the MSME wants the money right now, and the MSME is ready to get the money at the discounted rate, and the MSME do not want to lose the business. Okay, do not want to lose the business from the public sector undertaking. Public sector undertaking wants to pay after 3 months. Financiers, they are ready to give money to the MSME right now. So all the parties are in the happy situation because the MSME that needs the money right now is able to get the money at the discounted rate. It is also able to maintain the business. Okay, public sector undertaking will pay after 3 months. The financiers, they are able to get the profit of 50 lakh just for waiting 3 months. That is the idea. Any confusion? So this is the idea that the groundwork was laid for the trade receivables discounting system. This is the discounting system under which the factoring happens. This is known as factoring. Okay, the discounting happens. So faster access to working capital for the MSMEs. Buyer's account are debited after the time period. Financier credited. Transparent and competitive financing. Maybe the discount is only 1%, or maybe the discount is only 0.1%, 0.2%. Okay, whatever the discount rate can be. So this is the idea that groundwork was laid for the TReDS, so that there is the financing that can be provided to the micro, small and medium enterprises in the immediate manner. And this TReDS platform is only available for the MSMEs, sellers. And buyers, different buyers can join. Okay, the buyer can be the PSUs or any other corporate that has a good rating usually. Okay, so this is the idea, that this TReDS platform was developed for the micro, small and medium enterprises that sell, and usually the payments are stuck, and so the MSMEs require immediate money. Then they can give the bill invoice to the financiers and take the money immediately at a discounted rate. Now, Bharat Bill Payment System, this is the Bharat Bill Payment System was developed by the under the NPCI, and the NBBL, that is National Bharat Bill Payment Limited. It is a subsidiary of the NPCI that handles this Bharat Bill Payment System, through which the people like you and me, we can pay any bill. Like you want to pay electricity bill, water bill, so through this Bharat Bill Payment System, you can easily pay the bills. As well as under this particular document, there was also the focus that was given to acceleration of Aadhaar enabled payment system. Let's say you do not have UPI. Till that time, UPI was not available. Let's say you are not able to do RTGS, you are not able to do NEFT, you do not have your mobile phone or something. Okay, so you are not able to do any other digital transaction, you cannot pay the check. So what you can do, you can go to a business correspondent, that is the extended arm of the bank, and you can do the Aadhaar enabled payments. Okay, Aadhaar enabled payments, you just have to give your Aadhaar details. You just have to give your Aadhaar details. Then you have to do the biometric. Okay, you have to give your biometric detail, you have to do the fingerprint scan or iris scan, and after that, if you want to do the cash withdrawal, you can do so. The business correspondent will give you the money. Or if you want to do the cash deposit, that you can do. If you want to do the fund transfer to another account, that you can do. If you want to check your if you want to get the mini statement, or if you want to check your balance, that you can do. So basically, Aadhaar enabled payment system, if you are not able to do any other transaction, let's say there is a senior citizen who is not aware about the RTGS, NEFT, who is not able to go to the bank because the bank is very far off from the village. So you have to do the immediate cash withdrawal. How are you going to do immediate cash withdrawal if you do not have the ATM nearby, if you do not have the bank nearby? And if you want to do the fund transfer, you do not have the RTGS or NEFT system. Then this Aadhaar enabled payment system will help. Business correspondents, the extended arm of the banks, they are available in the shops. They are available, like the shops are there nearby, business correspondents are available. So you just have to fill in the Aadhaar details, scan your fingerprints, iris scan is also available, let's say. Then you can withdraw the cash or deposit the cash or do the fund transfer, or you can check your balance and take out the money statement. So these are the Aadhaar enabled payment system, where you have to provide your Aadhaar details and the biometric for the payment to happen. Okay, so the focus was given to accelerate the Aadhaar enabled payment system under this payment vision document. Coming to the next one, so we have discussed about the inclusion and standardization, where the focus was given to TReDS and the Bharat Bill Payment System and the acceleration of the Aadhaar enabled payment system and the licensing and expansion of prepaid payment instruments like the digital wallets. Coming to the digital transformation phase 2016 to 2018, in this time period, its focus was to encourage electronic payments across all sections of society while maintaining safety and resilience. UPI was launched under the NPCI's leadership. Okay, then next is measurable outcome phase, that is from 2019 to 2021. It introduced a results oriented framework under the theme empowering exceptional e-payment experience. Okay, it articulated 5 core attributes of payment system that has to be focused on, such as safety, security, convenience, speed and affordability. Established quantitative target including a 4-fold increase in digital transactions by 2021. Okay, so this is your measurable outcome phase of 2019 to 2021. Coming to the last phase, that was the globalization and trust phase, that was the payment vision document of 2025. Okay, so these were the payment vision documents: the payment vision document of 2016 to 2018, the payment vision document of 2019 to 2021. Now this was the payment vision document, the payment vision document of 2025. This was leading the globalization and trust phase. It was launched in 2022 and it reflected a confident, globally integrated digital payment ecosystem. Till now, we have developed Bharat Bill Payment System. We have a well-functioning Aadhaar enabled payment system. We have a well-functioning UPI till now. We have a well-functioning RTGS and the NEFT system. Okay, so now this Payment Vision 2025, it reflected a confident, globally integrated digital payment ecosystem. This Payment Vision 2025 anchored on the theme e-payments for everyone, everywhere, every time. So 4 E's. This was the theme, e-payments for everyone, everywhere, every time. It rested on 5 goalposts: integrity, inclusion, innovation, institutionalization, and internationalization. So in this Payment Vision 2025, for the first time, the internationalization was also focused on. That is, we have to internationalize our UPI system, our digital payment ecosystem. Okay, so these were the 5 goalposts: integrity, inclusion, innovation, institutionalization, and internationalization. Now the outcomes of this Payment Vision 2025 was alternative authentication framework. If you have studied for RBI Grade B 2025, then last year we discussed that how the OTP has become very repetitive. Like the two-factor authentication. In the two-factor authentication, first factor can be your PIN. You are putting your password, or you are putting some keywords. Okay, PIN, password, or something. And the second factor authentication is usually OTP. OTP is coming in your number. Now RBI is saying that OTP, you can use OTP for the two-factor authentication, but OTP is becoming too common. Okay, so that's why there are alternative authentication framework that also have to be searched, like there are authenticator apps that can be used, so that there are keys that can be used as that is usually in every 30 seconds the key is changed. Okay, so there are like the Google Authenticator apps and such, or Zoho Authenticator. If you have seen, these are the apps where the authenticator number is given, like 236849. Let's say this is the authenticator number. Now this keeps on changing every 30 seconds. So rather than only using OTP, these kind of Google Authenticator or Zoho Authenticator, such kind of authenticator apps can be used where the key keeps on changing every 30 seconds. So even if your phone is stolen, you know that after 30 seconds the key will change. So the second factor authentication cannot happen until and unless the other person has your Google Authenticator also. With your mobile phone, they should have your authenticator also. With your password, they should have the Google Authenticator also. So rather than only depending on OTP, the banks and the NBFCs and the other payment systems, they can allow the other authenticators, other authentication framework. Okay. Another thing was that master action on payment aggregators was released. This we have discussed last year, that there was a complete master action that was released regarding the payment aggregators, that are the intermediaries that allow the payments to happen smoothly. Let's say the merchants, they want to get the payment from the customers. So the transaction between the merchants and the customers can happen smoothly through the payment aggregators. Okay, this we have discussed last year. And you can see a session on the master action on payment aggregators that I have taken under the Finance 360-degree session. There was also under this Payment Vision 2025, the real-time check truncation system was reached. Okay, so near real-time check truncation system. So it was realized that even under the check truncation system, where the checks are being digitally transferred from one bank to another bank, so that there is no need for physical transfer, even in the check truncation system, it usually, the clearing cycle of the checks usually take T+1 day. That today you are depositing the check, so by tomorrow the check will settle. Okay. Now it is said that under the continuous clearing of checks under the check truncation system, your checks will be cleared in a few hours rather than waiting a whole day. So today you are depositing the check will get settled by tomorrow. So it is usually taking 1 day time period. Okay, so it was said that now under the continuous clearing of checks under check truncation system, in a few hours your checks will be cleared. So near real-time check truncation system is being adopted under the Payment Vision 2025. So these were the steps that were taken in the previous Payment Vision 2025, and these were the outcomes. Alternative authentication framework that can be used by the banks other than OTP. They can use the authenticator or other systems so that the two-factor authentication is strengthened. Okay, it is not only dependent on OTP. Master action was released on the payment aggregators. There were rules and regulations that were laid down clearly for the payment aggregators that are the intermediaries between the merchant and the customers in the digital transaction. Okay, near real-time check truncation system, that the check truncation system, the check clearance can happen in a few hours rather than taking a whole day. So these were the key outcomes. So RBI's Payment Vision documents released over the years chronicle, they lay down a transformative journey from infrastructure building to institutionalization. We have built the infrastructure, we have built the institutions that can handle the infrastructure, such as NPCI, that is a major player in the domain of the retail payments, that has developed the Bharat bill payment system, that has developed the UPI under the Reserve Bank of India. So the RBI's payment vision documents that were released since 2001 till 2025, like over the years, they show the transformative journey, the evolution from infrastructure building to institutionalization. Now coming to the payment vision 2028. Okay, this is the second section. So the dynamic and adaptive evolution through each vision has made India's payment system among the most advanced, inclusive and resilient in the world, while setting the stage for the vision document 2028. So the payment vision 2025 and the payment vision 2001 to 2004 till the payment vision 2025, these they have led to the dynamic and adaptive evolution through each vision document. This has made India's payment system the most advanced, inclusive and resilient. One that consolidates. Now the vision document 2028, now the payment vision 2028 is one that consolidates the gain even as it aims to help Indian payment space to further develop. Okay, so payment vision 2028 will develop the payment system further, and this is the payment vision 2028 that is going to consolidate the benefits. So payment vision 2028 builds upon the remarkable trajectory of digital payment in India with the core theme. Now remember the theme of the payment vision 2028, it is shaping India's payment frontier. It underscores the dual imperative of consolidating and strengthening the existing system. So payment vision 2028 has to further strengthen the existing systems infrastructure while pioneering the future of payments, while further focusing on evolution and development. Okay, so payment vision 2028 under the core theme of shaping India's payment frontier, certain specific initiatives, 15 specific initiatives have been identified, focusing on operational excellence, strategic innovation, ensuring that payment infrastructure remains resilient, inclusive, user-friendly and technologically advanced. Okay, so these are the 7 areas where the focus have been given, the 7 areas under which the strategic initiatives or the specific initiatives are being undertaken. Okay, so these are the 7 areas under which the 15 specific initiatives are undertaken. So 7 areas are: promote inclusivity and resilience, enhance safety in the digital payments, review of the cross-border payments, promoting ease of doing business and convenience, provide a boost to research, promote systemic stability and integrity, innovation. Okay, so these are the 7 areas under which the 15 specific initiatives have been launched. Now the current payment vision document set the course up to December 2028, that is for a time period of 3 years. It may be noted that while the document provides strategic direction and the initiatives, the 15 specific initiatives that have to be undertaken, but there can be additional initiatives that are not included, they can also be undertaken. So additional separate initiatives that can be undertaken by RBI or NPCI if they feel that there is the need as per the evolving needs and opportunities. Okay, so there can be other initiatives that can also be undertaken, but these 15 specific initiatives are the priority areas. Now we have discussed the section 1, that is the payment vision document. Over the years, I have explained you about the TReDS, I have explained you about the Aadhaar enabled payment system, the basics of the NEFT and the RTGS system. Okay, the check truncation system. Payment vision 2028, the theme you have to remember, there are the 7 areas under which the 15 specific initiatives are launched. Now coming to the specific initiatives. Okay, so first specific initiative that we are going to discuss is framework for interoperability and innovation in TReDS. So that's why I explained you the TReDS in detail, because for understanding the interoperability and innovation in TReDS, you have to understand the idea behind TReDS. What is TReDS? TReDS is, over the years, TReDS has evolved as a critical platform to address liquidity challenges and unlock growth opportunities for the MSMEs. TReDS, that is Trade Receivables Discounting System, it is a specific platform that is provided for the micro, small and medium enterprises so that they can get the liquidity when they require. Let's say they have sold their product worth 10 crore rupees to a buyer and the buyer is unable to pay right now. MSMEs require the funds immediately. So MSMEs can go to the TReDS platform and can take the money at a discounted rate. Okay, if they want immediate money, they can take the money at a discounted rate. So that is the idea. So over the years, TReDS has evolved as a critical platform to address the liquidity challenges and unlock the growth opportunities for MSMEs. There is considerable potential to further enhance the operational efficiency of the TReDS through targeted improvement in the TReDS platforms. In this regard, the case for introducing the following shall be explored. So these are the these are the targeted improvements that the TReDS is going to have, or that is the specific initiative that is mentioned under the Payment Vision 2028, that there is the targeted improvement that is required in the TReDS platform. So these are the improvements. First one is full interoperability across TReDS platform. So right now what happens? First of all, I hope TReDS is clear. Now, as I've told you that there are different TReDS platform, RXIL, M1 Exchange, InvoiceMart, DETX. So there are multiple TReDS platform. Now these TReDS platforms are operated by different companies, okay, that are licensed by the RBI to operate the TReDS platform. You can understand that, let's say M1, RXIL, DTX, they have different financiers. There are certain banks, there are certain NBFCs that have joined the M1. There are certain financiers, there are certain banks, certain NBFCs that have joined the RXIL. There are certain financiers that have joined the TTX. Now, if the MSME is logging in M1 and is providing the bill invoice in the M1, the financiers of M1 can bid to provide the money to the MSME at a discounted rate. Okay. So this is happening in M1. Now the RBI is saying that there might be less financiers in M1 and more financiers in RXIL, but M1, because it is doing more of the advertisements, so many of the MSMEs, they know only about the M1 and they are coming to M1. So what might be happening, that M1 might have many of the customers, many of the micro, small and medium enterprises that want to get the funds that are coming to M1, but M1 might have less financiers, or maybe the financiers, they are not so happy to provide the money to the MSMEs. Okay, so they are involved in M1, but they are not very attentive or very liquid in providing the money, while the RXIL is not doing much marketing, and that's why it is not getting much customers from the they are not getting much MSMEs, but many of the financiers have joined RXIL because of the low cost in the RXIL or low joining fees in the RXIL. So this is the problem that is happening, that the MSMEs, they are not able to meet all the financiers, they are not able to get the bids of all the financiers. Like I've told you that maybe the financiers in M1 are providing 10% discount, 5% discount and 7% discount. So the MSME has to choose the discounted rate of 5%. So out of the 10 crore discounted rate of 5%, that is 50 lakh, the MSME is only getting 9 crore 50 lakhs. Now the RBI is saying that what if the MSME, just by posting its bill invoice once, this bill invoice will be shown in all the TReDS platform, M1, RXIL, the InvoiceMart, the DTX, and all the financiers of all the TReDS platform, they can do the bidding. Now RXIL, because it has many financiers and they actually want to bid good, they actually want to pay, or they actually want to provide the money to the MSMEs at a discounted rate, and they actually want to earn from this platform. So they are bidding even more competitively, and they are bidding at 3%, 2%, at let's say 1%. Some of the financiers are bidding at let's say 4%. So now the MSME has more opportunity to get a competitive bid of 1%. So out of the 10 crore, the discount will be only 10 lakh. And the MSME can get 9 crores 90 lakhs. So you can understand that with the platforms merged, or let's say with the platforms interoperability, not merged but interoperability, this will increase the efficiency, this will increase the competitive spirit. So what has been said, that once the MSME logs in and provides its bill invoice, all the platforms, all the financiers from different platforms will have the opportunity to bid for this bill invoice. So right now the platforms are not interoperable, if the MSME is providing its bill invoice to one platform, that can be only bid by that platform's financiers. Okay, so this is the idea. This is the targeted improvement that is sought out under the TReDS. This is the specific initiative that has been mentioned in Payments Vision 2028, that going forward we have to do the targeted improvement in the TReDS so that it can be fully interoperable. So full interoperability across TReDS platform. Right now there is RXIL, M1, InvoiceMart, DTX. There are other TReDS platform also. To harness efficiency, there should be interoperability. So if the micro, small and medium enterprise, it is aware about the RXIL through the marketing. Let's say the MSME is only aware about RXIL because it has done the marketing. So MSME is doing the bill invoice uploading in the RXIL. But all the platforms financiers, the financiers from all the platform will be able to see the bill invoice, will be able to bid. So there will be more competitive bidding will happen, because before there was only the bidding that can happen in one platform for one bill invoice. Okay, but now the bidding can happen in all, like just upload your bill invoice and bid will be done by financiers from different platforms. So full interoperability across TReDS platform. This will harness efficiency, competitive spirit and avoid duplication of efforts. The MSME will not have to upload the bill invoice in the different platforms and pay the fees for the different platforms. So before, let's say the MSME wants to get the competitive discount rate. The MSME do not want to pay 5% of the discount rate. MSME wants to pay only 0.5% or 1% of the discount rate maximum. So MSME uploaded the bill invoice in the RXIL, and the MSME is seeing that okay, they are only doing the bidding at 10% discount, 5% discount, 2% discount, while the MSME wants the discounted rate of 1% only. So MSME will have no opportunity, will have to log in M1 or InvoiceMart or DTX. So MSME has to upload the bill invoice in the M1 and has to pay the fees to the M1, and then here the financiers are bidding more competitively, let's say 5%, 2%, 1%, 0.75%. So now the MSME has seen that okay, these financiers are better and they are providing a good discount rate of only 0.75%. Okay, so now the MSME will choose the best bid for itself. So before, the MSME had to log into different platforms to get the best bid that the MSME, the supplier, can get. So now with the full interoperability, the MSME will have to provide its bill invoice uploading just once in any of the platform, and the financiers from all the platforms will be able to bid. This will increase the competitive spirit. So now this is a very, very important update that will happen in the TReDS platform if it happens, because this is just a improvement, that is the initiative that has been mentioned that will happen in the future. If this actually happens, this will be very good for the MSMEs, because the financiers, there will be multiple financiers that will have the competitive spirit. Now coming to the factoring with recourse, this will help the financiers. How? Because right now what happens that, let's say in our example, the MSME gets the money, the financier has to wait for 3 months to get the money from the buyer. What if after the 3 months the buyer, because it is not the public sector undertaking of the government, but let's say there is some corporate that had a good rating of AA or that had a good rating of BBB minus. So financier paid the money to the MSME at a discount rate of 5%, and the financier will get the money from the buyer after 3 months. What if buyer defaults? What if buyer says that we cannot pay? Buyer is a private company, now it is saying that we cannot pay. So financier will make a loss of 10 crores because the financier paid 9 crore 50 lakhs to the MSME and financier was expecting the profit of 50 lakhs. So now the financier has already paid the MSME and the buyer is defaulting. So financier will lose the whole money. So now it has been said that factoring with recourse can happen. So this is another targeted improvement. Factoring with recourse basically means that the financier will have the opportunity to take back the money from the MSME if the buyer defaults, because MSME traded with the buyer. MSME was the one that gave the 3-month timeline to the buyer. So MSME should have the last risk also. So basically, financier will pay immediately to MSME. The financier will pay the 9 crore 50 lakh rupees to the MSME, and the financier will wait for 3 months to get the money from the buyer. But if the buyer defaults, the financier will take back the money from the MSME. So this is the factoring with recourse, that there is the recourse to the financier. The bank, the NBFC has the recourse to take back the money from the MSME, because the MSME traded with the buyer. The MSME should take the responsibility of the default. Got it? Any confusion here? This is the factoring with recourse. Before, the financiers, they were, as I told you, that some of the financiers, they were not very excited to give the money to the MSME, because they were afraid that what if the buyer defaults, especially if the buyer is a private company, it is a corporate that has the fine rating of BBB minus or CCC minus. So financiers, they were not happy to pay to the MSME, and they were not happy to wait because the buyer can default. But factoring with recourse, this will allow the financiers to pay to the MSME, and if the buyer defaults, they can take the money back from the MSME. Okay, so this is the factoring with recourse. Recourse is the MSME paying back to the financiers if the buyer defaults. Last one is trade receivables discounting of export MSMEs. So basically here what happens, that right now the financiers, they are giving money to the MSMEs at a discounted rate if the MSMEs, if the buyers are going to pay after a few months or after 1 month or 2 months. Okay, so buyers right now, the domestic buyers are there that have that can be the private buyers, the private corporates, the private businesses that have the ratings of AA, BBB and such, or the public sector undertakings. But now it has been said that the MSMEs, even if they are doing the export, if these are export MSMEs that are selling the products to the international buyers, then also the financiers can provide the money to the MSMEs. So basically, the financiers, they were providing the money to the MSMEs right now, and they are going to take the money from the buyers later on. After 3 months, let's say, they will take the money from the domestic buyers. Now it has been said that the trade receivables discounting of export MSMEs, that means financiers, they are allowed or this is the initiative that will be taken in the future, because this is the specific initiative mentioned in the Payment Vision 2028 that can be undertaken by the Reserve Bank of India. RBI can allow the international, if the MSMEs are selling to the international buyers, to the foreign companies, then also the financiers can discount the bills, and financiers can pay the MSMEs the discounted bill amount. Okay, why is it so? Because now the factoring with recourse will be allowed, that if the international buyer defaults, the MSME will have to return the money to the financiers. So financiers will not have too much of the risk. So I hope this is clear, that these are the 3 targeted improvements that have been mentioned under the Payment Vision 2028 as the specific initiative to be taken for the TReDS. So this is the first specific initiative. So full interoperability across TReDS platforms to harness efficiency, competitive spirit, avoid duplication of efforts from the MSMEs. Okay, factoring with recourse, the MSMEs, if the buyers default, the MSME will have to pay back to the financiers. Okay, trade receivables discounting of export MSMEs, right now only the MSMEs that were doing the domestic transaction, that were selling through the domestic buyers, they could take the money from the financiers. But it has been said that even the MSMEs that are doing the export, that are selling to the international buyers, they can also take the money from the financiers. And there is also the factoring with recourse that will be allowed. So if the international buyer, if the international company, foreign company defaults and is not able to pay back to the financier, then the export MSME will have to pay back to financier. This is the idea. Any confusion, anyone? So this is it. Now, as I've told you that there are 7 areas under which the specific initiative has been brought. The 15 specific initiatives, they have been brought under these 7 areas. Promote inclusivity and resilience. Under this particular area, the specific initiative of the TReDS has been brought. Okay, so to promote inclusivity and resilience, that is your first area. Under this area, the specific initiative of the TReDS interoperability has been brought. This specific initiative is under the inclusivity and resilience area. Now we will discuss the other initiatives in the next session, because the session has already been long and I do not want to just rush through all the topics, because the TReDS, AEPS, RTGS, NEFT, CTS, these are the important areas that you must know about. They will again and again be talked. As well as this topic is very important from the descriptive point of view. So you must know about the specific initiatives. So the rest of the initiatives we will discuss in the next session. Okay. So this is the idea. Any confusion? Anyone? So basically this is the specific initiative. So one of the specific initiative we have discussed. This is the specific initiative that we have discussed, okay, that is regarding framework for interoperability and innovation in TReDS. And this particular specific initiative, this is under the first area of promoting the inclusivity and resilience. So out of the 7 areas, the first area of promoting the inclusivity and resilience, under this area, this specific initiative has been announced, okay. Chalo. This is the first question. I hope you will be easily able to answer this question. This is the objective question that can come in your phase 1. Okay, this can come in your phase 1. It can even come in your phase 2, but then there will be a big paragraph. A paragraph based question can come, and on the basis of this paragraph, you have to answer the multiple different questions on the Payment Vision 2028. Okay, now this is your descriptive question. RBI's payment vision documents reflect the evolutionary journey of India's payment ecosystem from basic infrastructure development to global leadership in digital payments. Discuss this statement by tracking the key phases of payment vision documents and their outcomes. Okay, so this is the question. Basically, you have to inform about the key phases of payment vision document. So I hope you remember the foundational phase, and after the foundational phase, what was the phase? After that, what was the phase? So there are the 7 phases that you must mention and their key outcomes that you must mention. So this is the descriptive question that can come, and this is the descriptive question that you have to write answer of from this session. So this is it. Now before ending the session, let me remind you that from tomorrow there is going to be up to 30% of price increase for the different regulatory body courses. So if you want to buy the course for the regulatory body examination, you can join today and you will get the old price. And at that old price, you will also get the flat 77% off. So from tomorrow onwards, there is going to be the price hike. There is going to be the price increase for regulatory body courses of up to 30%. So if you are serious for your preparation, if you are a serious aspirant who wants to buy the EduTap's courses, today is the time where you can get the previous price and flat 77% off on the previous price. Okay, so this is it. Thank you everyone, and you will get the PDF of the session in the Telegram channel. The link for the Telegram channel is provided in the description box below. Okay, so do join the Telegram channel of EduTap where you will get the PDF for today's session. So this is it. Thank you everyone. Okay, word limit is your 600 words. This is the question for 15 marks. Okay, this is the question for 15 marks, 600 words, and the material I have provided, the detailed material in this session itself. You can use this material, you can analyze your answers against the material provided in the session itself. Okay, thank you everyone. Thank you for joining the session. So now we are towards the end of the session. Let's see that how EduTap can help you. So if you want the relevant and systematic material, you can go to EduTap's website. You just have to type edutap.in and you can come to the EduTap's website. Here in the courses section, you can see the RBI Grade B courses. Okay, so if you want the detailed material for the phase 1, for the phase 2, you can see the gold course where the concept classes, the concept videos are provided to you for all the components, for all the chapters, as well as there are the concept notes that is provided to you. With the concept classes, there are summary sheets for your revision that is also provided. The mock tests are provided, current affairs magazine, solve previous year questions, chapter wise mock test, sectional mock test, current affairs mock test, full length mock test are provided, as well as before the examination there are also the live classes that are conducted. So this is the gold course that consists of the systematic and the relevant material for all the components for your phase 1, for your phase 2, as well as the interview guidance will also be provided. Okay, so this is the gold course that consists of the relevant material for all your phases for the RBI Grade B examination. If you are confident for your phase 1, you are thinking that okay, I have done my quant reasoning and I'm quite confident in the quant and reasoning section, English section, and I only want the material for the phase 2 for ESI, for English descriptive, for the finance management. So you can get the silver course where you are getting the material for the phase 2 and the interview. Okay, here also you are getting the concept classes, the videos for all the components for the phase 2. You are getting the concept notes, summary sheet, mock test, interview sessions, live classes also. Okay, now if you think that you already have studied previously for the RBI Grade B examination and you have good conceptual understanding, you only want to practice the MCQs, then there are the test series that are also available. Okay, so this is how EduTap is helping you. EduTap is bringing out the systematic and the relevant material for all of you as per your needs, as per your requirement. So this is it, and this is the end of the session. Thank you everyone for joining the session.